lot of the frontline IT stocks at fresh 52-week lows. But for today, just to recap, yesterday we already saw the signs of that downtake because the markets did close in the red on Thursday. It ended near the day's low. We had the FIIs which net bought, but they bought only around 108 crores on a net basis. DIIs net bought around 276 odd crores. So we'll really need to see what the trend moves like. So CPI for January also came out over, post-market. So that came in at around 2.75% in terms of the new series, below the midpoint of the RBI targeted range of around 2 to 6%. Like I mentioned, and like you were talking about, the US markets closed lower overnight. Asia is lower at this point in time. And we still have Brent crude, which is hovering at around those $69 per barrel levels. A lot of result reactions today. So Hindalco, Coal India, ONGC, Biocon, Lupin, Cohance, Honasa, to name a few. And results today, as we wind down the earnings season, we have Torrent, Alchem, NBCC, InfoEdge, Fortis, to name a few. But again, the IT stocks, the IT index and the overall theme of AI would continue to dominate in terms of sentiment.
Absolutely, Ekta. Thanks so much for that AI theme, IT theme that will dominate the sentiment. Other stocks to watch out for in the trading session today. Let's go across to Gaurav for that list. Good morning, Gaurav.
Well, as we reach the fag end of the result season, we are seeing companies reporting double-digit growth, rather the profit actually doubling. So we have got companies like Hindalco, where the profit has almost doubled, and at the same time margins, they have also increased. But remember, the stock price has already shot up. Other than that, Engineers India, if you look at the profit here, there also we have seen the profit more than doubled for the company on a year-on-year basis. We also have companies who almost double their profit in the likes of Muthoot Finance, where we saw profit increasing almost by 95% on a year-on-year basis. Honasa Consumers, 93% strong growth in terms of profit on a year-on-year basis, and margins also expanded, almost doubled. And at the same time, we also saw Zaggle Prepared, where we saw profit increasing almost by 84% on a year-on-year basis. Along with that, some companies reporting healthy set of numbers in the likes of Indian Hotels, where we saw margins remain stable, but at the same time profit increased almost by 50%. And at the same time, IRCTC, where we saw profit increasing by 15%, but the performance overall was actually good across all the fronts. On the flip side, we have got companies like Biocon, where net profit actually came in a bit below our expectations. Coal India, where we look at the numbers, margins have come down, and at the same time, net profit declined almost by 15%, and IGL, where we saw net profit declining almost by 4% sequentially. So we have got these companies who will react in terms of numbers. Other than that, let's focus on Hindustan Aeronautics. Yesterday we saw numbers, and today company has got a deal worth 2,312 crores for aircrafts. J. Kumar Infra, where we saw company won an order worth 616 crores, and AU Small Finance Bank, where we saw reappointment of MD and CEO. So let's watch out on all these stocks and see how they perform in a day-to-day.
Okay, thank you so much for that, Gaurav. But let's go across to Sudarshan, who's finally here to tell us FNOQs that we're keeping an eye out on. Sud, gap down start, at least is what is indicated today. What are the cues suggesting?
Good morning, Vinny. So Qs have turned very weak, and we are seeing aggressive call writing in the range of 25,900 to 26,000, and that's reflected in your put call ratio. Also, it has slipped to 0.82 from the previous level of 1.06. Even FIs have sold in the index futures, in the stock futures, but maintain the longs exposure around 22%. On the short side, exposure remains around 78%. In the options data on the put side, if you see 25,800 and 25,550 were the most active ones, where the premium has increased. On the call side, 26,000 and 26,150. We have seen maximum increase in the open interest, but the premium has fallen for both. So first support for Nifty would be around 25,700. If we fail to hold that, next support comes around 25,480. That's the 20-day moving average. Resistance will remain around 26,000. Two stocks remain in the bank, Sale and Samant Capital. Keep an eye on all these IT names. Look at the underlying change and the OI percentage change. TCS. Stock has fallen 6%, OI has increased 38%, Persistent, OI increased 15%, LTIM 12%, KPIT 7%, Coforge 5%. And after the weak Qs and the fall in the Nasdaq, IT stocks will remain in the focus today as well.
Absolutely. Thank you so much for that, Sudarshan. But let's move on. And India's January CPI data that as per new inflation series has now come in at 2.75% versus 1.3% in December. This is as per the old series. Now, food inflation has risen by 2.13% after 6 months of falling food CPI as per the old series. Let's go across to Lata, who's here to give us more details on this one. Lata, over to you.
Well, that's right. The inflation number based on the new series has come out, and it's not a very big surprise. At 2.75%, it compares with our poll of 2.89 as per the new series, but it is higher than the old series, which was expected to come in at 2.3%. The surprise really is in food inflation. Food inflation was expected to fall, whether it was the old series or the new series. We were expecting a minus 0.08%, but it's actually come in higher according to the new series at 2.13%. This could be because a different set of items with different weights have been added to the food basket. It's likely that coconuts, copra and coconut oil and tomatoes, the three items which account for three of the sharpest rising prices items, have contributed to the higher food inflation. The other element which is expected on expected lines, personal consumption and other services, that has gone up by 19%, and that is largely because gold and silver jewelry, which are included in this, have risen sharply. A final takeaway, the expectation was that core inflation henceforth will be high. It will be something like 4.7. Core inflation is non-food, non-fuel inflation. But going by the new data, if you derive it, it's likely that core inflation is going to be less than even 4%. So that's the surprise element, and Reserve Bank looks at core inflation very closely. If that's going to be below 4, then the chance of the Reserve Bank moving either ways looks very limited at this point in time. So headline is higher than the old series, but core inflation is lower than expectation, which means the Reserve Bank will unlikely move much from here on, is the economist expectation.
Thank you so much for that, Lata. Now let's listen into what the Secretary of Ministry of Statistics had to say on the new CPI series and its impact.
We have released the numbers for the last 12 months for the entire 2025 of both the old series and the new series. So you have a month-to-month comparison of the old series. And to link it to the previous series, which started in January 2013, we have given a linking factor. And we are following strictly the international norms in this, that the linking factor is given to get an idea of what would have been the changes and how to link the new and the old series. The actual number of 2.75 also reflects the actual prices. Month to month, the prices of different items vary, as would be seen in the details. Prices of a lot of the food items were still in the negative territory. There were some which were in the positive. But I think this time, the inflation numbers have been influenced by some of the personal care and the personal jewelry, which has had a higher inflation.
Okay, on that note, we're going to actually slip into a very short break. After the break, we'll come back with cues from Wall Street. Stay tuned in. Thanks for staying tuned into Power Breakfast on CNBC TV 18. Now, talking about the US market, the stocks fell sharply on Thursday as investors grew concerned about the negative side of the AI build-out. Now, Dow Jones, that shed around 600 points. S&P 500 dropped 1.5%. Nasdaq slipped as much as 2% at close. Let's go across to CNBC. Steve Kovac, who's here to give us a wrap on what happened on Wall Street. Steve?
U.S. markets fell sharply across the major indexes Thursday as the investor fears of an AI disruption hit Wall Street once again. The Dow slid 669 points, the S&P 500 was down 109 points, and the Nasdaq fell 469 points. In a huge blow to climate change regulations, the Trump administration on Thursday revoked the landmark scientific finding that serves as the foundation to limit greenhouse gas emissions and set the standards under the Clean Air Act for cars and trucks, power plants, and fossil fuel facilities. The White House called it the largest deregulatory action in history. Environmental group the Sierra Club says it formalizes climate denialism as official government policy. And sales of previously owned homes had the biggest drop in 4 years last month, despite a dip in mortgage rates recently.
Now, here is some opinion from Roger Ferguson, former Vice Chairman of the Federal Reserve, on the outlook for interest rates.
The economic data does not support an aggressive move down by the Fed. Maybe one more and then done. And three things are occurring. One is the labor market data in general have supported the notion of stability in the labor markets. Chair Powell floated that at the last press conference, and I think the most recent data, unemployment, the U3 coming down to 4.3%. The other broader measures of unemployment also coming down. Job creation, robust, primarily in the private sector, by the way, and that's spreading out.
Okay, now let's move on and get you the latest on Trump-related developments. Starting with the first commentary for today, we had President Trump, who said that the United States has to make a deal with Iran. Otherwise, it would be traumatic for Iran. He wanted and he warned of consequences for Iran if they don't make a fair deal, and thinks an agreement could be struck in the next month. Listen in.
We have to make a deal, otherwise it's going to be very traumatic. Very traumatic. I don't want that to happen, but we have to make a deal. They should have made a deal the first time, and they got Midnight Hammer instead. And this will be very traumatic for Iran if they don't make a deal. Look, if they don't make a deal, then it'll be a different story. But we had a very good meeting yesterday with Bibi Netanyahu, and he understands, but it's ultimately up to me. If the deal isn't a very fair deal and a very good deal with Iran, then it's going to be, I think, a very difficult time for them in the back. I guess over the next month.
Now, moving on, in a post on Truth Social, U.S. President Donald Trump praised a significant change in Venezuela, stating that oil exports are resuming and the U.S. has extraordinary relations with the country's current leadership. The next commentary that came in, he announced that he will meet Chinese President Xi Jinping in April, with Xi expected to actually visit the United States later this year. However, he did not mention the exact date of his travel, so that is still uncertain in terms of when in April. Moving on, Trump has upped his pressure against Israel's President Herzog as he's seeking a pardon for his ally, Prime Minister Benjamin Netanyahu, who is facing bribery charges. He told reporters that Israel Prime Minister has been an extraordinary wartime leader, and he condemned Herzog for failing to offer Netanyahu the pardon which he's asking for. So let's move on. And final commentary that we have, President has said that his administration would revoke the federal government's long-standing scientific finding that greenhouse gas emission endanger human health, describing it as a disastrous Obama-era policy that harmed American industry. The move also scrapped federal tailpipe emission standards for cars and trucks. Maybe, this is going to lead to more in terms of legal matters coming in on this front as well. There are a lot of protests already going on that front, but that's the latest update that we have coming in from President Donald Trump. But on that note, we're going to slip into a very short break. We'll come back with more on commodities on the other side. Thanks for staying tuned into Power Breakfast on CNBC TV 18. Now let's move on and get to the latest update in the world of commodities. We have Manisha Gupta as always to take us through all of that. Good morning, Manisha. Today, what's the one that is going to be seeing most of the moves today, Manisha?
Well, it's a sell-off across asset classes, Vinny, and commodities is not left behind. We're looking at very sharp declines here. So when you look at the gold prices, we are trading below $5,000 an ounce. Silver declined 10% overnight. So we are trading below $80 an ounce for that one as well. This is a third weekly decline for gold and silver both. And this comes on back of the strength in US dollar. The US non-farm payroll data is much better than expected. And the markets are now pricing in a 94% probability of a no Fed rate change in the month of March. And that's weighing onto the markets. But the sell-off in equities, cryptos, metals is all coming in together. Copper, for one, has seen sell-off because of the larger sell-off in other commodities. Also, remember, it is weak demand because China is going for Lunar New Year holidays, and all of next week China is shut. That also seems to be bothering commodities.
Okay, Manisha, thank you so much for that. But with that, we're absolutely out of time on this edition of Power Breakfast. With the Nifty implied open still indicating a gap down start for the Indian market. Don't go anywhere. Bazaar Morning Call is up next to take you through all the market action.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Nigel. Guys, hi. Morning.
Hi, good morning. Once again, AI jitters gripping.
The white is looking very nice, by the way.
I was going to wear green, but then I thought it's a little inappropriate.
Nigel, but white is peace. But what we've seen in overnight markets is some violence, right?
Well,
not peace.
Well, that's right. And guess what, guys? It's Friday the 13th. Right?
Oh,
and I track some of these days very, very closely. Tomorrow's Valentine's Day, and today, you know which day it is?
What is it?
It's Kiss Day.
Oh.
I don't know. The Reema's tech stocks are getting the vampire kiss. But let's see how that goes, Rubia.
Hopefully the rest of the market holds up, right? Like even if IT sells off, we have some strength in the rest too.
Nigel is going to later give us we play out a video. Nigel giving us a demonstration from home. Huh, Nigel? Later? Oh. The day. Okay, all right.
But I'll tell you what, for Valentine's Day, I'll put up something interesting.
Okay, all right. Look forward, Nigel. Let's just take it from the top, right, in terms of where we are as we begin this session. We are laughing, we are smiling, but I guess that is all that you can do because the news on the screen is not good. It's red. And how? So let's just sort of put the graphics up. It's software stocks which continue their slide and sharp corrections. And this is not, a small 2-3% kind of pullbacks. But look at that. Infosys ADR down 10%. I looked at, the software stocks as they were selling off last night at about 10:30, 11 o'clock in the night. Most of the other stocks that you're talking about, right, they all recovered. They're all about 1-2% off the lows where they were trading, but not Infi. Infi actually, if anything, went the other way. Wipro down about 4.5%. Globant, EPAM, Cognizant, Accenture all selling off. So that is the software part of the market which is under pressure. The big tech in the US, which I've put separately also, look at Apple, 5.5% gone. Cisco, 12% lower. The Amazon was down about 2.5%. So it's hitting, and this is just a sample of things which happen in terms of the session overnight. The worries are AI disruption and markets very, unable to figure out how hard will this disruption come, whether it's already here, whether it's 6 months out, 1 year out, and what kind of multiples to give these businesses, because if it's not as if business models are disrupted. These companies are still generating cash, and it's not about now in that sense with IT companies. It is about what will happen, 6 months or 1 year down the line. To my mind, the big question mark is, and it's a real thing, we don't have the answer yet. Think back to 2021, right, when COVID was just sort of, getting over, or at least there was visibility that it's going to get over, and this big boom in IT started. What was the one big buzzword? It was cloud. Investors, the same investors who are selling software like there's no tomorrow, were chasing cloud stocks at 40 times, 50 times earnings and saying, well, cloud's the next best thing. It's here to stay, et cetera, and it's going to forever re-rate IT multiples. Those same guys are now selling IT stocks, software stocks at 10-year, 15-year low multiples. So markets tend to overdo things on both sides. Remember that. And there is blood in the water, no doubt. But there will be opportunities along the way as well as you look forward. Now, with that short bit, last night, US markets, of course, because of the software and the big tech sell-off, S&P down 1.6, NASDAQ down 2%, Russell 2000 down about 2.25%, and worries about AI competition. The 10-year yield basically was everything which rolled over, right? Yields fell 7 basis points, about 4.1%. Is risk off. Oil prices down 2.5% to about 67.64. President Trump saying that he sees Iran talks resolving over the next 1 month. Over the next month, basically, is the exact quote. And then, of course, there was also this other Bloomberg story which was circulating that Russia, there was a memo which was sent out saying that, well, they want to be part of the dollar settlement system and they want to repair relations with the US, etc. Is it a bluff? Is it real? We don't know. But there was a story, nevertheless, which markets kind of took note of. Gold futures down 2.7 this morning as I looked. Silver down 9%, and silver futures are about $80 odd, actually slightly under $80 or so. Bitcoin fell to $65,000 this morning. I checked, about $66,000 or so is where Bitcoin is at. And we use it for nothing but just assessing risk sentiment. In terms of macro data, you had a few things, but I won't go into too much detail. But existing home sales slumped to their lowest levels in September of 2024. You know, software, no software. The thing is, U.S. markets have not had, I mean, they've had corrections, 5-6% corrections, but they've not had a big one for a while. You know, there could be many triggers, but is this something we are looking at and faced with in the US specifically? I'll just leave you with supports. The Nifty, it's the gap zone, 25,450 to 25,640 is the support broadly for the Nifty as we start today. The GIFT Nifty will give you a quick sense of how we're likely to start, and I think the pressure once again, of course, will come from IT services stocks. So what, 130 points lower, 25,726 is the indicative open on GIFT Nifty. Nigel.
Well, according to an internal Kremlin document that was reviewed by Bloomberg overnight, Russia is reportedly considering a shift back to the US dollar. And that strategy is part of an economic reset with the administration of President Donald Trump. So the Russia's potential return to dollar-based settlement system, well, that could put some pressure on precious metals, which we saw overnight. And if it leads to dollar strength, then it will not be very, very great, both for industrial metals and maybe, in fact, for emerging market flows as well. So we'll have to see whether or not there is a lot of meat in this report that came out overnight, because clearly it did have a pressure on gold as well as silver, though they pulled back a little bit this morning. Getting back to the Indian markets, though, yesterday it appeared to be more of a routine profit-taking because the flows were positive from both the institutions, FIs as well as the DIs, mildly so, though. However, on the future space, there were shorts that were added on stocks, while there was not too much activity that we saw from the FIs on index futures. The short positioning, though, continues to remain at around 78% from the FI itself. Remember, that was at around 92% just a month or so ago. But there was some defensive positioning that was taken by FIs on the options space. They wrote close to around 4 calls for every 1 put. And that appears in terms of a strategy, there's a short straddle in place at around the 25,800 level. What's that? You write the call as well as the put of the same strike, which in this case is 25,800. And if you just add the premium, the total premium will be close to around 250 rupees or thereabouts. So they're looking to eat into that premium of around 250 rupees and bracing for a 250-point move on either side, which puts us in a broad 500-point range just in the near term. 25,500 on the downside, and on the upside, it could be at around 26,100 or thereabouts. So just take a look at these levels. The 20 DMA, that's important. You don't want that to get breached on the downside, 25,450. Crucial level of support. The other point that you're looking at is resistance at around the 26,000, 26,100, because that level has got rejected. Well, the worries about AI competition continue to hit software stocks globally. But the next important triggers, I have to name a few. Capgemini's results are due today. Some kind of commentary will be added. Not a big market mover, but commentary is going to be very, very important in the current setup. And Infosys Investor AI Day, that's due next week. That as well will be tracked very, very closely because of the kind of selling that you've seen on these tech stocks. Nifty Bank as well as Reliance Industries, that will have to do the heavy lifting. Remember, for the Nifty Bank, you have the crucial support levels at around the 20 as well as the 50 DMA. So let's see how that goes. Friday the 13th, KISS Day as well. The IT stocks could be under pressure, but I think at some point during the trading session today, we do see a recovery from the lows.
Thank you very much for that. Aditya Bhave, senior US economist at BofA Global Research, is now joining in. Aditya, thank you very much for joining us in. What's the call now on the US economy? Because some believe that at least last year, X of the AI-related spends on capex, data centers, etc., the US economy is fairly okayish, not perhaps supportive of the 50,000 levels that we're seeing on Dow. So would you agree with that view? Is it largely the AI spending which is driving the strength in the GDP numbers, etc.? And what is the impact of what we're seeing on, in the AI, the pace of innovation? How is it impacting the US economy as we look ahead to 2026?
Good morning. Thank you for having me on. So AI definitely has been a big driver of GDP growth, both in terms of AI-related capex and its impact on the equity market, which has supported spending by higher-income households. But we're bullish for next year. We're looking for this year, we're looking for 2.8% GDP growth this year, and we think that'll be driven by fiscal policy that's turning a lot easier. We think the Big Beautiful Bill will add 3 to 0.4% of GDP to GDP this year. Beyond that, monetary policy will also be easier. We'll get the lagged effects of the 75 basis points of rate cuts that the Fed did at the end of last year. And then AI-related capex should also be supportive for growth this year.
So how many rate cuts coming? 1, 2 this year?
We are not convinced that the economy at this point needs any additional rate cuts. We think we're on a path of solid growth, sticky inflation, and obviously the unemployment rate has fallen quite meaningfully the last couple months. That said, you're going to have a new Fed chair that will be pushing for meaningful rate cuts. And so we kind of split the difference in our forecast, and we say with low conviction, you're going to get 2 rate cuts, probably in the summer, maybe a little bit later this year, that should push the terminal Fed funds rate to 3 to 3.25%.
Hi, Aditya. Good morning. Good to see you in. What would that mean for the dollar index then? You know, there were reports overnight that suggested that Russia is doing a bit of a U-turn and going back to dollar-denominated settlements. In addition to that, if we're not going to get as many rate cuts as we thought earlier, then what does it mean for the dollar index? Because that's seen a sharp correction from the recent peak, 110 just around 12, 15 months ago, all the way down to around 97.
Yeah, so a couple of things on that. The first thing I would say is that what we're forecasting in terms of rate cuts is actually quite close to what the markets are pricing. So if that's delivered, I don't necessarily see an impulse lower or higher for the dollar. The other thing to think about is, you know, to the extent that there is a little bit further dollar depreciation, and that's something that's in our FX strategist forecasts, is that nominal dollar depreciation or real dollar depreciation? I think the global economy will be able to digest some additional nominal depreciation in the dollar because inflation might remain somewhat sticky in the US compared to other developed markets. But real dollar depreciation, there's probably some limits on that in terms of, you know, the growth potential of, let's say, Europe in that sort of circumstance.
Do you all have a view on cryptos, what's happening there this year? We've seen a lot of volatility, and even on the precious metals. What is the call?
I don't really have a view on crypto, but in terms of precious metals, particularly gold, what I'd say is what we've seen in the last several months is probably a broad-based growing concern about fiat currencies in the context of elevated deficits across developed markets. So what you're seeing is this debasement of fiat currencies. It's not just necessarily a dollar story, and that's driving commodities higher, particularly gold.
So big picture view, Aditya, what is it? What is it? US stocks, as someone was joking, perhaps the best performing position in 26 could be cash. Do you agree?
The big picture view on the U.S., I would say, is still optimistic, to be honest. The U.S. has weathered pretty large disruptions in the policy agenda over the last several months. We're still going to get significant growth last year, depending on whether you look at the annual number or the fourth quarter over fourth quarter number. You're somewhere between 2.2 and 2.5%. You should get a similar number this year, potentially even higher, closer to 3%. So the economy is doing great. Consumer spending is in good shape. What that means for stocks ultimately depends on your view on valuations, how much of that upside has already been priced in. Our equity strategists have a relatively modest forecast for this year, a little bit above 7,000, but their premise, again, is that the upside that we're expecting in the economy this year was essentially already priced in last year. So I wouldn't necessarily look at that forecast and say this is a forecast that bodes badly for the U.S. economy.
Thank you, Aditya, for joining in and staying up for us. Let's tell us what we've lined up on the show today. The interactions coming up at 8:35. We'll be talking to Vishal Sikka to talk about the AI disruption as it hits sentiment. We'll also speak to Sandeep Agarwal of Sovilo to talk about the sell-off that we're seeing in the Indian IT companies. At 9:05, the management of Senco Gold will discuss the Q3 earnings. 9:20 will be a market master for the day, Pradeep Bhattacharya of Edelweiss. 9:30, Amitabh Chaudhary of Axis Bank straight from the Axis Capital Advantage India Conference. And following that, the management of Glenmark Pharma will be chatting with us at 9:40. Later on, we'll also speak to the management of Muthoot Finance and find out if there is going to be a guidance upgrade. And towards the end of the show, Lata will speak to Dinesh Khara and Nilesh Sathe on RBI strict rules governing mis-selling.
Time to slip in a quick break. We've got a lot of stock-specific action tracked for you today. On the other side, we'll get to that in just a bit. For the time being, I give you a sneak peek. We'll look at Muthoot Finance, Lupin, Indian Hotels, IRCTC, Honasa Consumer. They'll be reacting to positive news flow. On the flip side, Hindalco, Coal India, Biocon, PI Industries, and IGL will be reacting to negative news flow.
Welcome back. Last day of the trading week. While the Nifty IT index is down nearly 7% from Monday to Thursday, the Nifty has held up. It's up close to about 0.5%. But will the resilience in the markets outside of tech continue? We'll find out today. But for now, let's drill it down to CNBC TV 18's list of top stocks for the day. Once again, Nigel, it's yours, Hindalco.
Well, Hindalco India operations, that's the EBITDA number that we track. The aluminium and the Utkal alumina as well as copper, that came in at around 5,660 crores. That's in line. The aluminium upstream EBITDA that was supported by strong operational performance and favorable macros. The EBITDA per ton jumped up by close to around 6%, coming at around $1,570 per ton. And it'll do even better in Q4. The downstream business, well, the extrusion volumes were higher, supported by strong market. The Aditya FRP unit, that ramped up on account of higher shipments as well as better mix. So aluminium, no worries. Copper business was impacted because of lower rod shipments, which reduces, the value-added proposition as a percentage of sales. And that's why the absolute EBITDA number came in at sub 600 crores. Net debt was higher because of higher working capital, rupee depreciation, higher capex, and restoration expenses due to the fire at Oswego. Give and take everything, the debt number has gone up drastically, and there's still uncertainty in Novelis. And added to that, aluminium prices have slipped a little bit, so going with a tinge of red on Hindalco. But Muthoot Finance, that's going to be one of the stocks of the day. Gaurav joins us to help us out with a quick analysis. Hey Gaurav, morning.
Well, as Muthoot Finance, strong performance were expected and company has delivered performance which was actually higher than the street's expectation. So let's look at the numbers first. Net interest income, now that was supported by the NPA reduction. Remember, company has received around 960 crores worth of NPAs reduction in this quarter, and that is the reason why net interest income increased almost by 64%. When it comes to PPOP, that has more than doubled on a year-on-year basis, and same goes for PAT as well. It has increased almost by 95% on a year-on-year basis. Now, what went actually right for the company is that because of all these metrics, we saw net interest margins expanding almost by 11 basis points, and we have also seen some sharp reduction in gross NPAs and net NPAs. Remember, the performance across the metrics have remained above street's expectation. And another key thing, now the show doesn't end here. If you look at AUM growth, it is at around 50% on a year-on-year basis in terms of loan book, and overall AUM also grew at 48%. Let's also not forget about the Bellstar, their MFI portfolio, where they have also shown some kind of profit, and the AUM has grown there as well in the likes of around 2.5% on a sequential basis. And lastly, let's also not forget that management was guiding for 30 to 35% AUM growth, but if we do the calculation, they have already reached that level. So there has to be a guidance uptick here, and yesterday during the con call, they have also ensured that they will be revising their guidance during the media call. Remember, they will be joining us at 9:50. So let's see what management has to say in terms of guidance as well as the growth going ahead. But in terms of numbers, a very great set of numbers delivered by Muthoot Finance for this quarter as well.
Yeah, no, absolutely. Gaurav, thank you very much for that. And strong numbers, maybe a raised guidance when we speak with them meets, of course, a pretty dull-looking market, maybe a bit of a pullback in gold as well. That's a stock yesterday. It's done phenomenally well. IGL is what we want to focus on next. Sonal is here with details on this one. Sonal, morning.
Good morning, Prashant. Well, it was muted volume growth, especially in the CNG segment. Let me take you through the basic numbers first, where revenue was up 1%, EBITDA was up 7% on a quarter-on-quarter basis. Margins did improve to levels of 11.6%, but profits were down by 5% because of higher taxes and lower other income. Overall volume growth was muted at 3% on a YOY basis, and CNG volumes, which is a bigger part of their volumes, was up just 3%, and PNG volumes were up 8%. So going with red on IGL this time.
Thank you. Nigel, it's yours, Coal India.
Yeah, that's right. Coal India going with red on that one because the margins were impacted due to the lower volumes as well as e-auction prices. The offtake number we already had, that was down by close to around 3%. Realizations were down by close to around 2% on a year-on-year basis. So put that together, that's what led to pressure on the top line. Employee cost was higher because of primarily because of the one-off employee cost provision. So that explains why the performance got impacted. The lower performance incentive as well weighed on the numbers. To just break it up, the FSA volume was down by close to around 3% because of lower demand from the power sector, while the e-auction, well, out there, that was down by close to around 5% on a year-on-year basis. That's the realization number that I'm talking about. That's the next plate that should come up for you on the screen. And the e-auction premium to FSA, that's come down to around 62%. That compares with around 76% on a year-on-year basis, but it's a little bit of an improvement from 55% in the previous quarter. The good news is they continue to pay out dividend of around 5 rupees, but the operational performance is a little bit soft, though the street was bracing for that. Expect the stock to open up in the red. Hopping across to Ekta, though, Lupin and Biocon in focus. Ekta, take it away.
Yes, I'll start with Biocon, which is in focus on account of its numbers. So the company recorded a net loss due to an exceptional outflow this time of around 293 odd crores, which was on account of the labor code as well as the BBL share swap cost, etc. But overall, in terms of the revenue, it was up around 9%. The street was anticipating a higher revenue this time. Margins came in line with estimates at 20%, but the profit, like I mentioned, was a slight net loss. Biosimilars, which is 59% of the business, was up 9%. Generics did well, so it was up around 24%, but the street was anticipating maybe a little more in terms of biosimilars. The CRDMO business, which is basically Syngene, we knew that was down around 3% on a year-on-year basis. Call at 9 a.m. today, more details then. But Lupin is one stock that I'm going to be looking at today, considering that it was a very strong set of numbers. The revenue was up around 28%, the margins came in at 31.6%, and the profit was up around 37%. It is the highest ever quarterly sales in the US for them, which came in at $350 million. India was up around 5.6% on a year-on-year basis. Other developed markets did well. It was up around 10.8%. In emerging markets was up over 40%. So really very strong set of numbers for Lupin. I wouldn't be surprised if it's the stock of the day today.
Thank you. It's over to Mangalam now for Indian Hotels.
Well, the hospitality sector has been a bit on an autopilot mode, and it's a steady set which has come in. The third quarter seasonally the strongest. And for Indian Hotels in particular, the net profit has been boosted by the exceptional gain from the Taj GVK stake sale. Remember, the company did that during the quarter itself. 12% revenue growth, 11% EBITDA growth, margins stable at 38%. And an exceptional gain of 275 crores meant that the net profit jumped from 632 crores all the way up to 950 crores. The same store hotels had actually a 9% RevPAR growth, so that's a positive. Management fee income grew by 15%, and there was 31% growth in new businesses. So the Indian Hotels company has actually started to diversify away just from the Taj and look at other sources of revenue, and they are growing extremely fast, so that flywheel is working. And that's where the company believes that this like-for-like growth momentum will continue. Ginger and new businesses will grow over 25% next year. And management fee will also continue to grow in high teens. All of this, along with acquisitions, would mean that next year looks good with a double-digit revenue growth potential. The street's working with mid-single digits, or rather mid-teens, and that's what the brokerages are saying. So see some green on Indian Hotels.
Thank you very much for that. PI Industries numbers look dismal. Revenues are down 28%. Profits have declined. Ria joins in with the numbers. Ria?
Well, yes, very weak quarter for PI Industries this time around, all below estimates. Revenue declines are roughly 28%. EBITDA and net profit also down 41% and 16% respectively. Even the margins have contracted by nearly 500 basis points, which is 22% in this quarter. Now, keep in mind that there was an exceptional gain of 105 crores this time around, which includes a 126 crore one-time exceptional gain from a write-back of excess earn-out provisions after the renegotiated settlement with the erstwhile promoters of the acquired pharma business. And this was partially offset by the new labor code impact of 21 crore of loss. So there was an exceptional gain of 105 crores in this quarter. Apart from this, if you look at the segments, there has been a 32% decline in the agrichem exports, with the volume declining by 29%. Even the pharma revenue contracted by roughly 6% on a year-on-year basis due to deferment of supply schedules to Q4 of FY26. But overall, weak quarter for the company.
Okay, all right. Thanks a lot for that. Ria, going back to Mangalam. Mangalam, tell us about IRCTC as well as Honasa.
Well, IRCTC is a steady set, no problems out there. If you look at the revenues, up 18%, EBITDA up 12%, margins at around 32%, and the net profit is higher by 15% on account of a 10 crore exceptional gain, led by both their ticketing businesses, which is about 13% in revenue growth and 14% in EBITDA growth, and tourism business, which actually on a smaller base grew 30% on the revenue, and the operating performance grew by 50%. But importantly for Honasa, this has been the result of the season so far as well, and I expect it to be the stock of the day. Why do I say that? Because the revenues have grown 16%, but look at the EBITDA, 151% jump out there. All the operating leverage play that was being spoken about has actually now shown up in the numbers. The 92% jump in the net profit. If you account for the exceptional, actually it's a much higher jump. So if you look at the EBITDA margin trend as well, over the last 4 or 5 quarters, it's been improving now in double digits. So that's a positive. And it all is on account of leveraging ad spends, which have come down from 34% to 31% of the sales. Their internals looking extremely strong as well. Volume growth of 30%. The stock's still below issue price. I see it doing extremely well in today's trading session.
Thank you very much for that. Yesterday as well, stock was up nearly 2.5%. Honasa Consumer, strong numbers. Here's a quick recap then of the top stocks. Stocks with positive news flow are Muthoot Finance, Lupin, Indian Hotels, IRCTC, Honasa Consumer stocks with negative news flow are Hindalco, Coal India, Biocon, PI Industry and IGO. Well, today it's a split. 5-5. 5 positive stocks, 5 negative stocks. But Manisha is now joining in for all the action from the world of commodities. Manisha, hi.
Hi, morning. Thank you for that. Well, it's a complete sell-off when you look at commodities in the overnight market there. Gold fell 3%. It's trading below $5,000 an ounce. Silver prices fell more than 10% overnight. Not just that we've fallen below $80, but $75 was also tested at one point in time. And then you have platinum down 6%, palladium fell 4.5%. Almost everything in metals is trading on the weaker side, including copper as well. The larger sell-off in commodities seems to be bothering this space as well. Well, you're looking at strong US dollar, the U.S. non-farm payroll data coming in better than expected, and markets now pricing in a 94% probability of no rate change in the month of March from Fed. The U.S. inflation data comes in today, and that is where the next cues would come in from. But at this point in time, whether it's copper, aluminum, zinc, even crude oil prices, crypto, all of that trading in the negative and headed for a weekly decline as well.
Got it. Okay, all right. Thanks a lot for that, Manisha. Well, time to slip in a short break. On the other side, we'll be connecting with Mr. Vishal Sikka as AI disruption fears hit sentiment. Stay tuned for that exclusive conversation.
Hello and welcome to this special program. The recent very sharp sell-off in software stocks reflects a rapid shift in investor sentiment rather than a sudden deterioration in fundamentals. The IT index has sold off about 14% here in India in the last 7 trading sessions. The sell-off began in global software names, US-based companies like Cognizant, Accenture, Globant, EPAM, etc., which have also sold off really hard. Over the past several weeks, announcements around new agent orchestration platforms, Claude Cowork, OpenAI's Frontier, have created a powerful narrative that horizontal AI layers will coordinate company workflows, enterprise workflows, automate complex tasks, and ultimately capture a disproportionate share of software budgets. That's the basic core worry here. The concern is that if AI agents become the primary interface for executing work, traditional platforms could be relegated to kind of passive data stores with pricing power and strategic relevance migrating elsewhere. That narrative has contributed to aggressive multiple, that is P multiple compression across software companies, often with little regard for differences in business model, end markets, or actual AI execution. And add to the barrage of articles on social media platforms telling us how the world as we know it has ended. Well, too dramatic? I think so too. But one thing is absolutely clear. Things are changing. The pace of change is perhaps the only question. My guest today is a rare full-stack visionary in the world of technology. Dr. Vishal Sikka doesn't need an introduction. He's not just an observer of the AI revolution. He helped build some of the foundations of this revolution, which is at our doorsteps today. From, of course, pioneering the SAP HANA in-memory platform to serving as the first non-founder CEO of Infosys, he spent his career preparing the enterprise world for the so-called timeless software era. He's, of course, now the founder and CEO of Vianai Systems, where he's solving the hallucination problem for the world's largest companies. Dr. Sikka, thank you very much for joining us here on the program. Really appreciate your time here.
It's a pleasure, Prashant.
Sorry for that long preamble, sir. Let me get straight to it.
No, it's okay.
You ran one of the largest IT services companies in India. Given what is happening in the US and all these technologies, is the Indian IT services business model prepared for this?
I think if you look at the application of generative AI to knowledge work, this disruption is real, it is here. In a broad strokes, you could say that all kinds of repetitive, knowledge work that we do can now be done using generative AI a lot more productively. But at the same time, we have to keep in mind a few important things. So in principle, that message is clear. It is real. This disruption is here. Like you said, it is on our doorsteps. But we have to keep in mind a few additional things. First of all, things are always slower than we expect. Adoption takes time. Enterprises are very complex. They are like countries. Large companies are like civilizations. Some of them have been around for hundreds of years, if not decades. I'll give you an example of Waymo, for example. In 2006, at Stanford, we had built a car which drove autonomously and won the DARPA Autonomous Driving Challenge. That was in 2006. That was 20 years ago. Sebastian Thrun, a dear friend of mine, built that. And now we have Waymo. Last year, Waymo did 15 million rides, but 15 million rides is less than 1% of all the taxi-type rides just in the US. So it takes a long time and even in terms of autonomy, there is a lot of still advancements to happen. Similarly, in the services industry, there are dozens of service lines. AI's impact on those service lines is not all uniform. It is not, doesn't happen overnight to all of them. Some systems are much more complex than others. And so the rate of change is always as slow as the slowest pipe in the network. So we have to keep those things in mind as well. But having said that, I used to say this 10 years ago, 9 years ago, whenever that was. And it is here now. And we have a short window of time in which to sort of transform.
Dr. Sikka, what has changed in the last 4 to 5 weeks, if I can put it that way, which is so dramatically different? Is something dramatically different? Because, I mean, AI is not new. We've been talking about it, but it seems like the pace has accelerated in the last 2 weeks. Is that correct?
It is. It is correct. The acceleration has been happening. Back in 2014, when I had started at Infosys, AlexNet had a couple of years before, AlexNet had beaten human performance on computer vision on ImageNet. And from that time onwards, transformers came around in 2017, 2018, and then the big models started to come. The ChatGPT was 3 years or so, 3.5 years ago. So there has been a continuous improvement. About 8 or 9 months ago, we saw the first reasoning models, O1, and then shortly after that, O3. And then one of the things that the big frontier model companies have done is integrated tools into the models. So within the chain of reasoning, they integrate tools. That's why software development becomes that much more powerful, is because tools like the shell, Python interpreters and compilers and other verification tools are all built inside the models themselves. And so that makes them much more powerful at creating correct code. And now, Anthropic launched this co-work thing, and Google has launched a bunch of things. Yesterday, Isomorphic launched a dramatically better approach towards the pharmaceutical drug discovery area. So yeah, there is no doubt that the pace of change is accelerating.
Pace of change. So there are these plugins, right, which you're talking about, the Anthropic, which happened, I think, last Tuesday, last week. I mean, basically, the general assumption is that Indian IT companies will integrate all this AI technology into an enterprise workflow, etc. So is that argument now on shaky ground? Because as you were saying, there are these plugins. But the pushback to even that is, well, you need plugins to plug in plugins, if I can put it that way, right? So that's my question. I mean, is the integration aspect of Indian IT there? What's your sense?
I think the prescriptive kinds of work, if a particular project or a particular service line is about work that can be repeated, that can be prescribed, such that people can be asked to do this, they can be trained to do this work. This kind of work can much more easily be done, using AI. This is already possible today, including complex kinds of transformation work, moving programs from one system to another, migrating, and things like that. A lot of this kind of integration work, writing code, glue code to connect systems and things like that, this can all be done much more easily using software, using AI. Can it be done 100% autonomously already? No, absolutely not. But people who know what they are doing can definitely see dramatic productivity improvement. So one could say that the gain in productivity because of using generative AI can be quite substantial.
Yeah.
At the same time, if people don't know the power of generative AI, if they don't have the fundamentals, they don't see that much gain from generative AI. So this is what Melanie Mitchell, who is one of the researchers in AI, called it the jagged frontier, that certain tasks, because of the nature of the task, don't see that much productivity gain. Certain people don't see that much productivity gain. And I was talking to a friend of mine who is he was a student with me at Stanford, and he's a genius. He rebuilt a site that earlier had been done by 15 people over 9 months. He rebuilt it himself in 14 days. So that's more than 100 times productivity improvement. I have seen examples of 20, 30x productivity gain and things like that. The important thing, Prashant, is that do we want to keep looking backwards? Do we want to keep looking at tasks that we already do? And do we want to limit ourselves to what we did in the past? Do we want to be afraid of the disruption and automation to the things that we did so far that brought us here? Or do we want to look at the opportunities of what are the new things that I can do with what we have in our hands? And I think, I focus much more on the latter. I have a small company, and life is a lot more interesting when you think about, my God, we have this incredible ability. What can I do with it? And I think when I look at it from that lens, it is incredibly exciting.
Dr. Sikka, sorry, this is we can have such an expansive conversation, but for now, we will have that. But I'm kind of bringing you back to some of those particulars.
And I will be in Delhi next week, for the AI summit.
And we can have that. We can have that expansive conversation then. I mean, if you have time, and hope to see you there, Dr. Sikka. So, if, as you said, productivity goes up this much, which means effort falls, right? 10x, 20x. So, which means what then? I mean, as for Indian IT services companies which are servicing US clients, US clients will see, right? I mean, you're using this and effort is now down this much. Is this deflationary in a big way on pricing? IT companies we speak to here in India so far have held out saying that it's not deflationary. So far, we've not seen that. What's your sense?
I think we have to separate the potential, the promise, if you will, of this disruption from how it impacts in the here and now. In the here and now, you have particular projects that people are executing on, and if a client expects that you now do this project dramatically faster or cheaper or with less people or whatever, then that would impact the here and now. But that is something that takes time. That's what I meant by depending on the service line, depending on the nature of the work, depending on the team that is involved, and things like that. So there is the fear in general of the potential of what this can do to knowledge work. But then there is the actual reality of creating an enterprise-ready offering that uses these new capabilities to deliver those. So there is a gap between them, and that gap, some of these services, there might be companies already offering new kinds of ways of doing the same services. And then, of course, you have much cheaper, much better alternatives available in legal services and many other areas. There are companies like that already. But then there are others where it might, take years for these new kinds of offerings to show up. So how much a particular services company is impacted by AI depends on how many of their service lines are being impacted by use of these or by alternate offerings that are much better than what they are doing or what the client's expectation is. I do see clients asking for discounts and all of that. There was a famous example of a large audit company that was asking for an AI discount on its own audits and so on. There was a report that I read about that. So there is that expectation that there is some productivity gain that is being baked into what you offer. But we have always dealt with that. So in other words, what I'm trying to say is, I'm sorry, it is not a simple black and white answer. In some cases, it might be something that people expect to happen today. In some cases, it might take years before you can deliver a transformed new kind of a service. And you have to see individual companies where they are at in that spectrum of disruption.
Welcome back. We just heard such an interesting conversation with Vishal Sikka. He's a visionary technologist. And the key takeaway is that there's no doubt the disruption is here. The gain to productivity on account of generative AI can be substantial. But you also need to separate the potential of AI from the here and now, because enterprises are complex and, in a way, slow to adopt technology. Sandeep Agarwal, fund manager at Sovilo Investment Managers, is also joining in. Sandeep, with Vishal Sikka, Prashant's conversation was more about the business impact. But what's happening right now is also a massive amount of valuation derating and the fear that the projected earnings may not come through. Even the EPS will get crunched. What is your own expectation of where the valuations are today for large caps, mid caps, and what is the appropriate valuation when there is so much uncertainty?
So, hi, thanks for having me on the show. So, Rima, I have a very clear view that, there are two different impacts. One is the business model and one is the market cap and the EPS and the valuation. So, since last 16, 18 months, I have been massively negative on the valuation and the multiple which asset managers and fund managers and analysts are assigning. I don't have any big doubt on the business model at all. So, I think that business model is intact. There is not much change because the nature of our business is such. So if you see the current cycle, hardware cycle has come back after more than 2 decades. So that is doing phenomenal. And the worst impact is on the software side because you have to reprice. It is an annual renewal kind of product. And the least impact will be on the software services. So we are in the software services where the impacts will be least. The only challenge is most of our projects are 5 years. So every year 20% come for renewal and you will see a 20% cut in the effort. So basically it doesn't make commercial sense to go preempt that. So every year when renewal comes, the management will renegotiate. So you will see a 4-5% negative impact on overall revenue for a few years. But at the same time, you will get 8-9%, 10% kind of new business growth. So net, you will be 4-5% growth for 2-3 years. And for that, the multiples which are there, I am very, very skeptic to assign that kind of multiple. So my call for last 15-16 months in every interaction is on the valuation of the sector and the market cap, not on the business model. So I am not negative on the business model, nor I have a view that there'll be a cascading impact on the employment and there'll be a cascading impact on real estate and all that. So I am not in that camp, but I definitely believe there is a lot more PD rating which is still due.
So for an industry which is growing at 4-5%, what is the appropriate valuation multiple, Sandeep? And how far away from it currently?
So Rima, I am not an analyst anymore, but if you recall in 2021, when, there was so much of pain, I wrote during peak of COVID, most bullish in a decade note. And it was primarily because of the things which were changing. Now, if I would have been analyst last year, I would have written most bearish in a decade. And the reason was that time also valuation and now also valuation. So I would say that, a PEG ratio of more than 2 times for an industry which has 5-6% growth for long is little high. And a PEG ratio of more than 3 times for mid caps, which can grow at 10-12% is also high. So I would be more comfortable to give a 20-25% premium to utility companies because of the good management, because of the huge cash generating capacity and all that. So I will assign, maybe 12-13 times, 10-15 times multiple somewhere in between to large caps and maybe 15-20 times to mid cap. But I would be very skeptical to give any more multiple beyond that because this is a mature industry. So more or less large caps are X of growth, to be honest.
But if, so large caps today are trading at what, 18-20 times?
Yeah, so they are, depending on the estimates, if you see Bloom numbers, they are 18-20 times. I think there is still more correction, which should happen there.
But if the valuation multiple, the derating has to come down to say a 13 times, 14 times, we're still looking at a 30% correction from here on. I mean, can it get as steep as that? Or do you think at some point, because these are dividend-paying companies, there is free cash flow yield, etc., at that point it'll start looking attractive?
So, the only thing which can change from here in this is that, at some point of time, it may happen that the asset managers decide that, okay, we are getting similar growth in some of the FMCG names. So, switch those FMCG names with 1/3 the multiple or 1/2 the multiple for IT. If that happens, then probably the bleeding will stop. But otherwise, I think large cap still minimum 20% correction should happen to make them reasonable and investable.
And mid caps?
Mid cap, I'm very negative. I think 40-50% correction is coming. Still 40-50% correction, I believe, should happen, and or the growth should pick up. But it is very difficult for the growth to pick up from here. In my view, we have at least 12 months more before growth can pick up.
Thank you, Sandeep. A short conversation, but a real punchy one. brace yourself for a lot of sell-off coming through in IT names, 20% maybe for large caps, 40-50% for the mid caps as valuations get realigned to lower growth and a lot of uncertainty.
Some bulls will be happy that Sandeep is not an analyst any longer. All right. Well, I'll tell you what, we've gone on a bit about techs. Let's slip into a short break. We'll shift focus to the management of Senco Gold on the other side. We'll also get you some technical trades. Stay with us. Welcome back. This is Open Exchange, and we are coming to you live from the CNBC TV 18 Motilal Oswal studio. Well, we're going to be getting pre-open rates in just a bit, but for the time being, let's welcome our technical experts. We have Sudeep Shah, who's joining in, as well as Mitesh Thakkar. Good morning, gentlemen. It's going to be an interesting day ahead of Valentine's Day, Friday the 13th. Gift Nifty suggesting a 150-point downtick. Mitesh, you go first. Yesterday, we ended virtually at the low point of the day. Last couple of days, we have seen mild pressure. At around 25,500, 25,600, do you believe risk-reward, Mitesh, would be favorable, or would you stay away?
Good morning, Nel. And yes, I think, we talked about targets of 26,000 and 26,300, but kind of reversed from the first level. And Yes, I was looking at charts and said that the first pivot is around 25,800, but in a bad case scenario, we might even test 25,650, 600. So I think that's the zone which I'll watch very closely. We are likely to open just above that zone, and around 25, 650, 600 levels, I would be inclined to fish for some long positions on the index. A lot of moving averages on the 2-hourly charts and the daily charts are placed in that zone. So the idea is that there is a strong possibility of a bounce back, and close to 25, 650, the risk reward equation for a long trade also is favorable. You can take about 70, 80 point kind of a risk and play for around 200, 250 point kind of a bounce back. So in that sense, the initial feeling is that post the gap down, in case we see some more supply and see the Nifty trade close to about 25, 650, 620, I think that's the area when I would look for a reversal sign.
Got it. Okay. All right. So at lower levels, maybe a contra trade could be in the offing. Got that. Sudeep, how are you feeling this morning?
Good morning, Nigel. Nigel, the entire AI saga, which is leading to all these IT stocks plummeting, I feel now it could come to some kind of lower levels stabilizing. And my sense is that we might not see an accelerated fall in the IT stocks in the coming week. So somewhere these stocks are approaching oversold zones and may start consolidating here. So from that context, I feel that Bank Nifty or the financial stocks could continue outperforming. And what could happen is that Nifty could take support closer to 25,500, 25,550 mark in any eventuality of excess fall today. Post opening. So 25,500, 25,550 would be that zone where I would like to accumulate long positions with 25,400 stop loss and play for a reversal towards 25,800, 25,900 levels.
Okay, all right. Contra buys coming in there from both our technical experts. So that 25,500 mark appears to be very, very important. Mitesh, what about individual stock calls?
On individual stock side, Nigel, I have a mix of buys and sells today. On the buying side is Nykaa. Post the numbers, the stock had a fresh breakout, and because of the market movement, it could give a pullback. So around 277, 276, which is about 3.5, 4 rupees lower. Look for long positions with a stop at 270 for a first target of 290. A sell on Nuvama with a stop at about 1335 for targets of 1250 can be looked at. Also a buy on Tata Power, again, on a mild decline, it's around 376, buy with a stop at 368 for a target of roughly around 393 on the upside. And KFintech, that's an IT name, and IT has been one of the most underperforming sector in the last 1 week. KFintech is a sell with a stop at 1,005 for targets of 940.
Sudeep, hi, good morning. What are you going with in terms of individual stocks?
Good morning, Rima. Rima, two stocks on my radar. One is L&T. Now, if the IT stocks are opening lower and we might see some pullback from the banking, it might even need help of L&T also from an index management perspective. And L&T has closed at its highest level yesterday. So it has even crossed and sustained above the January 2026 peak. So what I feel is now here, from here on, in case of any declines towards 4160, 4170, one should accumulate long positions here with a stop at 4120. The potential targets on the upside would be closer to 4280, 4330 levels. The second stock that is there on my radar is Bajaj Finance. Here also yesterday we had seen a breakout above 980 levels. The stock has closed stronger. And last several times, every time it was approaching 980, 990, there was selling pressure. But yesterday it has successfully closed above that zone. So I feel Bajaj Finance also needs to be watched out for. And this can be added on declines towards 995, 990 levels with a 970 stop loss. The targets here would be 1040 and 1070.
Thank you, gentlemen. We'll reconnect with you. For now, let's invite the management of Senco Gold and Diamonds. Very strong Q3 numbers. The company's top line went up by 50%. There was a margin expansion to more than 13.2% with profits of 264 crores. Suvankar Sen, MD and CEO, Senco Gold and Diamonds, is now joining in. Mr. Sen, thank you very much for joining in. What was the buyer? What was the volume growth in Q3? And can you give an indication of how Q4 has been, the first half of it?
See, the volume growth that we have seen in Q3 has been around a negative of 3 to 4%. And in terms of diamonds, we have seen a volume growth of about 10%. So when the gold prices have gone up, we've seen that the consumers are trying to, buy gold, buy silver, buy diamonds. But it's not fitting into their budget. As a result, we're seeing a little bit of a pressure on the volumes. But in terms of value, we've seen that with the gold prices being record high, we've seen an amazing growth of about 50% all in all for the Q3.
And Q4, what is the indication? What if there is no price growth? Prices remain where they are and buyers, the volume growth continues to remain under pressure, flattish or negative. What kind of growth should we expect in Q4? What are you going to end the year with?
So I think that, we've already been in the midway of Q4 and the prices are, more or less stable. So we are seeing about a value growth of 25 to 30%. So I think that, people are getting adjusted to the higher gold prices. Volumes overall are under pressure, but as a company and as a brand, we are continuously focusing on creating newer designs, making jewelry which is fitting into the budget, looking at lighter weight jewelry weights, and also 9 carat, 14 carat jewelry, which makes the overall price of the product lower. So these are the strategic ways in which we are trying to make up for the higher gold prices.
Okay, but you do see 25 to 30% kind of growth in Q4. Can you quantify the inventory gains on the unhedged gold in Q3 and what should we expect in Q4?
So see, I've been saying that, in this high gold price volatility, we've tried to balance between liquidity and the managing of risk, having a very prudent hedging policy, and we've kept our hedging ratios in about 55 to 60%. So in Q3, especially with where we get the highest ever sales. So if we look at the last 3-4 years performance, usually the Q3 gives us an EBITDA of about anything ranging between 9.5 to 10.5%. Our this particular Q3's EBITDA has been about 13.2%. So you can attribute about 2.5 to 3% due to the lower hedging and the gold price increase. Remaining 9.5 to 10.5% that we see from the business. We've seen higher sales in diamond jewelry. We have our company-owned, company-operated stores selling more than the franchisees, which is adding to the margin. Overall, we have seen that, the offers and the schemes that we've been running, in spite of giving a discount, because the gold prices have gone up, the making charge percentage overall has stayed the same, but in absolute numbers, that has helped the company to grow. So all in all, I think that about 2.5 and 3% is what we can see, given because of the higher gold price.
And how much does silver account for in your sales in terms of unhedged gains?
Silver overall in the business, see, we've done about 6,400 crores of turnover, but silver is about 1 to 1.5% of overall sales. So that would not really add a lot to the overall, profitability. Maybe 2-3 crores here and there, but that's about it.
You also acquired a 68% stake in Melora. This, I think, close to about 68 crores was the outgo. You also have presence in luxury leather, lab-grown diamonds via Sense. What is the contribution of the non-jewelry business and in Q3 as of now, and how much will that inch up to?
The non-jewelry business is still with a very long-term strategic focus that we are building on. We've been always a brand on jewelry, but if we look at the evolving consumer market, the modern generation, the Gen Z millennial customer base, for them, jewelry is an accessory, and we need to come up with various products so that we fit into their lifestyle, their thinking, giving them an option to buy, to gift. So that is the way in which we are looking at these various options of leather, perfumes. And if you look at the numbers, it's still very low. We are building the network, we are spreading ourselves, but it would be much lower than 1%. Lab-grown diamonds, again, as a complementary aspect to the studded diamond jewelry that we have. I think that it has a great future. Gradually, it will keep growing more and more. And as far as the Melora aspect is concerned, again, we can say that we are an 88-year-old brand with a strong legacy and trust. But how do we continue to make new designs, connect with the young generation? And it is with that strategic focus that we have, acquired the stake in that company. And I think that with the digital omni-channel aspect of it, in the future, it will play a very strong role in acquiring new customers and growing the companies in the young generation base.
Your studded ratio was 10.9%, I think, in Q3. How much does that number go up to, say, by the end of FY27?
See, our aim is that in the coming year, we should look at about 12.5 to 13% in the studded ratio. I've been saying for the last 2-3 years that our aim is that 15% should be the overall studded ratio. Yes, in the last 2 years, the gold prices have moved up so much that in spite of the growth in diamond jewelry sales, the studded ratio continues to remain at about 11. So once the prices stabilize, consumers get used to it, I think that we should look at about 12.5 to 13%.
Thank you, Sivankar, for joining in. Always great chatting with you. That is Senco Gold. For now, the value growth continues to remain very intact, 25 to 30%. That's the guidance. Volumes, though, in Q3 have declined by 3 to 4%, at least on the gold side. Mitesh is now back with us for a few 9-10 calls. Mitesh?
Well, I think very clearly the market is opening with weak kind of gap down. So while, as I said, we'll be looking at buying at lower levels, for the timing, I'll go with a sell on Nuvama for targets of around 1250.
Sell Nuvama, target price 1250. Let's just get the pre-open rates in. They've settled. It's more than a 200-point fall coming in. 200-point fall coming through on the Nifty. The Nifty closer to sub 25,600. Sensex down about 780 points. The problem is IT. The IT index sold off 5.5% yesterday, and this morning in pre-open also down another 5%, with names like TCS, Infosys, HCL Tech down 5 to 6%. Let's just quickly get in some more stocks that we should put the spotlight on. Vinny is now joining in with more on the earnings.
Hi, morning. So yes, first talk about Tega Industries. Q3 numbers very weak this time. Execution seems to be a bit of a concern because revenue is down 1.3%. Profits are down 63% as well. And margins seeing a sharp decline, 11.5% versus 22.2%. But margin obviously seeing an impact of that acquisition that they've made. So cost of that is coming in, labor cost impact, that is there as well. And obviously margins are actually continuing to be below that FY26 guidance that they've given of 22 to 23%. So that is something important to track. Zaggle Prepaid, when you look at the numbers, good numbers coming from the company, revenue growth of 56%, mainly led by the growth that one has seen in program fees as well as in gift card. That has done well for the company. Profits of the company 84% up at 36 crores, as well as in terms of margin. The management has reiterated that EBITDA margin of 10 to 11%, as well as their growth guidance of 40 to 45% for FY26. Engineers India, that is another one. Strong revenue growth that the company has seen this time. 58% revenue growth, the good growth, doubling in terms of profits of the company, margin sharp improvement as well. Now, do not forget, there was a turnkey project contract pricing which had changed. And because of that, we're seeing a very sharp increase in terms of revenues, margins. All of that is mainly aided by that. But even if you remove that, an X of that, the numbers are still very good, beating the estimates. A strong performance from them as well. HCC, the company has reported a profit this time versus a loss last year, as well as EBITDA profit this time versus an EBITDA loss. HCC has also secured a 577 crore railway contract JV in that JV. So that is the reason that we could see some up move here. Travel food services, good numbers from the company, good growth in revenues, and operationally also better performance versus last year.
Yeah. Vinny, thank you very much for that. Well, Mangalam is here now with Honasa, which is in focus. Mangalam, morning.
A stellar set coming in for Honasa. A 16% revenue growth, but if you account for one of the settlements that they've done with Flipkart, the revenue growth is actually 21%. Management guidance also positive. 151% jump in their EBITDA, which implies margins doubling, and the net profit as well, from 26 crores gone all the way up to 50 crores. The stock below its issue price still. So, the street is fairly sanguine about the prospects of the company going forward, especially given these numbers and the numbers of the last 3 quarters with the management guidance. Let's see how it goes. It's opened or settled higher in pre-open. We've seen underlying volume growth of 30%. Some of the key components of the business, Mamaearth itself has grown upwards of 25%. We've seen a good growth in their Dermaco business as well, double-digit EBITDA, and the younger brands have grown by over 25%. The management has increased their offline distribution, which has been one of the triggers of the company. So all these factors point in the north for Honasa. Let's see how it performs.
All right, we've got market open coming up on your screens at this point. And I think straight off the bat, a lot of the focus is going to be on IT services stocks and IT index. Well, what do we have? It's another 1% cut, near 1% cut, 25,600. Nifty Bank is at about 60,550. The Sensex is down about 3/4. The small cap index is down about 1%. The mid cap index will come up on your screen. That is down about 1% as well. The Nifty IT index, if you can put that up at a high level, look at the top-down view. and then we look at stocks. There's another 5% cut. I mean, if we go home and close this week out, this Friday with a 5%, it's going to be a historic 10% rout on the IT space in 2 sessions flat. Who would have thought, right? Just an incredible state of affairs. Look at the stocks at the bottom of the screen. You've got Infy, TCS, HCL Tech, Wipro, Tech Mahindra, and that's just the large cap space, right? TCS is the other one. But look at, Coforge, LTI Mindtree, Tata Elxsi, KPIT, Zensar, Birlasoft. Lots of these names that we'll keep putting them up on the screen and highlighting some of these. They're all there at the bottom. Muthoot is down about 7.5%. That is Muthoot Finance. So that's a sharp correction on Muthoot as things stand. Well, that is a screen, right? So you got about 40 names which are lower and about 10 names which are higher. SBI is easier to count what's up. SBI Life, Eternal, and Max Health are up. And everything else is down and out. 225 points lower on the Nifty. Rima.
Well, outside of IT, Hindalco is the big loser today, 4.5% lower. Numbers are largely in line, but the stock has had a fantastic run, 53%. So analysts perhaps are waiting for a better entry point. And plus, debt has gone up. So that is a bit of concern. ONGC slipped nearly 2.5%. Couple of auto names in reverse gear, M&M, Tata Motors. Coal India also under pressure, 1.5%. Very few places to hide. SBI Life, Bharti Airtel, Max Healthcare are holding up in the green. But again, the gains here are very modest. In terms of the midcap action, the midcap index is down over 1%. The stock which stands out today is Engineers India Limited, 12% up in a very weak market. Strong numbers on a year-on-year basis. The company's top line has gone up by 58%. We've seen the profits go up by more than 200%. I think there is an exceptional, but even if you adjust for that, EIL is clearly the stock of the day on the way up, 12.5% large volumes. Honasa is another one. Mangalam was telling us about it. It's now approaching the issue price of 325. The stock today, after the run-up, is at 310, so still below the IPO price of 324, but getting there. Lenskart sees buying for the second consecutive day. Yesterday, it was clearly the stock of the day. Strong numbers, and today it's seen follow-on buying, 2.5%. The market capitalization of Lenskart is now in excess of 91,000 crore rupees. Bharat Forge hit a fresh record high yesterday on strong numbers. Again, seeing some buying. Hindustan Aeronautics, Urban Company, Biocon up and about in trade. On the way down, a lot of these ETFs are weak in trade. HDFC Silver ETF, Growth Silver ETF, SBI, Nippon. We've seen silver prices come down by 10% overnight. And I think it's the third consecutive weekly loss for silver prices. So that's putting pressure. Muthoot Finance, 10% down on that. Numbers look fine, right, for Muthoot Finance, but the stock is taking a big knock. Tega, which Vinny was telling us about, under pressure. PI Industries, also numbers very disappointing here. Stock is weak in trade. Indian Hotels, 3% down. Cohance Life, 6% lower. The screen is red and the advanced decline ratio is just getting worse. We've got about one stock advancing for 6 stocks, which are declining. Nearly 2,000 stocks, Prashant, now in the red.
Yeah, no, absolutely. It's a red screen, right? Trideep Bhattacharya is with us, so let's bring him in. 190 points lower on the index. Trideep, CIO Equities at Edelweiss AMC. Trideep, good morning. Good to have you with us here. Not underplaying AI at all. And those who've followed me know that I won't underplay the impact of AI disruption, etc. But it's a historic route, right? The IT index, with a 5% cut today, is down 10 in the last 2 days. And we would be down, I think, some 18% in the last 8 days, today included. Markets overdo things, both optimism and pessimism. You would agree, Trideep, right? So what's your sense here on software stocks to begin with?
So my sense is that AI will clearly transform not only tech, but all other businesses. But markets in the near term are fairly emotional sort of animals from that standpoint. So in that context, we have been we have a technology fund, and where over the last couple of years, the positioning that we have been running is we have about 20-30% overweight on US tech and meaningfully underweight on India tech. So from the perspective of that, we are actually looking to see when this pessimism gets overdone in the near term. I think valuation multiples are coming to a level where AI concerns included there would still be time to buy these names. In the near term, we could see a bit of a pain, though, in terms of valuation multiples, because they are just about 10-15% below long-term average multiples. So in the near term, can the valuation multiples go a little further south? They can. But if you take a 1 to 2 year view, the stock sooner than later will get into interesting levels where one could look to sort of nibble in rather than trying to go fresh underweight from here.
But you believe the turning point is 1 to 2 years away? It gets to interesting levels still more than 12 months away.
No, I think Trilip is saying that the business impact, impact is 1 to 2 years away.
Yeah.
I'm just paraphrasing you, but given the pace of the sell-off, stocks can get to interesting levels pretty quickly. Is that what you're saying, Sudeep?
That's exactly what I meant. That, generally in the near term, the emotional nature of the markets makes it take down far bigger than what the actual impact is. Right. Likewise. So, for example, in the entire last year, India, absent US deal and not being the global favorite, went through a bit of a kind of rough patch. From there, after the signing of the deal, in my opinion, India should have globally do better, and currency should stabilize. So likewise, kind of these are the times when you get interesting levels in markets to sort of put money to work. Having said that, the result season that we saw overall, if you look at in aggregate, hasn't been that bad. The numbers would see a marginal upgrade coming through. This will be the second quarter in a row. I'm talking about Nifty 50 as an aggregate, where you would see some two earnings upgrades coming through. We have the US deal, we have the EU deal all signed in. That should put a bit of a sort of a lower lid to the currency. So incrementally for India, in the context of global markets, we are moving in the right direction.
Just one more question, Trideep, on IT, and then we'll talk about the other sectors. So we get a lot of questions, right, that I already hold IT stocks in my portfolio, large caps, mid caps. What should I do with them? Should I continue to hold on, or can I exit now also and then perhaps pivot to other sectors where I could see some more in terms of share returns? What's the advice?
So that's why I said if you have a view of about 1 or 2 years, then certainly this is not the time to exit. If the view is near term, next 1 or 2 months maybe, that's a short-term view. The markets could go either way. I'm not particularly an expert on that, but the valuations overall, sooner than later at this pace, will get to a level where we could get a mid-teens kind of closer to a high teens kind of a multiple, which very few times in history Indian IT has gone to. So it'll be interesting times to look at the sector from a buying perspective, not selling.
Okay, hi Trideep, good morning, good to see you in. What about gold? It was glittering for quite a bit, and some of those gold finances actually did very, very well. And some of the stocks as well have done well, case in point being a Titan. Now the problem is gold has gone up by such a fast clip that sustaining at these levels is going to be interesting. And, because of a bit of a downtick that we have seen in a stock like Muthoot Finance overnight, the stock now is down when the numbers didn't appear that bad. Your view on gold finances and on gold as an asset class?
So I think gold as an asset class or precious metals as an asset class is more, should be part of asset allocation for investors. I think given the rally that we have seen in precious metals, like I said, in IT, sooner than later, it'll get to interesting level to get in. In gold and silver or precious metals, the next trade, maybe over the next few months, is probably to lower down the weightage rather than kind of increase weightage from here. One can't time exactly. But I would say that a lot of optimism in the long-term charts is reflected in the prices already. That doesn't take away the fact that in the near term, both of these can go up. But the next trade is to lighten up rather than kind of load up at current levels, would be the way I would put it.
You said the earnings season was good. Second consecutive quarter of earnings upgrades. What are you buying post the earnings season?
So, what we have bought is what I can say. In the last couple of months, we've increased our weightage in financial services. What we note is one of the things that's happening in the economy is the credit growth is bottoming out. We think the credit growth, which was in around about March, April 24 at about 15 to 20%, came down to about 6 to 7% in September, October last year. And we think it's going back up to roughly about 13 to 15% in the next 6 to 12 months. We have been talking about it for the last couple of months. If you look at one of the leading banks, private sector, public sector banks, which reported in the last few days, they talked about a similar kind of a growth rate that's now a data point in that favor. So when credit growth rebounds overall, the sector as a whole does well. Some parts more better than that of others. So broadly, we have been adding to financials and select pockets within consumers.
Yeah. By the way, we've got the Muthoot management joining us in just a bit. Trideep, Nimesh points out that let's put the stock up. Nimesh is pointing out that the one concern which the street is pointing out that there is, I think there is no tonnage growth, right? Which basically means that you're not putting in more volume of gold to borrow money. I mean, the LTV goes down as prices go up, so you were able to borrow against the same value of gold. But it's not a new thing. We know this, and this has been true, I think, for about 15 months or so, 15, 16 months, maybe more. Any thoughts on this one, the gold finance space?
I think gold and gold-related companies have seen a tremendous amount of value growth-driven growth. And market over the last couple of quarters or even longer have responded to that. And that's the reason the share price has done of some of these gold financiers pretty good. So in that context, even though the numbers of gold financiers were expected to be good and they came quite well, there is a bit of, I would say, profit-taking more than any incremental concern, given how well it has done. And as I said, some of these, we are sort of in markets getting to those levels where the trades are done on one end and the anti-consensus nature kicks in. Overall leading to profit-taking. So I would say more of profit-taking rather than any fresh concern from what I'm aware on some of the gold financiers and anything else.
Absolutely. And I think it's an important point that you make. Trideep, are you actively buying, selling? Are you kind of sort of, as many have put it, right, just step back and watching where things settle and fall? With those, of course, with a lot of IT stocks, and we've spoken to a few of them over the last few sessions, have had to, of course, readjust quickly. But otherwise, I mean, beyond that, is it a holding pattern kind of a market? What's your sense?
No, we have been nibbling. It's not. We have added to. When I said we've added to stocks within financials, we think some of the public sector banks which have sort of come off in the correction overall, we've sort of added on to. We've all added on to select mid-tier private sector banks as well, because we think there could be things turning around there. So within financials, those are the two sub-segments that we have added on to. Within consumption, we think that some of the numbers which are on the QSR space, the results that have come about are interestingly positive in the direction. So post the GST reforms, while majority of the impact we saw in autos, we think it's gradually spreading to other areas. We're evaluating that space overall. So those are the two spots where we are kind of, on the hunting ground. And the area that we are sort of lightening is somewhere where things have been quite well, particularly in the non-ferrous side, is something that we have probably of late taken some profits.
Yeah. Trideep, we'll leave it there. Thank you very much for joining us. It's a good chat. Appreciate your time here on CNBC TV 18 and look forward to speaking to you again soon. Maybe just take a quick look at where things are landing as far as individual stocks are concerned while we wait for Amitabh Chaudhary, who should be with us in just a short bit from now. The Access Conference, of course, I mean, great attendance and lots of insights, as Nimesh has been pointing out from there. So 25,585 is where the index is at right now. Nigel?
Well, just take a look at some of these stocks, the way they're moving up. EIL stock is up 13%. We're talking about a market that's down close to around 200 points. Nifty, Midcap index all struggling. GE Power, that stock continues to run along. In this week itself, post its numbers, the stock is up close to 30%. So clearly the street is taking note of some, positive results and rewarding it out there. So these companies, they're up close to 8 to around 12% in a market that's actually down. On Muthoot, it's interesting. Yes, the tonnage is a little bit softish, But the valuations as well got a little bit expensive. And it appears, at least for now, there is some profit taking that we're seeing on that name. Stock down close to around 10% or thereabouts. But on the tech space, the index has recovered 1.5% from the day's low, maybe a bit of a dead cat bounce, but after the kind of selling that we've seen, the low of the day was around 31,400. So that's seen a small bounce in the low.
This is which one? This is the
IT index.
Yeah, the IT index, yeah. You know, and this is the point, Nigel and Rima. If you remember 2021, right? I remember that vividly because I was in office every day, and it used to be an empty office, right? It used to be, and you also started coming in. I think it was you, me, and Lata who were in office, and IT was absolutely re-rated, right? Exploded. And back then the big theme was cloud, right? And remember, interest rates had fallen to zero. So the assumption was that rates will remain at zero forever, and cloud is going to forever re-rate IT stocks, and people were buying IT stocks kind of, hand over feet. There was huge run and 40, 50 times P multiple. So the point is that markets tend to overdo things on both sides, optimism and pessimism. And I think we are at one absolute end of the spectrum in that sense. Vishal Sikka, just 30, 40 minutes back, I think the interesting line was the gap between the potential of AI and what AI can do for enterprises now is very large right now. Markets, of course, are forward pricing mechanisms. In that sense, we are seeing that sell-off. But at some point, I think there will be some amount of interest. At least stop falling first before we talk about maybe what looks interesting, what, where, etc. Axis Bank reported a strong set of third quarter numbers. Bank going forward aims to grow 300 basis points faster than the industry. We have Amitabh Chaudhary, MD and CEO at Axis Bank, joining in. 3 talking points, right? Loan growth engine in place now? Question mark. Net interest margins bottomed out in third quarter? Question mark. Inorganic growth opportunities going forward. Amitabh, great to have you with us here. Thank you very much for joining us. Prashant this side. Just a quick kind of sort of feedback on the conference, if I can start with that question. Huge attendance and as always, lots of participation from foreigners. Are they going to walk the talk with checkbooks as well? What's the feedback?
So firstly, Prashant, thanks a lot for having me on your show. You talked about the conference. This has been Axis Capital's largest conference to date with close to 1,000 investor attendees, 170 participating corporates and 190 CXOs. FPI participation was notably strong, not just in scale, but in quality. We saw some senior folks and EM heads come here. I think Indian market did not do well last year. Now I see a revival of interest in India. Obviously, they will spend their time in researching ideas and seeing where they need to invest. But there was a clear intent to engage deeply and identify some of these ideas. Corporate sentiment, since you asked about that, remained positive. Most companies reported a strong, obviously they had a pretty good quarter, but they also reported a strong January, building on healthy momentum seen since December.
Yeah.
So one of the senses one got was that post-December 15th, something seems to have changed. So let's see whether this momentum continues or sustains itself.
Neelkant was with us and Atul were in the studios. And I think they've also been making that point that maybe things are picking up, right? And it'll show up in numbers eventually. Amitabh, and now allow me to ask you this question. I have to. We reported some time back that you are potentially going to be making a bid for Credit Access Grameen. It's perhaps the highest quality MFI. And can you confirm that for us? Are you looking at it seriously?
Media is trying to ensure that we do this deal somehow. I don't know, and there have been newspaper articles and other articles otherwise. I will refer you back to what we have said. These are unsubstantiated comments and baseless rumors. It is incumbent upon us to definitely evaluate every opportunity that comes our way as an institution. And we will obviously evaluate this opportunity also, but we are in very, very early stages of that evaluation. We have not even decided whether we'll take the next step. And for media to speculate that something is going to happen tomorrow, day after, 1 month, 2 months, is too early. Our mind we have not been even applied in the early stages of this transaction. So it's all baseless, is all I will say.
Yeah, no, I get that. No, we didn't say it's going to happen today, tomorrow, or anything. We just said, well, potentially you're looking at it. That's all we said. And we were the first ones to break that story.
I saw some valuation also in one of the news reports.
That is just the promoter holding as a percentage of the total market cap. That's it. There's not very much science to it in that sense. But you're not, which means that you're not averse to MFI as a business, right? I mean, you know, it's perhaps some would say it's a bit of it plays out in cycles. Few good years, then it kind of sort of goes, things get overdone on the other side, then goes into a slump.
Sitting here and saying that.
Yeah.
So there is a lag in, I think, somehow the communications.
Yes.
Sorry about interrupting you. But no, I mean, MFI is an important business. We've been building that business for quite some time. We have been trying to see how we can transform the business internally. Here, the question is whether you want to spend a chunk of money to buy a business from outside with all the, accompanying execution risks, or you want to build it internally. And that's a choice we will make at the right time. We are not in a hurry, absolutely. And right now, we have enough things to focus on. So it's not that we are, just dying to do an M&A transaction for the sake of doing it.
Thank you very much for joining in, Mr. Chaudhary. This is Rima here. The belief is that the credit growth in the system has bottomed out and it's improving from here on. So say 1 year, 18 months down the line, what can be the credit growth that the industry sees? And can you do better than that? What is your own internal projection for Axis Bank?
So, well, at the start of financial year 26, we decided to focus on growing NII rather than NIMs, as NII directly in our mind contributes to our ROE. So we have been growing faster than industry over the last 2 quarters, and our platform, we believe, allows us to grow at rates faster this year than the industry. And we have consistently been giving guidance that we believe Axis Bank has the platform to go at 300 basis points higher than industry on a sustained basis. Now, it might not happen quarter to quarter, but definitely in the medium to long term, defined as 3 to 5 years, we can achieve that. In the last couple of quarters, the growth has come from wholesale banking side, based on stronger client engagement and materially faster turnaround times. We are in front of our clients more often than before, and sharper focus on obviously return on metrics also. So we have continued to kind of build on this foundation which we have created. MSME has always been a strength for us, and that continues to deliver strong results. Retail has been especially on the asset side, is a bit slow, but just to give you some data, in quarter 3 financial 26, our retail disbursements are up 20% year on year and 12% quarter on quarter. So after a couple of quarters lag, we do believe that it should start reflecting in our AUMs also. Credit growth, all the economists seem to be predicting that the credit growth in the financial services industry should start hitting 13 to 15% on a sustained basis. My only concern with that argument is that the deposit growth has to be similar. Right now, the deposit growth remains tepid or tough in the marketplace. RBI has very rightly talked about durable liquidity, but we have not seen that durability because of interventions in the FX market. So once this durable liquidity returns and is delivered, once credit growth also picks up, hopefully we'll feed it back in terms of deposit growth. The both need to converge, and we can hopefully look forward to 13 to 15% credit growth in the next 1 or 2 years. If India to deliver the GDP everyone is talking about, we will need that kind of credit growth. I mean, ultimately, all of them are related. So if we believe that GDP growth will be delivered, and I very strongly, I'm of the view that the government is very, very focused on delivering that growth. I think working along with the regulators, they will ensure that the right kind of signals are given so that the credit growth is also delivered.
All right. Hi, Mr. Chaudhary. Good to see you in, sir. The last time around we heard about Axis Bank going for some shopping was Spandana Spurti. At that point of time, it didn't result into a marriage. But this time around, it appears there is some interest. So we'll see whether or not there's a deal that ultimately takes place. We'll keep that aside for now. Let's talk about your operational performance itself.
I just want to clarify. I have not shown any interest. I want to clarify, I have not shown any interest. I'm just saying, like every deal, we will evaluate this deal also, and it's right now in very, very early stages of the evaluation. We have not made up our mind yet.
Let's set that aside then. We've taken that on board. Let's focus on the operational performance. You highlighted a fair bit with regard to loan growth as well as deposit growth. In the past, you've said NIMs could probably be basing out in quarter 4 of this fiscal or quarter 1 of next fiscal. But now there are expectations with regard to a couple of more rate cuts. Could you maintain NIMs at around these levels? And do you believe it's based out?
So I do believe that the rate cut cycle is done. Based at least on our economist forecast, we believe that, India does not need another round of rate cuts. Yes, inflations are benign, but inflation has been benign, but that does not mean that we go for another rate cut at this stage. And frankly, the commentary from even the Monetary Policy Committee does not seem to indicate that the rate cut is in the offing very soon. But at the same time, because the liquidity has not been reliable. You have seen in the marketplace on the incremental side that the deposit rates remain high, while we have had to pass, the rate cuts or reverse repo cuts done by RBI to the customers, with a very small lag. So in that sense, this quarter has not started well, but we are hoping that it will stabilize in the next couple of quarters. Yes, we have seen, in my mind, based on at least I'm commenting on Axis, we have seen a phase or in this quarter or the next where the NIMs will have definitely bottomed out, and hopefully from there on, they will start improving. I'm not trying to say that it will happen this quarter or next quarter, because I think they'll be giving guidance. But I'm just saying that in spite of what we see in the marketplace today, hopefully things will settle down and NIMs will start moving up, because the rate cuts have already happened as far as asset pricing is concerned, as far as liabilities pricing is concerned. We are hoping it will stabilize and trend down a little bit. So that will obviously impact your NIMs. In our case, the ratio of retail assets in the overall scheme of things should also improve as our disbursements go up. That also helps your NIMs. So I'm hoping that in the next 1 or 2 quarters, you will start, at least as far as Axis is concerned, seeing NIMs moving in the right direction.
Amitabh, I can tell you lots of investors are saying that 26 is going to be the big one for Axis Bank as a transformational year. It's going to really, you kind of sort of share that belief, and as head of the organization? Lots of things coming together in that sense.
Well, we strive every year. We strive every year to ensure that it's the best year for Axis. This year is going to be no different. But yes, I do agree that a lot of things which we've been doing in the last couple of years have not fallen in place, are slowly, gradually falling in place. We are trying to play the long game here. And again, the strong belief is that if you keep playing the long game the right way, with customer focus, end of the day, you will start winning more in the marketplace than some of the others. Now, this will happen this year, next year, only time will tell. But our focus is to ensure that this franchise keeps going from strength to strength. And that discipline, that intent, and that ambition has not changed.
More questions, Amitabh, as always for you, and I hope you will come back and not make this a rare occurrence. But we're out of time here. We're in the earnings treadmill, so lots of management lined up there. Thank you very much for being here and part of the program.
Thank you so much, Prashant. Always a pleasure to talk to all of you.
Thank you. Thank you very much.
Thank you so much, Prashant. Thank you.
We'll take a quick break. We are back and we connect with the management of Glenmark Pharma on the third quarter numbers on the other side. Stay tuned.
Welcome back. Markets down, but our next corporate is already ready. So let's go across to Mr. Anurag Mantri, Executive Director and Global CFO at Glenmark Pharma. Hi, Mr. Mantri. Good morning. Good to see you in new role in new company. So congratulations on that. We have spoken in the past on stainless steel, and we know the kind of work you did with JSL Stainless. So wish you all the best for your stint at Glenmark Pharma.
Thank you, Nigel.
That said, we've got a few pointers now to focus on. Top of mind will be the India-US trade deal that was announced. It mentioned that the US is still examining the pharma sector under Section 232. How do you look at this, if you could give us an idea? And also your US revenues, I think they were at around $93 million for the past quarter. somewhat subdued. What's the outlook for the next few quarters?
So Nigel, on this 232, I think it's too early to speculate at this stage the impact. But if you see from our business model perspective, typically US, Europe, and emerging market contributes almost equal sort of revenue in our business mix. So almost every geography contribute 20 to 22% in our business mix. So we actually continue to strengthen our business model so that we remain insulated and mitigate some of these geopolitical or the policy-related risk in any geographies. So that's that will continue on this. US revenue on Q3 was a bit subdued because we had a unprecedented challenges because we shifted our warehouse in that quarter. But now going forward, we have a good lineup of the new products launches. We are expecting fluent approval in any time soon. So with that, we should see a good growth coming in the US market.
Do you have a number in terms of the US pipeline, the kind of growth we'll see in Q4 FY27?
Rima, it's difficult to get the number, but I think it will be better than what we have been expecting in Q3. As I said, Q3 was more because of some of our operational challenges due to warehouse shift. And with new launches coming up, we see a good growth coming in US in coming quarter.
Anurag, there was a search and seizure operations undertaken by the GST department from the 27th of January to the 31st of Jan. Have you heard back from the GST? Any update or comment on this?
So it was in a routine course, and as we informed the stock exchange, there is no material financial impact on this. We provided all the information to them.
Okay. And on AbbVie, have you received the full upfront payment of $700 million?
Yes, we got the entire upfront payment from AbbVie with us, and income booking, as we mentioned, we are doing a matching principal income booking. So we booked $525 million in Q2 and $17.5 million are being booked every quarter now onwards.
Okay, so you had planned to repay 600 crore of debt by March and become debt-free. That is on track.
So yes, so we are on track to become our gross debt zero. But in terms of our net cash, we are still significantly positive net cash as on today also.
All right, what about the allocation? Debt repayment is one part of it. The remainder of the cash that you'll be getting, how will you allocate it? R&D spends, if you could throw some color on that for the coming years?
So we have a very disciplined R&D spend approach now, and we will continue to invest in cutting-edge R&D pipeline through IGI. So what we have said is that around $70 million will go into R&D spends annually. And we are also correspondingly booking the similar sort of revenues from every deal which we have got on a matching principal basis. So that helps us to actually insulate our P&L from that aberrations. And besides that, we will continue to do a strong strategic partnerships through in-licensing deal, like we have recently done the 2 deals, one with Hengui and one with Henso. So we will continue to do that, and we'll also, as a Glenmark, as a strategy, we'll continue to invest strongly in our organic growth. So that will continue. That's what the broadly capital allocation for 9 to 12 months will be.
Okay, all right. So tell us then, what does the growth pipeline look like getting into FY27 and also margins? I think you're guiding for 100-150 basis points improvement from here on. So what are the levels in store?
So, Nigel, FY27, we are guiding for margin for our core business close to 23%. And we have a good pipeline. So India, if I go by market, I think India is a very strong franchise. We continue to outperform the market. We launched GFB NAB, then Trimembra, Brukinsa, we introduced in the market. So there are enough new products in the market which we launched. So India will continue to grow 10 to 15% for us. US, as I said, we have a good launches lined up. Plus Monroe also getting cleared from FDA, which is also positive. So we started the commercial production. So it should also start contributing slowly into the P&L. And also, if you see Europe, we have a Winlevi. We launched Winlevi in UK, and we are expecting to be launched now. This will be launched in a larger EU market. Then relatives continues to do well for us in that, and emerging market continues to drive our strong growth for us. So I think all across the market we are seeing a good traction.
Sir, on ISB 2001, which has been out-licensed to AbbVie, what is the current development status? What are going to be the next key clinical or regulatory milestones? Because there is a potential of $1.2 billion in terms of milestone payments. So what are the triggers that investors should track over the next 12 to 18 months?
So ISB 2001 right now is in a phase 1B study. So dose expansion is ongoing. It's progressing well. I think what we have seen is that investors should track the further readout, regulatory interactions, and development milestones in that. So all $1.2 billion has a three sort of milestone, which is include development, regulatory milestone, and the sales related milestones. So as we said that we will be and partners will be publishing the data. I think investors should track that data. We can't say much beyond this at this stage.
Okay, all right, Mr. Mantri, appreciate you joining in. Wishing you all the best, and we look forward to more such conversations in the future. Thanks for joining in. Well, let's move to Muthoot Finance. That's the next management on the show. They actually reported a pretty good set of numbers. Maybe the expectations were higher than what they have delivered. To discuss this, the growth guidance ahead is the revision on the cards. We're joined by Mr. George Alexander Muthoot, the MD of Muthoot Finance. Hi, sir. Good morning. Always good to have you on the show, sir. And the street is keenly looking forward to this conversation. Now, with the current AUM growth, your steady guidance, you had given earlier was, I think, guidance of around 30-35% AUM growth, which was given for FY26. But the street wants to know, what is the new guidance, sir? Could you spell it out? What is the range you're looking at?
Yeah, thank you, and good morning to you. This quarter, the first 3 quarters have been good growth. We've seen in the last 3-4 quarters have been quite good. We have already grown the gold loan AUM by 36%. I feel that we should be able to do around 45% by the end of the year. We should reach that by 45% by end of the year. So that is, I think, something which we plan to achieve.
The revised guidance is 45%, right, sir?
Yeah, something like that. Yes, yes.
That is, Mr. Muthoot, hi, morning. So FY26 growth will be 45%. That's the number?
Yeah.
Okay, roundabout there. Could be higher also.
Can be.
No, absolutely. So we'll put that out, sir. And I think that is a number which markets were awaiting as well. Sir, the stock is down 10-11%. I mean, sometimes because it's done so phenomenally well, the stock. I mean, it could be routine profit booking. The overall color today is a bit reddish. But one point which some analysts have highlighted is the tonnage thing. That tonnage, I think is flat to slightly, it's a bit of a degrowth. You want to sort of address that? I thought that was a thing last 1.5 years as well, that tonnage was not growing.
See, I think you should understand the business of gold loan. The gold loan is actually the average tenure of a gold loan is 3 to 4 months only. So the total portfolio gets churned every 3 to 4 months. So every 3 to 4 months, new customers come, old customers go out. What happens is, take the case of an existing customer who had taken about 2 lakhs of rupees 4 months back, 6 months back. Here I have to give 4 chains or 4 bangles for that. Today, if he wants the same amount, after 3 months, he's taking a new loan, or somebody else is taking a new loan. He need not give the 4 bangles. He need to give only 3 bangles because the price has gone up. So I can't ask him to give all the 4 bangles. He would rather give 3 bangles and keep one to himself. So I think as the price increases or the LTV goes up, the tonnage has to come down. Having said that, today, if you look at the price of gold today and the amount lent by us, the LTV is only 57%. So there is always headroom, more money to be given, but people take money only what they really need.
Yeah. That is quite significant.
The tonnage is dependent on the gold price. I can't ask customers to bring more money when even with the lesser gold, they can get the same amount.
Yeah, so you're saying two things, and you explained it beautifully. Tonnage being flat is a function of the tenure of loans, of course. Also, gold prices go up, and that's exactly what I said before you joined. We had somebody from the markets with us that LTV is dropping, and LTV is now 57%. You're saying?
Yeah, 57%. Today's price, LTV on the loan we have given or the loan outstanding is only 57%.
Yeah. And this is despite the 12-13% pullback in gold prices that we've seen, right, from the highs.
Yeah, I think those highs were just, what should I say, is too simply a hike. That's all. 5,500 of gold price. I don't think it remained there for more than few days.
Yeah, but Mr. Muthoot, there's a general belief that gold prices, once they go up, I mean, they don't. And they may seem very high, but they don't come down. I mean, I don't know, you're in the business of lending against gold, but let me ask you that question about gold itself, because that is a central commodity here. What is your own view, if you have a view?
Anyway, first of all, I have to say that I'm not a commodity financier. I'm an ornament and household ornaments financier. But of course, gold is very much relevant to us. I also feel that there can be some small corrections, but gold price will stay elevated. That is my general belief.
What about on NPA recoveries? 960 crore of NPA recoveries in Q3. What's the number we should expect in Q4?
So the NPA recovery is because people have again the churn. The price have gone up. Probably some of them would have taken the loan, taken back the gold, and probably sold it also. Not sure. Anyway, when the price is so high, some of them may think that why not keep it there? I will release it. And there are so many shops here who are saying, I will buy old gold, etc. So that must be So NPA, as I said, it doesn't translate into any loan loss. In fact, when the NPA gets cleared this month, the NPA got closed about 800 crores or 900 crores of NPAs churned, and we realized very good interest on that. The full interest we realized. It's a good amount. That is one of the reasons why our yield went up.
So we understand AUM growth. You explained the tonnage growth, but what about customer growth? That has also been flattish sequentially.
The customer growth, new customers are coming. Old customers are also. So we have about 4 lakh plus customers coming every quarter, and that is continuing. As you said, it is flat. Yes, people are coming. People are coming with more gold also. So we see new customers coming. We see old customers going away also. Probably they may go to another financier or banker, or they may actually dispose the gold also.
So just to clarify that LTV point, that's the average LTV, sir, 57%?
Yeah, average LTV.
Okay.
Yeah.
But what about LTV for customers who came in, came in now, I mean last quarter?
Yeah. You mean the incremental. Incremental people generally take about 69 to 70% average. Today, if I give, some people take 75, some people take 60, some people take 65. On an average, today's price, the LTV would be maybe 69 to 70%. That's all.
Okay, that is also an important number. So incremental LTV is 69 to 70%. Got that. Thank you.
All right. Mr. Muthoot, I wanted to ask you, what about the yields? In the past, I think you've said 18 to 18.5% you believe it can hold out. But there's intense competition that's coming in there. So do you think there's a risk on the yields because of competition? And also I wanted to ask you about the cost of funds. That's not moderated, but the systematic rates itself are down. Why is that?
See, there is a lot of rates which are coming down. But the final transmission happens to us through the MCLR. The MCLR of banks have not really come down in proportion to the repo rate reduction. Repo rate would have come down by 50 basis points, but the MCLR has not come down. There's a big lag. Today, the lag is more than two quarters and more. So the bank lending to NBFCs, they have not really transmitted that rate reduction to us. They have transmitted the rate reduction to the individual lenders, probably a home loan, a personal loan, or a vehicle loan, etc. But to the big companies like us, to corporates like us, the rates have really not come down. But having said that, we actually maintain our yield and spread. We continue our yield and spread. We continue with that. If the rates come down, we pass on the rate benefit as to the customers. If the borrowing rate goes up, we transmit that to the customer. So we try to protect our yield, our spread and NIM.
Okay, all right. Final couple of questions, sir, from my end. Belstar, it's returned back to profitability. You had indicated about that. So which quarter are we bracing for that listing? Will it be in 2026 itself? And also on branch opening, now the regulatory hassle has been cleared. How are you looking at branch openings in the coming year? 2 points are Belstar and branches. Please go ahead.
Belstar is, I think, it had a profit portfolio of about 10,000 crores. Now it has come down or maybe moderated to about 8,000, little around 8,000 or 7,900 to 8,000. That is what it is remaining there. But we are quite cautious and calibrated in the new loans. And the new loans, the collection is extremely excellent. So the legacy loans, most of it has been written off and the provisions have been made. That is why this quarter it is showing a profit of about 50 crores. But the first 2 quarters was a loss. So probably Belstar in the end of the year may come with flat or maybe wipe off the losses which they had earlier. But going forward, definitely will be a calibrated growth and only very, very carefully calibrated.
So when are you ringing the bell at the BSE or the NSE, sir? When are you listing it?
Sir, today we don't need extra funds there. So when the growth is there, extra funds are there, we will list it. There is one more thing. Belstar has got a permission, or rather there is a dispensation to do 40% of the AUM in gold, and they have started branches in gold. They have already about 100 branches of gold loan branches. They are planning to branch more. Probably the non-MFI portfolio will be dominated by gold in the next 1-2 years. So we want to make it a little more stronger with collateralized lending and non-collateralized lending. Your second question was about the branch opening. See, in branch opening, every NBFC who wanted to start gold loan could open a branch without getting an RBI's prior approval. But an NBFC with more than 1,000 branches, probably 3 or 4 or 5 or so, had to go to the Reserve Bank and get permission, since we are a bigger company with more than 1,000 branches. So this is really a little unfair on our side. So we had been telling that to the Reserve Bank of India. And now they have actually dispensed with that provision, saying that even bigger companies like Muthoot and others with 1,000 branches gold loan can open branches without getting RBI's prior note. But of course, it is only a draft stage. I'm sure generally the draft regulations come as regulations. But having said that, just because the branch regulation has been changed, we are not going to open 1,000 branches. We open 100, 150 branches a year. Probably it will go about 250 branches plus, because we don't need a prior permission. That's all. It's not that we are going to open 1,000 and 2,000 branches all over the country. It's not
Mr.
but
Muthoot.
Can I have one more minute?
Please, sir.
The more important thing is definitely the sentiment of gold loan with the regulator and the finance ministry. They are very positive about gold loan. I feel that they are convinced that gold loan is the way to put purchasing power in the hands of people. Because secured loans, etc., are difficult to come by. Microfinance loans are very difficult. All sorts of unsecured business loans are also difficult. So the one method is monetizing the gold, which I think the Reserve Bank and the Finance Ministry has realized in the recent many instructions which have come from there. It is positive. And definitely, this also shows the comfort of the regulator in the large gold loan NBFCs by giving them the permission to open branches without this. I see more of this not as a number game, but as something which is again more about the confidence of the gold loan sector in the real growth of the economy and the acceptance of the ministry and the Reserve Bank on this aspect. I think I'm very happy with that.
Yeah. Mr. Muthoot, I had one more question, but I'll save it for the next time you're on, sir. Out of time, thank you very much for joining us. And absolutely, I mean, I think regulatory comfort and confidence in gold loans as a product for credit transmission, certainly very, very strong. Thank you for joining us, sir. Appreciate it. Time for a quick commercial break here. On the other side, Manisha is going to be with us with a quick focus on commodities, which is top of mind. Stay tuned.
Welcome back. It's not just equities which are down in trade. Even metals are selling off very sharply. Manisha is now joining in to tell us more. Manisha.
Oh, yes. Overnight was a deluge. It wasn't just about equities, but commodities, crypto, everything saw a very, very sharp decline. In the Asian markets, you might be looking at some buying coming back for gold and silver. It's trading in the positive right now, but still below that very important key psychological level of $5,000 per ounce has been broken on the lower side. So gold fell 3% in overnight markets and silver fell 10% overnight, trades below $80 an ounce even right now. So we did see a range of around 84.5 on the higher side to 73 on the lower side in the overnight markets yesterday, just about holding 77 on your screens there. This is a third weekly decline that silver is putting on right now. Well, there are a couple of reasons for this sell-off. One, the US dollar has strengthened back yet again. The other is the US non-farm payroll data came in much better than what the street was anticipating. The unemployment number has seen a decline. So while the labor market is resilient, the markets believe that there is now a nearly 94% of a chance that the US Fed will not change rates in March, but it might actually not happen in June as well, might go to July. So that is what seems to be bothering many of these commodities. And then it's not just gold and silver. Take a look at the base metal prices. They have seen a decline as well. So copper has seen a sell-off because of the larger sell-off that we saw in the market. Overnight was 3% of a decline, as has been the case with other metals. There's a bit of an opportunity buying that we are seeing in Asia right now. The Chinese new home prices have declined the most in 7 months. That is putting pressure. And then remember, China is going for Lunar New Year holidays all of next week, so there's not going to be much buying. And then we also have seen copper inventories in major exchanges continue to gain up. So when you look at the LME stocks, they are the highest since the month of May. Take a look at the Shanghai stocks. They are the highest since the month of March last year. And it is the COMEX inventories, which are at a record high of around 535,000 tons. So when you put all of these three major exchanges in the global markets and put the global inventories together, that stands at a 990,000. It's a 2003-year high, and the markets are looking at a lot of pressure anticipated going forward because of that. While there is a demand expectation, but most of that is on paper right now. The potential demand is what took the copper prices to all-time high of $14,500 a ton. Right now, it's trading at $12,800. And then there's a Goldman Sachs report as well saying that last year as well, copper was in surplus of around 600,000 tons. So all of these numbers together are expected to put pressure on prices, so much so that most of the banks and brokerages are now telling you to sell copper on every uptick there. What the street will watch out now is the US inflation data and further cues coming in from that.
Okay, Manisha, thank you very much for that. We will take a quick commercial break here. A special segment is the economy. Lata in conversation with Dinesh Khara and Nilesh Sathe on RBI's strict rules governing mis-selling, especially third-party products. Stay tuned.
Hello and welcome to It's the Economy. On Wednesday, Reserve Bank announced a bunch of strict rules governing how banks will sell financial products like insurance or pensions. Not only are banks forbidden from coercive selling, tying to a customer, to a loan customer, forcing him to buy an insurance when she wants, just to open a savings account or take a loan. Banks also have to assess if the product they are selling is suitable to the consumer. Like you can't sell a life insurance product to a person who's over 60 years old and perhaps who's not earning. So will the strict new rules impact banks' fee income? Also, will the sales volumes of insurance and pensions companies dwindle because of these stricter rules? I have with me two stalwarts, Mr. Dinesh Khara, former chairman, State Bank of India, and Mr. Nilesh Sathe, who was formerly with the IRDA, so a regulator and the chairman of the biggest bank. Gentlemen, thank you very much indeed for your time. Let me first start with the stock market question, Mr. Khara. Will this mean a loss of revenue? Because when a loan was being tied up with an insurance product, the banks were getting a small slice of that premium as a third-party fee. So will this mean a loss of money for banks, and which banks could be affected?
Well, Lata, when you talk about the loss of income for the bank, yes, when it comes to, the cross-selling income or the CV income, which we call it, normally insurance would be comprising about 20 to about 30%, depending upon which bank it is. But yes, of course, so it is actually not prohibiting as it is, but it is only saying that the right practices should be followed by the banks when it comes to selling the third-party products or the insurance products, and there should not be any bundling. So essentially, what it really calls for is that there should be right assessment of the product, showcasing the product, and if at all it's not a mis-selling, if it is a right selling, then there is no restriction per se. So I think to that extent, yes, of course, when it comes to the insurance income, distribution income for the banks, when it comes to their other income, maybe it will be comprising about 20 to 25% or so. But yes, of course, not every penny will go away. But yes, of course, it is only ensuring that it should be the right selling. And when I say so, I must also mention...
How much of that 20 to 30% could be these kinds? I mean, there will be genuine insurance policies also that a bank will sell. And then there will be these bundled products. So out of that 20 to 30%, how much may be bundled income?
I think I would say that when it comes to larger banks, they had already started practicing in the manner that there should not be any bundling. Okay. So what was actually happening was that at the same time, it was also being insisted upon there should be right profiling of the customer and showcasing the product with the value proposition to the customer. Yeah. So I think many things have happened for last couple of years. And many of the right practices have already been followed by the banks. But yes, of course, now with this kind of a norm which is being prescribed by RBI, it actually goes a step further. It also says that if at all there are any exceptions, then once the mis-selling has been established, it is premium need to be refunded. Yes. Whatever income has been made, that has to be refunded, and on the top of it, it can have impact on the license also. So I think this kind of a guideline has gone a step further in terms of the implications which should be there if at all these policies are not put in place and practiced on ground.
Got it, sir. Let me get Mr. Sathe. Mr. Sathe, what about the insurance companies? There was actually a statement from Max Life Insurance saying that their sales numbers will be impacted. Was this a large part of their job? Bancassurance itself is a very big vertical for them. So what is the impact? I'm only talking revenues now.
Yeah. A few of the insurance companies which have greater bank assurance business, they will get impacted initially. But then I am of a view that this is a welcome step by RBI because there was no guidelines issued on especially mis-selling. Definition of mis-selling has been given. What is dark patterns, what DSAs and DMAs should do and should not do. Mis-selling is defined properly in advertising and marketing. What is all that should be done? It is well defined. Moreover, Lata, these are draft guidelines. Public comments have been invited up to 4th of March and they will be effective. Guidelines will be effective from 1st of July. So still time is there for banks and insurance companies to have proper things in place. So that is good. But initially there is a possibility that some of the bank's business may get impacted. But on a long run, I think it is very, very essential. It was essential and it will benefit the customers, the banks, as well as the insurance companies as a whole. So this is my view.
Yeah.
And,
no, I'm taking your point entirely, sir. I mean, I have in my lifetime taken 2 home loans and I was not insured for either. I actually prepaid most of them. But now, it seems to become a common practice, especially if it is a, SME or a business loan. The insurance is maybe demanded, maybe bundled. We don't know whether people can refuse. But my short point is, you think that sales can be impacted for insurance companies, at least initially?
May get impacted if they are not well prepared. But 4 months' time is there. So, and what is required is proper assessment of the risk. Moreover, giving option to the customer to either buy the product from other insurance company on his own or giving a presentation of more than one product. And it is not applicable just for insurance. It is applicable for all financial products, including mutual fund. So this is a good welcome step, mutual fund, NPS and everything. So proper assessment of risk profile of the customer is required to be done. That should be recorded also. There should be a proof. And the internal audit department of banks should evaluate whether it is properly done. So these are the really good steps which RBI has taken.
Yeah, fair enough. No, I mean, no denying it. I've never seen such a comprehensive overhauling of rules. This is the first time that RBI has come out and they've quickly followed it up with more rules on recovery agents as well. So clearly, customer at the center of the focus this week, at least for Reserve Bank. Mr. Khara, do you think that banks will be forced to follow completely to the letter? There is a supervisory bandwidth also. How much can they possibly do? There are a lot of gullible customers who wouldn't know that they don't have to buy the insurance along with the loan or along with the deposit that they're opening. So is there a limit to which Reserve Bank can even enforce it?
No, I think, Lata, when it comes to the awareness of banking, which is actually awareness of trust. So if at all the banking in long term, unless and until they enjoy the trust of the customer, they cannot really exist and survive. So I think it will be a very conscious effort on the part of the banks as it is, because even in response to the moral situation which was there in the past from the regulators, banks had come out with the policies which were in line with what was intended. So I think my sense is that even if the regulator has got limited bandwidth in terms of ensuring oversight, it will be incumbent on the part of the bank management itself to ensure that there are right policies in place and they should be effectively governed also on ground. So I think, to my mind, there will be a voluntary effort on the part of both banks, even insurance companies which are availing this route of bank assurance. And also, eventually, I think when all the three will work in tandem, insurance companies, banks, and the regulator, eventually the customer's interests will be taken care of. That is what my sense is. And I would say that in the past, we have already seen it happening. And it will be further strengthened because now it very clearly defines what the mis-selling is and what are the implications if at all things are not followed to the T. I would say that even beyond the banks, there are many NBFCs also where actually this kind of a bundling was a reality. So I think maybe they will also really come in the purview of this particular guideline once it is implemented.
Yeah. Oh, absolutely, sir. I mean, I know even for deposit products, happened to a relative of mine who was going abroad for about 10, 15 years and wanted to put his gold or his jewelry in a safe deposit. He had to open a savings account to have the locker. And he was told that, no, you have to buy an insurance. He said, I'm not here for 15 years. What will I do with an insurance? But no, you can't open a savings account unless you take an insurance. There were these predatory practices. Mr. Sathe, you pointed out that this is open for advice, open for feedback. What changes would you ask?
A couple of things need to be clarified. First is within 30 days, a full refund is stipulated here. IRDA has a cooling off or free look cancellation policy in which full refund is there, subject to the term for which the insurance has already been used or availed, and the medical fees and the stamp duty which has been paid. Now, these are some of the things which the insurance companies, the banks, and of course the RBI will have to sort out as to who should bear this. Because as per IRDA, these are to be borne by the customer, these expenses, even if there is a free look cancellation in which the policy can be cancelled in 30 days. So these are some clarifications which are required. But one thing is there, it will be a great ease of doing business for everybody, for the customer as well.
Oh, yes, absolutely.
And when second is about mutual fund also, like after a month, if the NAV has gone down and RBI wants full refund, whatever has been invested, then again, who should bear that loss? And mutual funds are not there to bear this loss, definitely, because investment risk is passed on to the customer. So these are some of the things which need to be clarified.
Fair point.
But otherwise, it's very good guidelines. They were long awaited. And Governor had announced it in the last press conference that they will be issuing these draft guidelines.
That's right.
It's a welcome step, no doubt about it.
That's right. So, spoken like a regulator yourself in terms of the gaps. Mr. Khara, just 30 seconds, sir. Any suggestions?
Well, I think I tend to agree with what Mr. Sathe is saying. At times, what happens is that when at the point of time when the selling happens, the customer seems to be inclined. But later on, when they go back and have a rethinking, then they would like to exit out of it. And that is the reason why the free look-in policy, free look-in period is permitted. So I think such kind of instances should not be treated as mis-selling. They should be actually treated as only change of mind. So I think those kind of things have to be kept in mind because having said that, I must also mention that bancassurance has been a channel through which the distribution of insurance has actually improved. If we really look at it, just about 4% penetration level, of course, it needs a lot to be done in terms of distribution. The channel should not be condemned because it has actually created value. But yes, of course, having said that, there should be enough checks and controls to ensure that the malpractices should not be encouraged.
Fair point, sir. Thank you very much, Mr. Sathe and Mr. Khara, for enlightening us of both the positives and the cautions on this new set of rules. But both of you are giving a AAA to the Reserve Bank for these new set of rules. Thank you very much for joining us. Wrap up on Bazaar. Chartbusters coming up.
Hello and welcome to Chartbusters. We are coming to you live from the Motilal Oswal studio. Keep an eye out on the markets. Markets currently in the red. Mangalam, what's going on? The Nifty, the Sensex, the Midcap index. It's a red start to the day ahead of Valentine's Day.
I think you said it, market likes red, Valentine color is red, and that's exactly why all the IT stocks are, behaving in the Valentine's mood. But let's see what happens from here on as well, because barring the IT sector, no other major problem for the market if you look at it. Earnings have been good as well. And speaking of earnings, let's speak about Indian hotels. A steady set of the third quarter numbers. Now remember, hospitality isn't an undiscovered space. It's more or less on the autopilot, and that's exactly what analysts expect as well. Puneet Chhatwal, the MD and CEO of Indian Hotels, joins in after 12% revenue growth in the company's consolidated performance, near 12% growth in the EBITDA. Thanks a lot, Puneet, for joining in. The third quarter obviously was assumed to be good. It is good. 15 straight quarters of record-breaking performance, and now that record itself sounds like a broken record because it's been spoken about so often. Having said all of this, every time the sector surprises us, the fourth quarter, no one is expecting 32 lakh rupees sort of rates coming by in the NCR because of the AI summit. So let's start with that, about MICE as a proportion of your sales and how the AI summit would hold you in the fourth quarter.
Good morning, Mangalam. Even if it sounds like a broken record, let's start getting used to it because the next quarters, I am quite confident will pan out the same way. Summits are very important, whether it's international delegations or summits, but 32 lakh for a Tata suite or a presidential suite is a far-fetched proposition. So let's not get carried away by reporting of one-off cases that might have happened for whatever reason, and God knows what all was included in the package. Definitely it's not from us. So it's not from us, and let's stick to responsible journalism. I think it's very important that we give a boost to the sector and not put it down on the national television.
Exactly. Thank you for saying that, because there were so many clickbaity words which were going around and all of that and stuff. I wanted it out straight out of your mouth as, the leader of India's largest hospitality company. What could the AI summit impact be on the average room rates of the region? Could it be 5-10% increase? What does this basically do to your Q4 business as compared to same time last year?
See, Mangalam, the AI summit is only 2 days of the 90+ days Q4. So with the law of averages and mathematics, we need many more things to happen to continue our double-digit top-line growth. We have guided for 12 to 14%. Year to date, we are at 17%. I think Q4 is the second most important quarter after Q3. We are on a good track. We are on a good roll. We have added new businesses. Our pipeline remains strong. Our openings remain strong. And we remain confident of definitely, getting ahead of Q4 of the last 3 or 4 years.
All right. Hi, Mr. Chhatwal. When you're looking for responsible journalism, look no further. Always true to its name, CNBC TV 18.
Yes, with my 2 favorite people, I think I could take the liberty to request you on behalf of the sector to not propagate, wrong information.
All right. We take that on board and, Mangalam.
Cheers, Puneet. Thank you for calling us your favorite people. And we'll see you around. We'll still not ask you any lighter questions. We'll still push you for numbers. We'll still push you for margin guidance. We'll still push you from, all the, from the vantage point of all the stakeholders in your company.
I think Puneet had a smoke on his face. Because Mangalam said cheers. That's a bit of a switch, with the tea. But anyway, cheers sometime during this quarter, Puneet. Let's get back to the numbers then. How do you see ARRs as well as occupancy move? In this quarter, as well as getting into the next year, as you're indicating, and you've said it time and again, every time you appear post a quarterly result, your body language is extremely strong. So what are your expectations on this front?
I think the rates will continue to grow at around 10%. Now, whether it's 9 in the end or 11, that's your RevPAR growth, which is projected. which comes majority from rate and a portion of it from occupancy, because occupancies are at a very high level. But more importantly, February is not just summit driven. February this year has more wedding dates than January had. So I think that is a very important component of the total revenue in India. Accounts for almost 20% of the revenue coming from wedding, MICE, food and beverage segment. So I think all in all, we see the demand outpacing supply, not just in the current quarter, but in the next quarters to come. And the domestic front is very strong. Our hidden upside potential still remains the foreign tourist arrivals, which is not really moved from the pre-COVID levels. But that should move, because globally the movement of foreign tourists has started happening, and some destinations are very much ahead and others are following. So I think India will be one of those that follows in getting its fair share of increase in foreign tourist arrivals.
Take that point, Puneet. Just a bookkeeping question. What proportion of your revenue comes from MICE? And in that, how much of that is corporate events? How much of that is weddings?
From MICE, approximately 30% in the Taj branded properties, because these are the larger boxes or larger hotels which have the capacity, like the Taj Palace in Delhi, the host of AI Summit. The Taj brand gets approximately 30% of its revenue from weddings and MICE events.
Okay, all right. Mrs. Chatwal, what about margins? Have they peaked at this 33-35%, or is there more to go?
Well, it depends how one looks at it. 7-8 years ago, we were averaging 15-17. Today, we are getting, last year we reported 35. This quarter, we reported 39.1, which is marginally higher. And on the standalone business, it's 48%. So in a capital intensive and a labor intensive business, we are very pleased with the margins. And these are despite the fact that we absorbed the growth of company-owned projects, the Ginger and Vivanta in Ekta Nagar, which have startup costs, as well as we are spending money on the opening of Frankfurt, which should open next month, middle of next month to end of next month. The date will get fixed very soon. And at the same time, all the money that has gone into due diligence, legal expenses, travel expenses for absorbing the inorganic growth that we had with Ank, Pride, Bridge, as well as Atmantan.
Right. We'll speak about this diversification at length sometime during the middle of the quarter, Puneet, when we get you once again. Just a final question from both Nigel and my end. You were speaking about Frankfurt, etc. I'm concerned a little about what the US media is reporting about the Pierre. Their residents, etc. They're up in arms. They don't want the property to be sold, but reports suggest that maybe members of the Pierre board have reached a handshake agreement to sell the building, etc. Do you know of anything that's happening, and could that have any bearing on your management of the property?
As we speak now, Mangalam, there is, again, no substance in that news, and there will be none even when we end this quarter, or we are reporting Q4 results. Definitely the co-op owns the building. So very important clarification that is needed is we don't own the pier. We have a lease contract on the pier. And we are very pleased with the current financial year performance. Actually, December was the first month in the history of pier where it crossed 100 crores in revenue. And this year is the first time we are going to have a cash profit in pier. So we are very happy to be on the Fifth Avenue, and we'll do what it takes to keep the property and keep the flag, because that is, the pride of a brand like Taj, which builds that soft power of hotel in, Fifth Avenue in New York, or Buckingham Gate in London, or at the Business Bay in Dubai, etc., etc. That's what builds the brand power of the Taj brand.
All right, Mr. Chatwal, always a pleasure speaking to you. Maybe since you took us across the globe, next time around, maybe we'll do an interview in New York or Dubai or somewhere better.
At the pier, or maybe the Frankfurt property that opens next month. Let's see whatever happens. Does that work?
We always say, we promise, we deliver. Now, you've said it on the national TV, Please join me in Frankfurt for the next reporting.
All right.
Cheers to that, and all the best for the quarter, Mr. Chatwal. You're going from strength to strength, and you're sounding very, very optimistic. Catch up soon, and thanks a lot for joining in.
Thank you for having me. Always a pleasure.
Well, time to slip into a short break. On the other side, we have Mr. Satish Pai. I had a chat with him. I'll tell you, what he said in that conversation. Stay tuned.
Fly Emirates.
Welcome back. Markets are under pressure. Hindalco has been reporting its numbers, both the India operations as well as Novelis over the last few days. I had a chat with the management, Mr. Satish Pai, the MD of Hindalco. Let's hear out what he had to say with regard to the India business, the Novelis business, and the debt plan as well.
Well, if you look at the last couple of months, the aluminium prices have been around $3,000 plus minus $100. So I think that, we are well into the middle of quarter four, and it's fair to say that these levels of pricing of aluminium are going to continue. I think you have a tight supply-demand situation. And then when you look at the investor sentiment, commodities are now very much in favor. So I think as a combination of this aluminium, copper, and most of the commodities seem to be having a very strong pricing support in the coming months.
Okay, all right. Let's focus a little bit on the business and the aluminium business. What is the mix likely to be? Because I'm just looking at the export contribution, export domestic mix. domestic sales, that turned around a little bit. So how do you see the mix stabilizing in the coming quarters?
So I think that over the next year, till our new upstream capacities come in, we're going to be more than 70% domestic and only about 30% exports. Why? Because our value-added downstream capacities have gone up after we have commissioned our new plants in Odisha for rolling and extrusion. And the Indian market demand is very strong. So I think that, the auto sector has bounced back after GST 2.0. We're seeing electronic goods manufacturing picking up. So I think that the market demand in India for aluminium and copper is extremely strong.
Okay. Even though you have a hedging strategy in place, 60% of your volumes in Q4 will be at lower prices, 2,800 ballpark. And in the next year as well, 20% of your aluminium will be hedged at a little bit of a lower rate. That said, most brokerages are factoring in that in Q4, the EBITDA per ton can improve by around $200. And on that increase, they are factoring in that in FY27, it can go up by another $200. Is that possible?
I don't want to speculate on how the profitability will work because, Nigel, there is the LME and there is the cost side. So I think it's fair to say that we are currently running at a 46% EBITDA. And I think that at these levels of LME, it's fair to say that the Q4 EBITDA per ton will be higher than Q3. I wouldn't want to speculate on the quantum. The fundamental profitability with the LME will continue to go up, of course, tempered by the fact that cost prices are also starting to show. So I think, some of our inputs like CP coke prices have risen sharply. So I think you'll have to look at the combination of the cost of production and the market. But I think it's fair to say that these high EBITDA per ton that you saw in Q3 are only going to improve in Q4.
Got it. At least directionally, we've got some color on that front. Let's shift to Novelis then. The impact of the fire that you'll be recording for Q4, will it be higher than Q3? Point number one. And point number two, I wanted to ask you with regard to this tariffs. Tariffs have had an impact on profitability. But now with the Midwest premium moving up, do you see that tariff impact actually gradually start coming down?
So let's take the Oswego fire incident. I think that, we gave a guidance that the overall cash flow impact would be around 1.3 billion to 1.6. I think that it'd be fair to say that you are going to see a large part of the cash flow impact actually coming in Q4. I think the EBITDA impact in Q4 will be more or less in line with Q3. But I think the good news is that we have now visibility that we'll be starting the mill by middle of Q1. And I think that once that comes back, Novelis US is going to be very good. Now, taking your second question on the tariffs, the tariff impact for us is steadily going down. And as you rightfully said, with the Midwest now running at around $2,200, would be fair to say that going into next year, we should not be seeing any tariff impact at all.
Oh, that's heartening to hear then. So from being a bit of a headwind, it could actually flatten out, which is good news from an investor perspective. Also, you all have repeatedly mentioned that insurance is 70% plus of the total hit that you'll see. Is there any risk to that?
No, I think we are fairly comfortable. We are working very closely with the insurance. They have been involved in Oswego right from the beginning. So we are quite optimistic that we will be able to recover 70 to 80% of the damages.
And Novelis goes to around $500 per ton in the second half of the next fiscal, possible?
So Nigel, let me tell you that Q3 itself, if you strip out the effect of Oswego, they were at $495 per ton. So I think underlying profitability of Novelis at around $500 per ton, you should be seeing next year.
Got it. All right. So we've got clarity on that front. What about the copper business? TCRC, came under a little bit of pressure, but you stick to that guidance, 650 crores per quarter for the copper business?
I think that, because of the varied value chain of copper, sulfuric acid prices are good. The rest of the metals that we get, precious metals, those are contributing. Our value-added copper is now slowly coming on stream. The IGT, the inner groove tubes for air conditioners plant, has been commissioned in Baroda. So I think that as a combination of the value-added copper along with sulfuric acid, we are quite confident that even in this low TCRC era, we'll be delivering the 600 to 650 crores a quarter.
Okay, what about the capex, sir? You had laid out a big 40,000 crores of capex for the next few years. In the near term, what is that capex likely to be in FY 27? If you could help us out with that. And what does it mean for the net debt number? Because most sell-side notes are talking about that debt number swelling towards 80,000 crores at peak levels.
So I think that the first guidance which we are giving repeatedly is that the consolidated net debt to EBITDA will be around 2. So people don't need to worry because our balance sheet, especially in India, is extremely strong. The second thing is that our capex cycle is in India. We are steadily going ahead. We will spend 10,000 crores in FY26, and we plan to spend about 12,000 crores in FY27. So we have taken all our capex spends and our cash flows, and we are quite comfortable that our net debt to EBITDA will be around 2, which is healthy.
All right, that was the management of Hindalco then. Talking about the path ahead, they believe that the global aluminium as well as copper dynamics will continue to support prices, though they highlight that CPC prices are moving up, which is an input cost as well. The markets, though, firmly in the red. We're down close to around 250 points now on the Nifty. Hopefully, by the end of today, we do see a recovery because for the time being, at least, the number of stocks advancing has recovered from the day's low. Take that break, come back, continue to focus on markets as well as stock-specific action. Don't go anywhere.
You want to talk business?
Welcome back. One day ahead of the Valentine's Day, people call it the kiss day. The only kiss that the market participants perhaps would be at some point waiting for is the kiss between the advance and decline lines. They're far too apart from each other. 2,300 stocks in the red for about 545 stocks in the green. Whether that happens or not, we'll leave it to the team of Trading Hour and the shows beyond that. But Nigel, do you think
Don't give any
happening?
further details.
do you think there's a kiss happening?
They'll get closer to each other.
They'll get closer to each other.
They'll get closer to each other.
Those lines I'm talking about.
Yeah, obviously.
All right. On that note, what we'll do is we'll take your leave. Thank you so much for watching. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, and with me, Ritu Singh, joining in from the Bangalore studios. Ritu, it has been a fairly weak day if one is a bull. Over the last couple of trading sessions, the IT index by itself has bounced down on the other frontline indices, and right now the Nifty is below that 25,600 mark as well. Though there has been recovery from the lows on the IT index, it's still down 3.5%. The Nifty is still under pressure because no supporting cast helping today, and the broader markets have it even worse.
No supporting cast today, Mangalam. Yesterday you had, the bank Nifty trying to pull its weight, but today, it's red across the screen. And so sorry to disappoint Nigel and you, but those crisscross lines, I mean, it's only getting worse now. More than, almost 4.5, you could say. More than 4 stocks are declining for every 1 stock that's trying to advance. That's where we're at. A bit of a recovery midday, but, it seems like we're slipping again. The IT index, like you said, that's been the big drag. It's not such good news on the equity market front, but on the money market, if you quickly pull up the 10-year yield, we've seen a softening of 3 to 4 basis points coming in this morning. The yield, in fact, is below 6.7 after very many days. And that's because of the switch that was announced by the government yesterday. So keep all of that in mind as well as we get set, for the next hour. But Mangalam, you spoke with United Breweries earlier. Tell us about their numbers.
That's correct. So in a market like this, I think the only thing that the bulls would want right now is a glass of a cold beer. And that also did not come about in the third quarter, largely because of the weather-related issues. The management sounded a lot more optimistic about the current quarter and a bumper summer ahead. So let's go ahead and listen to what Vivek Gupta, the MD and CEO of United Breweries, had to say. The stock off the lows right now, one of the few ones which are actually at the high point of trade. Vivek.
We are a quarter away from the right level of growth. I think there are 2 things which are hitting the category. One is, of course, the weather, but most importantly, the second one is affordability. I can see the green shoots now because the state excise policies are getting released. Yesterday, we got the policy of one of the biggest state, Uttar Pradesh, and they have not increased any taxation on beer, and relative taxation on spirits have gone up, so which is going to help beer. West Bengal has released a policy in December. We're already seeing the category bouncing back there. We are seeing the category bouncing back in a couple of other states as well. So I think it's a combination of affordability and weather. We see January definitely and December, the category coming back to growth. So I really hope that the days of negative category growth are over and we will see at least mid-single-digit growth of category in this quarter, and then hopefully a bumper summer based on the weather prediction.
All right, mid-single-digit growth in the fourth quarter and a bumper summer. Could you define the bumperness of the summer by quantity, and at the same time give us a sense on the premium side as well? Because the last 2 quarters, they've been very weak. It's been growing upwards of 25-30% in the past. Then the last couple of quarters, it came down. In the third quarter, was up just 1%.
Yeah, no, I would say that, at least 50% of India had more rainfall and extended winters. Like North, for example, had a double-digit decline in the category, and the winters were, the La Nina impact came. But we should not shy away from the affordability issue on the category. The taxation on beer relative to the entry-level spirit is the single biggest driver for this category as per our learning. I think in many states like Karnataka, Telangana, Rajasthan, West Bengal, Odisha, which contribute more than 55% of the sales in the category, the beer became expensive and more expensive as compared to spirits. Now, we have been working extremely hard with Brewers Association of India, working with the governments to really share with them the economic impact of beer, why beer is important for farmers, why beer is important for ecosystem, why one job in the brewery actually creates 98 jobs outside the brewery. So all of that is leading to a policy consideration where at least in many states, they are realizing they've gone overboard on beer taxation.
Right.
So we are seeing those changes coming out.
Okay. What about Telangana? You did speak about Telangana, but I hear from your conference call commentary that fresh issues around receivables have emanated. Can you give us a detailed, answer to that?
Yeah, on Telangana, we have actually got the old money, the 2024 money, almost 90% of that the government has paid us, which improves the quality of the dues. But the current dues are still mounting up to the same level, and we are in consistent conversation with the government because working capital is extremely important, especially in the coming beer season. But at the same time, I know when we are talking about the top line, we had excellent bottom line results. We actually clocked highest ever gross margin in the last 3 years. The EBIT actually went up by 87%. And there is a significant structural improvement we have done due to localization of our portfolio and premium mix. So I think on one side, while the category has slowed down, at the same time, structurally, we are actually in a much better position. And that's why what I mean by bumper summer is that we are actually prepared as a company in terms of supplies, in terms of stocks, in terms of our portfolio. If the weather, leads to better consumption, we are ready to supply that.
Right. So could you give us a sense on the next couple of quarters? Mid-single digit volume growth, slightly higher than mid-single digit volume growth in the summer months if that the weather is conducive. Premium, how much does that grow at? What's your near-term outlook on margins? And if you could give us an updated market share on both premium and overall.
So overall, let me start with the market share. In 2025, United Breweries grew 90 basis points of all India market share, which is phenomenal. This is the highest market share growth at a country level in the last 15 years. So we got actually 90 basis points of overall market share. On premium, we grew 23% on volumes, which is again leading to almost 200 basis points of market share on premium. So both on overall beer and premium, we are growing market share. We expect that 20% plus growth on premium to continue because we absolutely have a lot of opportunity on further driving Heineken Silver, which is a flagship premium brand, Amstel Grande, expanding in most states, and Ultra Max, which we are localized now in most of these states, and we are seeing this significant brand power. On top of that, we actually have also launched Kingfisher Strong Smooth, which is actually an upgrade version of Kingfisher and more designed for the younger consumers. We have launched in Rajasthan, we have expanded in Karnataka, we are going to expand in more states in the coming weeks. And so we feel that the revenue mix and premiumization story will continue, and we expect that to be in the tweens as we did in the last 25, and our goal is to further accelerate our premium business. On the category growth, as I said, that look, affordability and season is a big one. The big states are yet to come with their policy. We are hopeful they understand the impact of affordability on the beer, and that's why right now we are planning we are planning scenarios.
All right.
Is it mid-single digit to above? We are ready for both.
Okay, and Visi coolers and bottle returns, if you could give us an updated number on that before we let you go.
Yeah, on the bottle returns, we have made almost 200 basis point of improvement sequentially, which is also reflecting in the margins. So in the 220 basis point margin increase, we believe that almost half of it is our structural improvements, which will carry on, and at the same time will be very competitive to serve the market. On Visi coolers, we again there are more than 35,000 stores who have UB Visi cooler. One data point is we have actually implemented 10x more Visi coolers than what we implemented 3 years back. So we are making a lot of progress on our execution strategy as well as our overall structural health of the business.
All right, so they're preparing for the structural health of the business, Visi coolers, premium products, and laying out everything. But Ritu, the question is whether there is demand or not. Are you up for it this summer?
Well, there's always be demand comes summer, but Manglam, let's do one thing. We'll slip into a short break. Up next, we're going to focus on the bond market with Panisha Gupta, so stay tuned.
CNBC TV 18 and India Bonds presents Bond Street.
Welcome to Bond Street. Joining us on the show today is Dr. K. Paul Thomas. He's MD and CEO at ESAF Small Finance Bank. Mr. Thomas, hi. Thank you for joining in. At the onset, the ESFA's Q3 performance has stood out. What would you say have been the biggest drivers therein?
Thank you, Manisha. Last 2 years, we were on a transformation path because of the asset quality issues we face in our microfinance book. We have taken various steps. One major was to diversify the asset towards a more secured portfolio. So because of the consistent efforts, we were able to bring down the microfinance portfolio from 70% to 37%, and increase our secured book from 45% to 63%. So the asset like agri, mortgage, mobility, and MSME, and also the major part comes from the gold loan growth. So that is one aspect, and the second was we continued our efforts in rebuilding our microfinance portfolio by introducing the SRO has introduced guardrails in 24. So we have very strictly followed those guardrails. So the new microfinance book is very well performing very well, and also continued our efforts in the bank own channel and the BC channels for the collections, the NBA collections. So that has also really helped us to turn around the bank.
As you mentioned, you pivoted towards secured asset class over the last 24 months, particularly exposure to gold loans. How has that experience been?
Yeah, building up gold loan, especially we have 50% of our branches are in South India, and gold loan is a very, very well-known product, and resources were also available. So talents were available. So we were able to scale it up quickly, and gold loan demand, and generally the small business owners and farmers use gold loan as a bridge funding. They are all very well known this product, and we had good branch network also, so we were able to scale it up.
How would you say does ESAF's overall funding mix look today, and how is that mix evolving for you?
The overall mix today is basically mostly from CASA. 24-25% comes from CASA. Then the major part comes from term deposits. So out of the term deposits, around 24% is NR deposits. Then we are also to build our we also use borrowings mainly interbank borrowings, as any other bank does. We also do that, and also we avail the refinance facilities from NABARD and CP, the development finance institutions. We also use that. Also, we have a part of it comes from Tier 2 capital we have raised. Last financial year, we have raised around 415 crore of Tier 2 capital. This was mainly to augment our capital adequacy. Even though the capital adequacy requirement is 15%, we maintain about 20%. As of now, it is 22%. So this since we were going through turbulent times, raising Tier 1 capital was a big challenge. So the Tier 2 was helped us to improve the capital adequacy. So this is almost this is the way we fix our funding mix.
Mr. Thomas, also, how would you say you have seen the corporate bond market evolve with the rise of SEBI-regulated online bond platform providers especially?
Yeah, so in India, it is very interesting to see the online bond market is getting momentum. So so far, mostly bond market investors were only institutional investors and HNI investors. Now the online bond market platform will open up to a large number of retail investors can participate in it, and this will definitely evolve. The debt market will going forward will definitely evolve and improve, and mostly since a large number of the Indian savers are moving to the capital markets, banks will also will have to depend on bond markets going forward to fund their liabilities.
And finally, Mr. Thomas, ESAF has recently raised funds through a bond NCD issuances. How was the investor response? What was the core objective? And what's the key takeaway for bond investors from there?
So it was a very good response. The last issue was 150 crore Tier 2 bond, and we got a very good investor response. Even during these difficult times, investors had a confidence on the fundamentals of the bank, and it was, as I mentioned earlier, it was mainly raised the Tier 2 bonds for augmenting our capital adequacy ratios.
Fair point that, Mr. Thomas. Really appreciate your time here today at CNBC TV 18. Thank you so much.
Thank you very much.
CNBC TV 18 and India Bonds presents Bond Street.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Carraro India has delivered a strong quarter. Double-digit revenue growth is what we've seen in this quarter. Balaji Gopalan, the Managing Director of Carraro India, joins us now on their numbers and the way ahead. Mr. Gopalan, thanks very much for being here. The outlook seems to be turning, more positive for the tractor industry. We had Eminem telling us that they see more than 20% industry growth in this fiscal. How are you seeing demand shape up across your agri driveline portfolio? And also, what kind of momentum are you seeing on the construction equipment side?
Yeah, thank you very much. My pleasure to be on the CNBC show today. As you rightly said, yes, you have captured it, that the market is booming. The good monsoons, the reduction in the GST is all creating a sentiment in the farmers to go in for tractors and mechanization. India is going through a phase where agriculture, mechanization, farm efficiencies are going to be the focus to achieve food security for the country. So it's been doing very well for us. At Carraro India, the revenue grew by 21% in these 9 months. And we're looking at a very strong future because the transition from two-wheel drive to four-wheel drive tractors in India is gaining momentum. So the technology absorption is taking place. And today, roughly from unconfirmed sources, we know that the four-wheel drive market penetration has reached as high as 25% out of the 1.1 million tractor industry that exists in India. So the going is good. The future year, our projections are quite strong. We are getting strong demand from the market to book capacities at our end. And to that reason, you would have seen that we have to go in for an expansion, capacity expansion this year to meet the market demand. So all in all, going very well on the agriculture side. As far as construction equipment is concerned, the market was down overall. But luckily for Carraro India, we had got into, at a very strategic point, into the teleboom handler business. And teleboom handler business is globally growing very well, and it should start growing in India. Currently, it is at less than 1% of the construction industry market. So we did very well with exports in teleboom handlers to one of the largest OEMs in the world. So that picked up, gave us the momentum in exports. Second, backhoe loader, very surprisingly, in India, because of the long monsoon, the market was down. But for us, we could export because there was a big demand coming in from Latin America and China. So these were really enablers that helped Carraro reach in these 9 months growth of 21%. And the future, we are very, very excited. And in fact, it is challenging for us to meet the market demands, which we will certainly do.
Sure. You've given us some strong numbers. Is that why, you've sort of indicated that you will surpass that FY30 revenue guidance? So now, if you could put numbers to this outlook that you're very optimistic about, what kind of growth trends are you now looking at?
See, we hope to close this year slightly above the guidance that we had given. So I feel we should reach a figure as of March 31st. We should close close to 220 to 25 million euro, which would mean 2,250 crore is what we are looking in terms of Indian rupees. So the going seems to be good, and we will be exceeding the guidance that we have been giving. And we are very confident for the next year as well in the long-term guidance that we have given in the past. We will be meeting it for sure at this point in time, but we hope to probably even exceed the guidance given for next year.
Could you give us a sense, Mr. Gopalan, then what is the kind of over and above the guided band, how much do you think you'll beat it by? And also, if you could give us a sense on what the kind of volume growth was in the third quarter. At the same time, what's your outlook on the margins, given the surpassing of expectations on the top line? Do you think that'll flow down to the bottom line as well?
No, there will not be a slowdown in bottom line. I have seen some reports where they are talking of a decline in our PAT in the Q3 results, but that is largely because it is an industry-related labor code provision that we have already taken. So in real terms, our PAT and EBITDA is doing well. In fact, as guidance for the year, we are sticking to the original guidance of reaching close to 11% that was given. So we are targeting anywhere between 10.8, 10.9, 11. If we reach 11, I think that will be a good story that we could bring to the market.
Next year will be 12%. And what kind of revenue growth are you guiding for next year?
8 to 12% is a very reasonable growth we are projecting. Our capacities also are aligned with that. The market order book that is coming to us is also talking of 8 to 12. As we move towards the next year, mid-year, we will have a clear confirmation on that. But 8 to 10 is something we can start off now. And the EBITDA growth, yes, we had spoken about 12%. That is surely our target. And by the way things are moving and the product mix that we are getting for next year, I am sure we will reach our EBITDA guidance that we are giving. The future is exciting for us. So when there is growth coming in, when there is momentum there, I think all these profits and margins we work on efficiencies, and they give the result in the end. So
take that point entirely.
Mr.
Gopalan, thank you so much for joining in. 8 to 12% revenue growth next year with 12% margins. We'll take a short break, come back. We'll also discuss the market fundamentals. George Thomas, fund manager from Quantum AMC, joins in on a day where the markets are seeing a sharp decline.
Welcome back. George Thomas, the fund manager from Quantum AMC, is with us now to talk more about market fundamentals. Mr. Thomas, thanks very much for being here. You know, these big macro headwinds as we start the year are out of the way. We've already heard the budget, the big trade deal overhang, that's sort of gone now. But the volatility continues. Where do you see the market, say, in the near to medium term? And also in terms of sectors, where are you finding pockets of opportunities? Where are you staying away from, especially with all this talk around AI impacting the IT sector?
Yes, thanks for having me on the show. As you said rightly, most of the macro headwinds seems behind us. And when we look at valuations and how things are likely to pan out, given that there has been a series of measures to boost consumption in the economy, our sense is in the medium-term market should do reasonably well. But from the impact of AI on IT services, our sense is it is more noise than what is actually happening. If I were to borrow the comments from one of the tech leader, from an anecdotal perspective, if I were to explain what is happening with all the fears of AI on IT services. So if we were to assume that we will have to create a township in central Mumbai, which is spanning, let's say, 2-3 acres, it might take us 10-12 years. But if I were to do the same thing in the outskirts of Mumbai, where it's a barren land, I might be able to do it in 3 years. This is precisely how AI is likely to impact the services. A lot of times, people project productivity and how transformation can happen on a standalone basis, ignoring that there is an existing systems and enterprise which enterprises have in place. So historically, what we have seen is this kind of fear has happened even when SaaS or ERP came into picture, where you would wipe out IT service revenue. But the very fact that it has to displace some existing thing and it has to integrate with the existing tech landscape, that could definitely make the opportunity much larger than what anyone can imagine at this point.
Right. When we look at the other opportunities here, after a big correction of almost, 50 to 60% in a lot of these broad cap names, which have not done particularly bad from an earnings standpoint, valuations have become a lot more comfortable. Are there any screaming ideas here?
Yes, of course. If you look at the deal wins of the top 5 IT players, of course, each of them have different ways of reporting the deal wins, but it gives a good directional sense. So if you look at the trailing 12-month deal wins for the top 5 players, as of the recent quarter, it is up about 9%. And if you look at the revenue growth of some of these SaaS players, where the market is supposedly worried about disruption, even that is growing at healthy high single digits and some of them even at double digits. So none of these data points kind of point to a sharp deceleration in terms of revenue trajectory. And even if you look at the headcount addition, so those are, of course, the macro uncertainties is still there, and that has been there for quite a while. And our sense is as enterprises see that the current macro setup does not deteriorate from the current level, we could probably see the discretionary spends come back. And to your question, some of the large cap IT names, the larger service players, which has corrected to a larger extent on market fears that their business could be disrupted to a higher level. My personal sense is those might be the players where the opportunity could be the maximum.
All right, Mr. George, we'll leave it at that. Thanks very much for joining in. We have to slip into a short break, but don't go anywhere. When we're back, we'll get you more on the markets.
Welcome back. The Valentine's Day color is red for the market, and that's exactly what's playing out as well. It's Friday the 13th, so the street is definitely spooked. If you're a bull, the Nifty lower at around 25,550, the Nifty Bank, the Nifty IT index as well. So both those big cap indices, the Nifty Bank and the Nifty IT, weighing down on the Nifty, even though there has been a recovery from the lows on the Nifty IT index. The Nifty Bank is down 0.75%. The broader markets have it worse. We have the mid-cap index down nearly 2%, the small-cap index down as much as well. And that's visible in the kind of portfolio decimation that we're seeing. Advanced decline ratio tells you that nearly 2,300 stocks, which are in the red, for about a little under 550 stocks, which are in the green. So that's, not making anyone's portfolio look good either. And it's visible in a couple of other things as well. The volatility index, there's been a big spooky spike there. 12.5%, 12.5 is where the VIX is, with a 16% rise, 6.16% rise. The only elements of hope right now for the bulls are two. One, the Nifty is still holding on to the 20-day moving average. So that's an important support. Secondly, the put-call ratio tells you that we're at perhaps the end of this decline, because it's oversold now. It's getting below that 0.7 mark as well, 0.69 as we speak. And we are seeing put writing at 25,500. We're also seeing some call writing at 25,600 and 25,700. But chances are from here on, maybe the upside is a lot more than perhaps the downside. That's what the data points from the put call ratio and the 20-day moving average are suggesting. The Nifty Bank as well, very close to its 60,000 psychological support. So signs of a turnaround, you'd probably first see in the mid-cap index, secondly, mid-cap IT names, and thirdly, if the Nifty Bank maintains this 60,000 mark, maybe there could be a bit of a pop on the way up. And if it holds above the 25,600 mark, then all those call writers of 25,600 may have to run for cover. All of that in the second half of trade today. We take a short break, come back, get you more on the markets on the other side.
Welcome back. For the markets, still in the red. The advanced decline ratio, very little improvement, still about 4 stocks declining for every 1 stock that is advancing. The rupee has also slipped in trade today. Pull that up for you. It's weighed down by some broad-based dollar demand, and that we understand is because of some maturing positions in the NDF market. Now trading at about 90.74 to the dollar. It's depreciated by almost 0.15 rupees in just today's trade. The 10-year, though, that's reacting well to the news from last night, where the government is going to switch the bonds that were maturing in FY27 to a much later dates. That effectively brings down the borrowing by about 75,000 crore rupees, and that is why you've seen the yields cool off by about 3 to 4 basis points. Apart from that, oil prices, of course, reacting to the IEA projecting a slower increase in oil demand in 2026. The Brent at 67.41 as we speak, and the WTI at 62.69. On that note, we're going to wrap up this edition of Trading Hour. Mangalam and I will take your leave, but stay with us. More news and updates will continue after this very short break.
Stocks see a sharp slide with IT stocks getting battered after a slump in US tech names overnight. Midcaps also feel the heat as risk aversion spreads. Realty and metals are also the other big losers.
A recovery in Novelis is a few quarters away. Hindalco MD Satish Pai tells CNBC TV 18, though he expects FY27 to be better, a sell-off in metals and a step up in debt also weigh on the stock.
Axis Bank CEO Amitabh Chaudhry says acquisition of Credit Access Grameen is pure speculation. He, however, adds that the bank is in early evaluation stage of the opportunity and a decision has not been taken to pursue or opt out. CNBC TV 18 had reported that evaluation for a possible deal was on.
While the IT sector has seen a sharp and indiscriminate sell-off, the former CEO of Infosys, Vishal Sikka, says that there's a gap between AI's promise and enterprise-ready reality. Sikka says while some disruption will hit now, others will take years to show up and will all differ company by company and line by line, but warns, don't assume slow adoption means no disruption. Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Ekta Batra, and we'll be joined by the management of Indegene in just a bit. Quickly, let's tell you what's happening with the markets. Another day of fall. Nifty IT is down 8% this week, but Nifty so far has been resilient. That one is flat, so down just 0.5% versus the massive moves that we are seeing in Nifty IT. Though that index too has recovered from the lows of the day. We were very close to 25,500 today. In fact, we were at 25,513. That was the low of the day. We have recovered from those lows. But metals, realty, IT, all of them putting a lot of pressure. In fact, all the sectoral indices are in the red today.
Hi, Sonal. Yes, definitely a very, dismal day for the markets, you'd have to say. But what stands out is at least the broader markets are showing some amount of buying from lower levels. So currently, the mid-cap index is just about lower by around 1.3%. Remember, at one point in time, it was lower by around 1.7%. So there has been a little bit of recovery and buying from the day's low, which has taken place for the markets. But nonetheless, let's talk about specific companies then. We have Manish Gupta, who's the chairman and CEO of Indegene, who's joining in to discuss three main points, which is basically the impact of AI on their business growth across geographies and their FY27 outlook. Manish, hi, welcome to the show, and thank you very much for joining in in our studios. Well, wanted to start by asking you about the topic that nobody can stop talking about, which is the impact of AI on business. You're so closely linked with the entire industry. You're at the cusp of, tech as well as pharmaceuticals. Tell us about how exactly AI is utilized in your business at this point in time, and how is it impacting your revenues?
So first of all, thank you so much for the invitation. Great to be here and great to see you again, Ekta. Before I go and talk about our business, let me just give you a sense of the industry over here. We believe that AI, and not only me, right, in general, the broader industry, the tech guys and the pharma guys believe that AI is going to be a big tailwind for the life science industry, right? And could unleash something which we are already getting to, a science super cycle, right? A medical golden age. AI is going to help and is already helping pharmaceutical companies discover drugs faster. Right, the whole lab piece is getting accelerated. Today, there are already 40 candidates which have moved to clinical trials, and these are candidates which have been discovered using AI-based approaches. Right, now, obviously, all of them have to cross the clinical trial process. So, what we believe is there's going to be a stronger pipeline of new drugs coming in with the help of AI. Now, the interesting thing, and that's where Indegene starts playing, if you're going to take these products through the whole clinical trial process. If you do clinical trials the way they are done regularly, right, 5 to 8 year cycle, huge amount of cost, couple of $1 billion, your P&Ls will break. You can't do that. You got to find better ways to drive clinical trials, right? More efficient ways, cutting down cycle times across the board. Next, assume that more candidates are crossing the clinical trial phase and getting into the market, closer to the patients, right, or getting to patients. You can't do sales and marketing the same way. You can't have the cost of compliance, regulatory affairs, right, at the same level. So the per unit price for each of these will have to come down. And the best way to do that is AI, right? And that's what our business enables.
How much of your business are you currently utilizing artificial intelligence?
Actually, our business is based, when we started the company 27 years back, right out of college. The whole thesis was that we will bring healthcare expertise, medical expertise with technology expertise, right? Now, technology continued to change over time. It was initial days, we were tinkering with Palm Pilots, wireless access protocol, moved to various other things like virtual environments. Digital came in, which was a big tailwind for us. Right? Somewhere in 2016 or 17, across the board in all our processes, medical and commercial processes, we started building in AI, NLP, and computer vision. Right? In fact, when COVID happened, one of the large COVID vaccine manufacturers had a huge adverse event reporting, right, which had to taken back to the FDA. And with regular people, they couldn't have managed the workload. They could have need thousands of people.
Okay, you know, I'm coming on to that in terms of numbers, because yesterday Bajaj Finance in their conference call said 10% of their disbursements came in while AI tracked phone calls, AI tracked what people wanted, and that is how they basically structured their business. So if you say technology has been in your business from the word go, it has been changing, have you seen any numerical difference with adoption of AI or with the changing technology? You say productivity will increase, cost per unit will come down. Are there any numbers for that?
I think it's too early for numbers, right? As I said, pure digital, and if you could and take out things like take things like AI, NLP, computer vision, right? Gen AI is still in its early days. As a company, we grew from $10 million in revenue to $90 million by 2020, to 10 to 220, which is 24% dollar CAGR, close to 30% rupee CAGR. 2020 to 2025, we grew from 90 to $335 million, which is a 30% dollar CAGR, 38% INR CAGR. Our differentiation was based on digital AI, NLP, and Gen AI. But the Gen AI, which is a new tool, that still has to percolate. It's early days.
Okay, so it will have a revenue and a cost impact.
Absolutely, absolutely.
Okay. Well, you know, Indegene has been quite active in terms of the acquisition front. And you have, what, 1,395 crores of cash on books?
Slightly more.
Okay. Are you planning to make any more acquisitions? Would AI then be something that you're looking at actively in terms of an acquisition?
We are always open, right? We have a full-fledged corporate development team, which is on the ground always. But our approach typically has been acquiring specialized capabilities, right? The AI stack and the AI tech platform, most of our wins over here have been, or what we have done has been organic. We've been spending a couple of percentage of our revenues on R&D for many years. And most of our AI has actually come from those investments. What we are doing is acquiring specialized units, which are doing work more or less the traditional way, right? And using AI to offer a very different proposition, right? So I don't think we'll do AI-based acquisitions unless we find something super interesting. But we'll acquire specialized capabilities which fit into a customer stack.
Okay, all right. It was an interesting conversation. We learned a lot more than the business fundamentals, and especially, as Ekta said, it's the buzzword AI impacting all segments of business as well. Thank you so much for joining us today and visiting us in the studio. That's the word coming in from Indegene. But with that, we'll do one thing. We'll slip into a short break. Up next, we'll connect with the top management of Lupin to decode their Q3 numbers.
Fly Emirates.
Welcome back. You're still tuned in to Halftime Report on CNBC TV 18. Let's shift focus to Lupin. The company reported a strong December quarter where revenue and profit witnessed a healthy growth along with margin expansion. I did speak to the management and started off by asking them about the key contributors to the US markets this time. Listen in.
Tolvaptan, Mirabegron, where we've had exclusivity and semi-exclusivity in case of Mirabegron, of course, have been strong contributors in the quarter as well over, quarter-over-quarter growth. But likewise, our baseline products, Spiriva in particular, albuterol as well, have performed well because this past quarter also has been a pretty strong flu season. So, asthma COPD products, the other flu products like oseltamivir have done extremely well to grow in volume, to offset, the usual baseline low single-digit price erosion. So very strong contribution both from the new products as well as our baseline products. The injectable products like glucagon are ramping up. I mean, during the quarter, we launched Risperidone Consta, which we were very pleased to with CGT exclusivity. This past year has been a really good year from the standpoint of the injectable portfolio rollout with glucagon and then liraglutide and Risperidone Consta. And, adding to that our biosimilar soon. Hopefully this quarter, we're planning to launch pegfilgrastim as well. So really excited about the institutional product portfolio build as well.
Yeah. Are you on track to achieve that $1 billion target for FY26 in terms of the US sales?
Very much.
All right. And what does that mean for FY27? The street is a little worried that maybe there could be some drugs which would lose momentum in FY27. So what would the pipeline look like? And is that a fear that Lupin is possibly working with, that maybe there are these key drugs which could probably see some amount of competition?
Yeah, we certainly see potential competition in products like Tolvaptan, maybe with Mirabegron as well, although, we think that we know the companies that have filed for the product and what it takes to really stay on the market. Factoring in the additional competition on these key products, plus, the build out of the injectables portfolio, and added to that, the pegfilgrastim launch, we feel fairly confident of staying over that $1 billion also for fiscal year 27. So really pleased with the momentum that we have right now and sustaining that $1 billion plus level into the next year.
Okay, all right. Ramesh, I just wanted to come to you with regards to the margins this time, because that really stood out. You did around 31% in terms of margins, and your guidance has been around 25 to 26%, something that you raised vis-a-vis 24 to 25% last quarter. Where do you stand now in terms of margins and guidance?
So clearly, because of the top line buoyancy continuing, the expected competition for Tolvaptan did not materialize. Given that the buoyancy was certainly still pretty good, and given the focus on costs, and of course R&D being in line with what we expected, margins were about the same as the previous quarter. Of course, last quarter also had the benefit of PLI benefits. Minus that, it's in fact this particular quarter would have been a little higher. So going forward, so if you look at the full year, given the fact that we have achieved pretty good margins even in the third quarter, you could say the full year margins should be close to about 27-28%. And going forward for next year, given that we expect the top line buoyancy to continue and the focus on costs, of course, would always be there. R&D could be a little higher. So you would expect, in fact, our expectations would be that it should be in the range of 25% at least.
Well, India will also see the semaglutide launch in March. You've said that you're going to be part of the first wave. How much are you expecting in terms of sales from semaglutide in terms of the India launch? And what is your plan for other emerging markets, say, such as Brazil and others?
Sure. I'll start in India, and then Vinita can take up the part on the other emerging markets. On India, we're geared up for it. March is the date, and we will launch the injectable semaglutide. In that time, our brand is called Sema Next, and we're looking forward to bringing it to market. Numbers are going all over the place, right? And there's going to be, I think 40, 50 companies that will launch this. Obviously, as the second or third largest cardiometabolic player, we would expect an equitable share of that market to come to us. And I think that's the opportunity for Lupin. I think in the first year, this is 50 crores plus. It just depends on how much the market takes, how much it grows. We'll find out soon. But clearly, our team is very excited.
Okay, all right. Just quickly, Vinita, there is this Section 232 investigation still on pharmaceutical companies. Do you think that is a big overhang, and how should one look at it?
So far, all of the read that we have got from the stakeholders in DC has suggested that that everyone understands the need for affordable medicines and generic medicines that are over 90% of the prescriptions in the U.S. They understand the implications of cost increases on generic drugs, the potential for market disruptions, which no one wants to see. So everything that we have heard so far is, while the investigation is still not concluded, that generic drugs should certainly be exempt from any tariff impact. Now, that's hard to predict for certain, but that's what we have heard so far.
Okay, that's an interesting conversation with the management of Lupin, but it's time for a break now. Up next, Manisha Gupta will connect with Surendra Mehta, Secretary at India Bullion and Jewellers Association.
Fly Emirates.
Welcome back, and let's talk about precious metals now, which continue to be quite volatile. If you look at the gold silver prices, we saw gold decline 3%, silver down 10% in the overnight markets. But that decline is getting bought into slightly. But what is it that the markets should watch out from here? For that, we're now joined by Surendra Mehta. He's Secretary at India Bullion and Jewellers Association. Mr. Mehta, hi, thank you so much for joining in. I'll start with silver first, and the volatility there seems to be much higher than what we've seen in various other asset classes from where we stand. At these 75 to 85 of a range that silver seems to be making in the last couple of sessions, how are you looking at prices going from here?
First of all, we'll have to understand that silver will remain very volatile for a few more days. There is in fact, the next week is a holiday week. Monday, US markets are closed. There is China markets are closed for next 1 week because of New Year. Then there are holidays in Singapore. There are holidays in Brazil, South Korea. So it's basically a holiday week. And I think silver is going to remain volatile for the next 1 week. I personally feel that yesterday was not enough. There can be more paper dumping on silver in the next 1 week. This has also been because of the news by some news agency that probably Russia is trying to renegotiate with America regarding the trade in the dollars. But anyway, I don't buy with those news because they are only considering and there are no confirmation from Russian side on this.
So when you say there's more profit taking coming in for silver, what kind of levels are we looking for then in the worst case scenario on the lower side?
In the worst case scenario, I think $64 it can see again, maybe between $64 to $68. Silver will remain volatile for some more times because probably the gold-silver ratio is not getting adjusted. Earlier, the gold-silver ratio initially was 80, it declined to 50. Now it is again back to about 60, 62. I think first gold should move up and then only silver will start moving up. It may take maybe another week or so or another 10 days. But I'm still bullish on gold and silver both.
If you look at the previous quarter and previous year for that matter, Mr. Mehta, we've seen investment demand give a very stiff competition to jewelry demand in a market like India where jewelry buying is premium quite. But if you also look at various jewelry companies which have been posting their results, their quarter numbers have been on the higher side, quarter on quarter, year on year as well. So the jewelry demand really hasn't gone down in volume terms slightly, but value terms, all of them have posted very strong numbers.
No, Manisha, I disagree with what you are saying. Most of the jewelry companies are doing their stock valuation on the basis of weighted average, by virtue of which they are forced to pay a lot of taxes. And I think it is only the accounting issue because of which they need to pay more taxes. The volume, in fact, has gone down. Because of the rise in prices, the value-wise, the turnover are seeing much higher. But overall, let me tell you, the market is in a very, very bad shape. Unorganized sectors are seeing drop of almost 60% in their sales. Organized market, in my opinion, should be seeing about 25% or 27% drop in their sales.
This you are saying in sense of what?
I don't understand why share prices of these companies are going up. I think the equity analyst would be a better person to answer.
How are you looking at the jewelry demand gaining from here, though? Because we've seen prices come nicely off from its all-time highs. And then you have a Valentine and a Women's Day and Gudi Padwa, Akshaya Tritiya, all of that coming in the next 2 or 3 months. Would you say some buying could come in because of these correction in prices?
Yes, the buying could come in. Probably if the gold prices remain stable, then only buying is possible. If the gold prices continue to be volatile between 140,000 to 180,000, then at that point of time, consumer keeps waiting for prices to further fall or to further increase them, and he stops buying at that moment. We have seen a lot of buying happening at 180,000. But after 180,000 rupees, the gold dropped in India to 138,000 and buying suddenly stopped. Now people are waiting. If the prices get settled near 155,000, I think a good buying opportunity or a lot of customer will come out in the market to buy the gold during this Valentine's Day and other festivals.
Just matching numbers here then, Mr. Mehta, if you look at the ETF buying as well, and most of the ETF buying, all of the ETF buying that India does is backed by physical gold and silver therein. So there have been various numbers doing rounds on how we bought nearly 100 tons via ETFs in the month of January, while silver, of course, was much higher. Would you say investment demand, whether it's physical, bars and coins, and then plus ETFs, seems to be right now stacking higher than what jewelry is done?
I think people are understanding with the almost zero profit in last 1 year from the equity market. People are trying to reallocate their portfolio and are trying to shift some of their portfolio to the commodities, and of course gold and silver is always a preferable in that case. So I think this is just the beginning. What we are seeing is a lot of investment demand coming through an organized sector like ETF and digital gold. I personally feel that 24,000 crore was just a number for January. We might see more and more ETF demand, gold ETF demand coming in the year 2026 and 27.
All right, absolutely. One final question then, Mr. Mehta, and this is on the prices. You said buying on dips still is a good strategy when it comes to gold and silver. So what's your sense on where could we be closing this calendar year 2026?
I still think that $5,900 to $6,100 gold will be an achievable target. Of course, one has to be ready with 10-12% correction at all points of time in respect of gold. And for silver, my target would for 2026 is between $155 to $165. Of course, get ready for correction, maybe 15 to 20% at any point of time in between.
$5,900 an ounce for gold and 150 to 175, did you say?
155 to 165.
165, all right.
Wow, okay. We'll keep watching out for these prices only all this year. That's going to be our goal. But thank you so much, Manisha and Mr. Mehta, for joining in today with your take on precious metals and the outlook going forward. Time for a break. When we come back, we'll connect with the management of Biocon Biologics to decode their Q3 numbers. Stay tuned for that.
Fly Emirates.
Welcome back. Well, the mid-caps are underperforming the benchmark, but there are a couple of stocks which are buzzing on the upside. GE Power is one of those, which is up around 18% as we speak. The other one is EIL. That stock is up 14% in an otherwise weak market. Gokuldas Exports is up 8.5% since the US-India trade deal contours were announced. This stock has been buzzing on the upside. Apex Frozen Foods is the other one, which is a beneficiary of this deal. We do have AB Fashion and Retail as well, which is doing well in trade. And these are some of the names that we are tracking very closely. On the downside, you do have certain names, but they are largely from the metals pack because that is the index which is the top loser. That index is down around 2.5%, followed by the realty index. The CPSE pack also not doing so well. So this is largely the texture of the market. There has been some recovery in the IT pack, but it continues to be a down day. And earnings, we are towards the end of it now.
Yes, absolutely. It's a busy day for the pharmaceutical space. Biocon Biologics reported what was an operationally in-line set of Q3 numbers. Revenue came in lower. However, I did catch up with Srihas Tambe, who's the MD and CEO of the company, and began by asking about the quarter gone by and how they see pressure on the biologics segment. Listen in.
We've seen growth, which has been a phenomenal growth in terms of how it's grown on a 9-month period, which ended December. But also, just going back to the question you asked, for the particular quarter, we saw 9% year-on-year on the revenues, but we've seen a much higher growth on the EBITDA margins, which is over 40% growth, which took us to 28% EBITDA margin this particular quarter, which is clearly because we focused on high margin markets this particular quarter. Given that we were preparing ourselves for the new launches. Now, if you would have tracked us, you would have seen that we've got multiple product approvals in the last several quarters, and we're looking to scale those up in fiscal 27. So we'd upgraded our facilities. So there's that revenue growth that you've seen, and then you've seen now a good, strong, high margin growth this particular quarter. On a full year basis, we expect it to be in the mid-20s, which is the window that we've guided for. So pressure, probably yes, but then opportunity far more is how I would categorize.
Well, liraglutide, that has been one of your big launches in the GLP-1 space. How did that?
Again, here is something where I would like to give credit to our genetics team, which has really built up that business, developing peptides from a very early start that we've had, getting approvals. We were the first to get approval in the UK. The first to launch. Now we've had a very successful launch in Europe, Germany in particular. That particular product has seen good demand. We are seeing approval coming up shortly in the US as well. And in this particular quarter that you just referred to, liraglutide has shaped some of the business growth that you're seeing in several emerging markets. As the product gains traction in big emerging markets. We expect growth to be driven in the generic space, not just by Lira, but also by Sema as we go forward into 27 and beyond.
Okay. Are you launching semaglutide in India in the first wave?
Oh, that's a question that probably everyone has been asking everybody that you probably talk to. And there are several people in the business, in the industry who are doing it. We're certainly developing it. We're very strong in that space, and we also have, as they say, a horse there. But the thing is, we've already looked to partner in the Indian market with those players who have far greater reach than we've had. We did that when we partnered our insulins business last year for the biosimilars. We look to do that with our GLP-1 so that we can bring these products to several people in the country as we go forward. But there are several other markets where we have our own field force, boots on the ground, and those are markets where we will bring the product direct to patients.
Just wanted to get your thoughts in terms of the debt on books now. It was around $1 billion the last time we spoke. What is the comfortable leverage that the street is working with or Biocon is working with at this point in time, and the plans to reduce?
Yeah, I think the way to look at this and the lens that you would rather use is not the absolute number, but the way to look at it is when we actually did incur that acquisition debt, transformative, but still acquisition debt, was at a ratio where the debt to EBITDA ratios were at 4 or 4.2x or 3x of where we were. So the debt to EBITDA ratios were over 4.2x at that point in time. At this stage where we are after the fundraise and all the efforts that we've put in and the business that has shown tremendous growth over the last 3 years, we are at 2.5x, which is a very different space to be in than to be at over 4x at that point in time. So I believe that the debt to EBITDA ratio levels are already trending in the direction where we are far more comfortable than we were 2-3 years ago. And we've already guided that it would go below 2 and closer to 1, which would really be a very, very comfortable place for any company of our size and scale to be in.
All right, that's the word coming in from Biocon. With that, we'll slip into another break. Up next in our What's Trending segment, Rima will focus on the IT sector, which is under pressure.
Fly
Welcome back. Well, in our What's Trending segment, markets are under pressure with the Midcap seeing cuts, but they have recovered from the day's low. The IT index continues to see pressure with the Nifty IT index now having lost around 8% at current reckoning this week and around 14% odd for the year. We have Rima with us to take us through the latest on the AI-driven IT sell-off. Rima, over to you.
Thanks so much for that. So the Nifty IT index is staring at one of its worst falls in recent histories. At the session low today, the Nifty IT index had seen a fall of 11.7%. And that would have meant the steepest weekly decline in 6 years, last seen in March of 2020, around the time of COVID. Since then, of course, the index has recovered. But just in the last 2 days, to give you a sense of the intensity of the sell-off, IT companies have seen a decline of 3 lakh crore in market capitalization. And year to date, the damage across the IT companies has been very, very significant. So, for instance, TCS, Infosys are down nearly 17%. Wipro has seen a fall of close to about 19%. And the pressure that we've seen today also resulted in many IT companies across market capitalizations hitting fresh 52-week lows today. So you had TCS, Infosys also hit a fresh 52-week low. Since then, it's managed to recover, but a Wipro, Oracle, LTTS, Tata Tech, Cyan, Mastech, Firstsource. So it's a long list of IT companies hitting fresh lows. Most of these stocks, and now if you look at the large cap screen, are down about 30 to 40% away from their all-time high levels. TCS and Wipro particularly down in excess of about 40%. But some stocks have been resilient, and there's still some distance away from the 52-week highs. And they include, say, an LTI Mindtree, it includes a Persistent, a Tech Mahindra, Birla Soft. These are stocks which actually are still reasonably away from their 52-week low. The fear in the market is earnings compression, PE derating, but as you can see, after the steep sell-off, there is a bit of an intraday recovery taking place. JP Morgan came out with a note today, and they're saying that if you look at the valuations of IT company on a free cash flow or a dividend yield, it is at scream deep value, and these were levels which were last seen very significant market dislocations like a GFC and COVID. So they're making a case that valuations, at least for now, appear to be at maybe close to rock bottom. Back to you.
Okay, thank you so much for explaining that to us. IT continues to be the big talking point this entire week. Let's slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side.
Welcome back. You're still tuned into Halftime Report on CNBC TV 18. Well, it's turning out to be a day where we are seeing some amount of a mild recovery which has taken place for the mid-caps. Let's see whether that sustains or not and whether there's any more buying at lower levels. Specific stocks continue to bleed. So Hindalco is reacting very negatively post its Q3 numbers. That stock is the top loser on the Nifty, down around 4.8%. And giving it company is HUL, which is down for the second day in a row. So that one is down around 3.3% post numbers. Eternal has had quite a choppy week and a couple of trading sessions, so that stock is down around 3% at this point. It's probably going to go home with just about mild gains of around a gain of 1.6%. But that's all the time that we have on the show. Stay tuned. Business Lunch will take all the action forward.
Stocks see a sharp slide with IT stocks getting battered after a slump in US tech names overnight. Midcaps also feel the heat as risk aversion spreads. Realty and metals are the other big losers. A recovery in Novelis is a few quarters away, Hindalco MD Satish Pai tells CNBC TV 18. Though he expects FY27 to be better, a sell-off in metals and a step-up in debt also weigh on the stock. Axis Bank CEO Amitabh Chaudhary says acquisition of Credit Access Grameen is pure speculation. He, however, adds that the bank is in early evaluation stage of the opportunity and a decision has not been taken to pursue or opt out. CNBC TV 18 had reported that evaluation for a possible deal was on. While the IT sector has seen a sharp and indiscriminate sell-off, the former CEO of Infosys, Vishal Sikka, says that there is a gap between AI's promise and enterprise-ready reality. Sikka says while some disruption will hit now, others will take years to show up and will all differ company by company and line by line, but warns don't assume slow adoption means no disruption. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan. Good afternoon, guys. Let's take stock of where the markets are at today. It's all red across the screen. And if you take a look, the Nifty at 25,545, not at the lowest point of the day, but, still 1% in the red. The Sensex, same. Midcap index is faring worse than those benchmark indices. But the Nifty Bank, slightly better, doing slightly better, but also 0.7% in the red. But if you take a look at those stocks that are lagging, it's the metal packs on top. And if you take a look at that index, we've got Hindalco, Hinzinc, and NMDC, all of them down between 4 to 5%. If you take a look at Hindalco, that's reacting negatively to its numbers, seeing big cuts over there. The realty pack is also feeling pressure. Prestige, DLF, and Brigade seeing deep cuts down about 3% each. But the IT stocks, we were seeing some recovery there, but that's also been sold into. And if you take a look, all of those stocks under pressure, L&T Tech Services, Coforge, TCS, all of them down between 2 and 5%. And that remains the top story this afternoon. Indian IT stocks continue to see sharp fall for the third straight session. The IT index sold off about 14% in the last 7 trading sessions as concerns over AI-led disruption continue to weigh on sentiment. Earlier today, we spoke to Vishal Sikka, the founder and CEO of VNI Systems, on the AI disruption fears, and here's what he had to say.
Things are always slower than we expect. Adoption takes time. Enterprises are very complex. They are like countries, large companies. So it takes a long time and even in terms of autonomy, there is a lot of still advancements to happen. Similarly, in the services industry, there are dozens of service lines. AI's impact on those service lines is not all uniform. It is not, doesn't happen overnight to all of them. Some systems are much more complex than others. And so the rate of change is always as slow as the slowest pipe in the network. But having said that, I used to say this 10 years ago, 9 years ago, whenever that was. And it is here now. And we have a short window of time in which to sort of transform. I think we have to separate the potential, the promise, if you will, of this disruption from how it impacts in the here and now. In the here and now, you have particular projects that people are executing on. And if a client expects that you now do this project dramatically faster or cheaper or with less people or whatever, then that would impact the here and now. But that is something that takes time. That's what I meant by depending on the service line, depending on the nature of the work, depending on the team that is involved, and things like that. So there is the fear in general of the potential of what this can do to knowledge work. But then there is the actual reality of creating an enterprise-ready offering that uses these new capabilities to deliver those. So there is a gap between them. The gain in productivity because of using generative AI can be quite substantial. I have seen examples of 20, 30x productivity gain and things like that. The important thing is that do we want to keep looking backwards? Do we want to keep looking at tasks that we already do? And do we want to limit ourselves to what we did in the past? Do we want to be afraid of the disruption and automation to the things that we did so far that brought us here? Or do we want to look at the opportunities of what are the new things that I can do with what we have in our hands? And I think, I focus much more on the latter. I have a small company, and life is a lot more interesting when you think about, my God, we have this incredible ability. What can I do with it? And I think when I look at it from that lens, it is incredibly exciting.
And even as global IT stocks plunge on fears of disruption by AI, capital continues to flow into generative AI companies. Anthropic, in its latest funding round, has secured $30 billion in investment at a valuation of $380 billion, more than double the valuation secured in its previous funding round in September. The latest round included portions of previously announced investments from NVIDIA and Microsoft, which amounts to $15 billion. This development comes after the latest Claude plugin was released, which can automate parts of the software development process, and revenue from Claude has also doubled since the start of 2026. And moving on, Axis Bank CEO Amitabh Chaudhary says acquisition of Credit Access Grameen is pure speculation. He, however, adds that the bank is in early evaluation stage of the opportunity and a decision has not been taken yet. Listen into his comments.
We will obviously evaluate this opportunity also, but we are in very, very early stages of the evaluation. We have not even decided whether we'll take the next step. But no, I mean, MFI is an important business. We've been building that business for quite some time. We have been trying to see how we can transform the business internally. Here, the question is whether you want to spend a chunk of money to buy a business from outside with all the, accompanying execution risks, or you want to build it internally. And that's a choice we will make at the right time. We are not in a hurry, absolutely.
Meanwhile, Muthoot Finance sees sharp cuts despite a strong set of third-quarter numbers. The management, speaking to CNBC TV18, also raised its guidance for FY26, saying it now eyes 45% growth versus the earlier guidance of 35% growth in FY26.
This quarter, the first 3 quarters have been good growth. We have seen in the last 3-4 quarters have been quite good. We have already grown the gold loan AUM by 36%. I feel that we should be able to do around 45% by the end of the year. We should reach that by 45% by end of the year. So that is, I think, something which we plan to achieve by the end of the year.
And before we slip into a break, here's a quick sneak peek into the stocks that we will address on Your Stocks today. Don't forget to catch fundamental and technical experts give their views on these at 2 p.m. today, only on CNBC TV18. Welcome back. You're still with us on Business Lunch. India's January CPI, as per the new inflation series, has come in at 2.75% versus 1.3% in December per the old series. Food inflation has risen by 2.13% after 6 months of falling food CPI as per the old series. Lata Venkatesh is here with all of those details. Lata?
Well, countries revise their CPI series so that you bring it in line with current consumption trends. So that is why we had to revise the series. It was earlier based on the 2011-12 consumption pattern. Now the base year has become 2023-24. This is needed. Now, what does the new CPI throw? January CPI, as you said, is 2.75%. If you gave the same weights to the old CPI series, then it would have been 2.55. So analysts are concluding that for FY27, the inflation may be 10 to 20 basis points higher in the new series compared to what it would have been if we had continued with the old series. Now, let me come to food inflation at 2.13 is a surprise because everybody was expecting food prices to continue to fall. The rise is because weights have changed within the food basket, and 3 products were really expensive, and that is tomatoes, coconut and coconut oil, and that explained the rise in food inflation. The surprise was the steep fall in core inflation. Core is non-food and non-fuel goods. And in the new series, it has come to only 3.4% in Jan 26. The old series was expecting it at 4.1 or 4.2%. So that is clearly lower. The likelihood it is lower is because the weightage of gold is less. Gold is an important element in core CPI, but it's come down from 1.08% weight to 0.6% weight. The other big change is the way in which they are computing housing. In the old series, there was nothing on rural housing, no prices. As well, employer-given houses, that is government houses, even those were included while counting the index. Now those two are excluded. Those are the big changes.
All right, thanks for taking us through those big changes, Lata. But let's listen into what the Secretary of Ministry of Statistics had to say on the new CPI series and its impact.
We have released the numbers for the last 12 months for the entire 2025 of both the old series and the new series. So you have a month-to-month comparison of the old series. And to link it to the previous series, which started in January 2013, we have given a linking factor. And we are following strictly the international norms in this, that the linking factor is given to get an idea of what would have been the changes and how to link the new and the old series. The actual number of 2.75 also reflects the actual prices. Month to month, the prices of different items vary, as would be seen in the details. Prices of a lot of the food items were still in the negative territory. There were some which were in the positive. But I think this time, the inflation numbers have been influenced by some of the personal care and the personal jewelry, which has had a higher inflation.
The RBI on Thursday announced it is switching some of its near-term bonds with the government in exchange for longer-term bonds. 75,504 crore rupees of bonds redeeming this year and next are being bought back by the government from RBI, and new longer-term bonds have been issued back to the Reserve Bank. Lata is here to explain what this means.
Well, the Reserve Bank and the government do this often when they want to reduce the burden of the borrowing program for the next year. Bonds that are about to be redeemed in the coming year are exchanged. The date simply changes from 2026 to be redeemed in 2040. So to that extent, the government does not have to pay RBI. That's why this switch happens. To give the arithmetic, government is buying about 58,500 crore of bonds which are maturing in 2026 and about 17,500 crore of bonds which are maturing in 2027. And together, it's about 75,000 crores. In exchange, the government has issued Reserve Bank 15-year bonds which mature in 2040. So to that extent, the government borrowing comes down for the coming year, that is FY27. It comes down from 17.2 trillion to 16.45 trillion. Now, this is very good news for the bond market because, they were staring at a really huge borrowing and now that is down. So early morning, we did see bond prices rise and bond yields fall by about 4 or 5 basis points. But as the bond prices rose, many people who had the old bonds came and sold it, and there was a lot of profit taking. The market is telling you that ultimately we have to buy even 16.45 trillion of bonds. That is smaller than 17.2, but that is still a large borrowing program. So the profit taking, took away the little bit of gains that we got.
All right, Lata, many thanks for taking us through those details. But on that note, it is time for us to head into a short break. More news and updates coming up on the other side. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're still with us on Business Lunch. Moving on to the latest global developments, President Trump said the United States has to make a deal with Iran. Otherwise, it would be traumatic for Iran. He warned of consequences for Iran if they don't make a fair deal and thinks an agreement could be struck over the next month. Take a look.
We have to make a deal. Otherwise, it's going to be very traumatic. Very traumatic. I don't want that to happen, but we have to make a deal. They should have made a deal the first time, and they got Midnight Hammer instead. And this will be very traumatic for Iran if they don't make a deal. Look, if they don't make a deal, then it'll be a different story. But we had a very good meeting yesterday with Bibi Netanyahu, and he understands. But it's ultimately up to me. If the deal isn't a very fair deal and a very good deal with Iran, then it's going to be I think, a very difficult time for them in the back. I guess over the next month.
Let's get you updates on the results of the election in Bangladesh. The Bangladesh Nationalist Party has returned to power after nearly 20 years, sweeping the general elections with a commanding two-thirds majority. Counting indicates that show the BNP and its allies crossing 212 of 299 seats, while the Jamaat-e-Islami bloc trails with around 70. The Election Commission's partial numbers place the BNP at 181 seats, with full results expected shortly. So we'll have to wait and watch what happens over there. But before we end the show, let's take stock of where the markets are at. They're doing better than when we started the show, but the Nifty still at 25,550, not at the lowest point of the day. The Midcap index faring worse than the Nifty and the Sensex, but the banks managing to do slightly better. If you take a look at the indices, we've got that metal pack that's lagging quite a bit. If we bring up Hindalco for you, it's one of the top losers on the Nifty, and it's about 5% lower, reacting negatively to its numbers. And the Realty Pack also not doing well in trade today. But if you take a look at the IT Pack, it's been under pressure. That's what's been pulling the markets lower. We've got L&T Tech Services, Coforge, TCS, all of them down between 4 and 2%. But we are seeing some amount of recovery. If you take a look at Tech Mahindra, Persistent Systems, and Emphasis, those three stocks have managed to turn into the green. So all three of them mildly in the green, but seeing some recovery on that front. But with that, it is a wrap on this edition of Business Lunch. Midcap Radar comes up next and takes all the market action forward.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Ekta Batra. Continues to be another down day. The IT decline continues. Today, metals also taking it to the chin. But other than that, mid-caps, they are largely outperforming the benchmarks.
Hi, Sonal. Yes, absolutely. You know, it's been a down day for the markets, and for the IT index, it's lost around 8% on a week-to-date basis as well. Just giving you an indication in terms of the kind of sentiment which is really dominating the entire IT space at this point in time. But for the markets overall, the Nifty is at around 25,550 odd. We have the advanced decline ratio, which has not shown any kind of respite through the trading session. So currently stands at around 1,300 stocks advancing to around 2,800 stocks declining. But let's get to our segment of the first segment on Midcap Radar, which is Midcap Movers. We have Gaurav with us to take us through all of the broader market stocks that are moving around in trade today. Gaurav, it's a dull day in terms of the key indices, but tell us about specific stocks.
Well, yes, indeed, it is a dull day for the market, but let's understand and let's see the companies who are still actually outperforming the market today. And we've got companies like GE Power. You also can look at Engineers India. If you look at the stock performance, it is up 13% because they reported very good set of numbers. Profit more than doubled for this year on a year-on-year basis. Apart from that, let's also not forget about TVS Supply Chain. Now, this stock is not only up today, but in the last 5 days, the stock has gone up almost by 30%. Physics wala and Purvankara is also actually reacting on the back of the good set of numbers that they have delivered. Apart from that, we are seeing exporters who are again turning into green in a day today. So we've got companies like Gokuldas Exports, KPR Mills, Vardhaman Textile and Apex Frozen Foods. All of these companies are actually in green, up more than 5% in a day today. On the losing side, let's not forget about Muthoot Finance. Now, the company actually delivered good set of numbers. They also upped the guidance for their AUM growth. But despite that, we are seeing a profit booking in this company. The stock is down 11%. And then we've got companies like RateGain, where we saw profit actually decline almost by 50%. Cohance Life Science, there also we saw margins decline, EBITDA margins, and that is something which is pressuring the stock right now. And Carstate. Lastly, let's also not forget about the IT pack, as you mentioned, because most of the IT companies are in red. And we've got companies like Coforge, KPIT Tech, Tata Elxsi, Newgen Softwares, Birla Soft still in red and down more than 2%. So let's see if there is any revival in the IT pack. But at the same time, we have got gainers as well. And as you suggested, mid-caps currently at least outperforming with marginal gains to the broader market in a day today.
Okay, all right. Thank you so much, Gaurav, for joining us with all those names. It's a good time to get a technical check on the markets. Shrikant Chauhan of Kotak Securities is joining us now. Shrikant, every day it's another low. We are now down 267 points in the Nifty, above the 25,500 mark though. What are you suggesting? Do you think we could see further moves on the downside? What's the support level now?
Good afternoon, Sonal. Good afternoon, everyone. So, yeah, the market has broken all its important level, like 25,800, and today it is failing to sustain above the levels of 25,600. In fact, if we go through with the option statistics, then there is good amount of call writing has happened at 25,600. So till the market is not crossing 25,600, we can see further more weakness in the market and we need to be careful. But yes, side market or maybe the broader market is doing well. And based on that, we can take some stock specific trade in this market. But for index, I think till the market is not crossing 25,600, we need to be careful.
Okay, all right. Till the market's not crossing 25,600, we need to be careful. So yes, there's definitely that amount of resistance which is coming through. But Shrikant, I'm sure you've been chatting with your clients through and through about the IT stocks. So what are you recommending on that?
Say for IT, most of these stocks have fallen to their extreme levels, and today's lowest level certainly going to act as major support for the market, because today the way they have fallen and now they are recovering from the lows, somebody must have taken active interest in the IT sector. But the way they have fallen, I am of the view that at higher levels we need to be careful and we should look for reducing some position instead of buying at these levels and trying to take any short-term trade. So it is better to reduce position at resistance level instead of buying at maybe we can say it is like advisable to avoid catching falling knife.
Okay, that has been the word on Nifty IT in general. Any individual technical picks, Shrikant?
So for individual pick, yes, number of stocks, they are doing well. They are recovering from their lows, and most of these stocks have crossed their important levels. We like Biocon. It is like in the range of 380 and 400 for last almost 6 months. And whenever there is a fall below 370, we saw active buying interest in the stock. After the result, I am of the view that the stock is stabilizing and it is heading for the levels of maybe 400 in the near term. So it's a buy at current levels with a stop loss close to 370. The other stock on which we are bullish is from the metal space. And in that specifically, if you see all these steel stocks, they are doing really well. So in that specifically, we like Jindal Steel and Power. There we have a bullish view. Currently, it is around 1200, 1190. But while looking at its technical pattern, I think it is heading for the levels of 1300, and we can keep a stop loss around 1160 for the same.
Okay. All right, Srikanth, we're going to let you go on that note. Thanks very much for joining in and taking us through all of those views in terms of the technicals. We'll take a short break, but up next we'll connect with the management of Ingersoll Rand India to decode their Q3 numbers. Stay tuned.
You want to talk business? Meet me in the onboard.
Welcome back. Well, for the markets, it's a weekday, we'd have to say. So the Bank Nifty, which was fairly resilient in yesterday's trading session, is also seeing profit booking today, so down around 0.7%. Those are the IPCA lab numbers for you. The EBITDA is up around 15% this quarter. The revenue has grown around 6%. Margins have expanded around 200 basis points for IPCA this time. So 22.3% is where it's come in at. So overall, looking like a decent set of numbers operationally. The profit also doing well this quarter for them, up over around 30%. But let's focus a little more on the entire pharmaceutical space. We had Biocon, which came out with its numbers earlier today. And a couple of key takeaways is that the company has said that the biologics business, what really stood out was not really the revenue growth, but what they saw in terms of the margins this quarter. So they focused on the high margins, high margin geographies this quarter, and that resulted in a margin uptake in the biosimilar business. Separately, they do expect erosion in the legacy products in the generics business going forward. They've seen a successful launch in for liraglutide, which is one of the GLP-1 drugs in UK, Germany. They were one of the first companies to, in fact, launch it in UK. And there is a launch coming up in the US as well, so that will be something to watch out for. And they expect growth within the GLP-1 space to be driven by liraglutide as well as semaglutide. When it comes to semaglutide, which is basically the generic version of Wegovy, they've looked to partner with companies in the Indian market which have a far greater reach. And that is basically how they would be approaching the semaglutide opportunity at this point in time. They do have partnerships, for example, with Ajanta Pharma as well in some markets. They have raised around $1 billion in terms of fundraising successfully in just the past few months, that is via 2 QIPs. So the company has indicated that overall the debt to EBITDA, which was at one point quite high at over 4 times, has come down to around 2.5 times. The focus is to bring it below 2 times and then eventually close it at around 1 time. So those were a couple of key takeaways from the Biocon management at 0.6%.
It is actually, it is one of the big movers in an otherwise weak market. Thank you for explaining that to us, Ekta. And you know, while talking about result reactions, we've gotten some on the opposite side as well. Muthoot Finance, for instance, was one of those stocks which reported good set of numbers. In fact, management on CNBC TV 18, they did raise their guidance from 35% to 45%, and they 35% to 45% in terms of AUM growth. Despite that, the stock is down around 11.5%. The commentary was strong, the numbers were strong. Despite that, the stock is seeing some profit booking. That's the texture of the market. Let's do one thing. Let's listen in to what the management had to tell CNBC TV 18.
This quarter, the first 3 quarters have been good growth. We have seen the last in the last 3-4 quarters have been quite good. We have already grown the gold loan AUM by 36%. I feel that we should be able to do around 45% by the end of the year. We should reach that by 45% by end of the year. So that is, I think, something which we plan to achieve by the end of the year.
Okay, and that's Muthoot Finance. That stock really hammered in today's trading session, down around 11%. But the other space which is not seeing any kind of respite is the entire ETF space. So the Tata Silver ETF is down around 5% at this point. We have the Nippon India Silver ETF, which is down around 5% at this point. So remember that both of them have respectively lost around 22% and 18% on a month-to-date basis. So it's been a very, very volatile session for the silver ETFs, and that seems to be continuing. We'll take a short break, but a lot more on the markets once we're back. Stay tuned.
You want to talk business? Meet me in the onboard.
Welcome back. You're still tuned into Midcap Radar. It's a lot about earnings. We are towards the fag end of the earnings season. Hunasa is gaining a trade after reporting good set of quarter 3 numbers. Manglam is joining us now to tell us what worked this time around. Manglam.
Well, a couple of things that worked for the company. You know, if you look at the overall revenue growth of them, close to around 17%. And if you adjust for the settlement that they had made with revenue recognition in Flipkart, it's actually a 20% plus revenue growth that the company has done. And add to all of this, the operating leverage is playing out. So the EBITDA jumped from 26 crores all the way up to 65 crores. And the highest margin that the company has reported ever since listing, so closer to 11%. And to that as well, the management said that they will go ahead and perhaps see a 100 basis points improvement from these levels as well. The net profit has nearly doubled from 26 crores all the way up to 50 crores. If you add the adjusted, exceptional loss on account of labor code, then it is an even bigger beat than a 100% jump on the bottom line. All these factors led by a 30% underlying volume growth. Their key business, which is the Mamaearth business, growing upwards of 25%, Dermaco reporting nearly double-digit EBITDA margin, and the newer brands growing upwards of 25% as well. All these factors working well for them. The only fly in the ointment, however, is that the stock has already seen a big correction from the top, and it's still below its IPO price. So every time it makes a dash towards the issue price of 324 rupees, perhaps some supply comes by, and as a result of which, every time the stock moves towards the 320 mark, as we can see in today's chart as well, the stock sees some supply at the top. Currently holding with a gain of almost 4%, but as it moves towards 320, let's keep an eye out on how the price behaves.
Okay, all right, Mangalam. Thanks very much for that. And let's move on to the top story that we're tracking. Indian IT stocks continue to see a sharp fall for the third straight session. The IT index has sold off about 14% just in the last 7 trading sessions as concerns over AI-led disruption continue to weigh on sentiment. Earlier today, we did speak to Vishal Sikka, founder and CEO of Vinay Systems, on the AI disruption fear. Listen in.
Things are always slower than we expect. Adoption takes time. Enterprises are very complex. They are like countries. Large companies are like civilizations. Some of them have been around for, hundreds of years, if not decades. So it takes a long time and even in terms of autonomy, there is a lot of still advancements to happen. Similarly, in the services industry, there are dozens of service lines. AI's impact on those service lines is not all uniform. It is not, doesn't happen overnight to all of them. Some systems are much more complex than others. And so the rate of change is always as slow as the slowest pipe in the network. But having said that, I used to say this 10 years ago, 9 years ago, whenever that was. And it is here now. And we have a short window of time in which to sort of transform. I think we have to separate the potential, the promise, if you will, of this disruption from how it impacts in the here and now. In the here and now, you have particular projects that people are executing on, and if a client expects that you now do this project dramatically faster or cheaper or with less people or whatever, then that would impact the here and now. But that is something that takes time. That's what I meant by depending on the service line, depending on the nature of the work, depending on the team that is involved, and things like that. So there is the fear in general of the potential of what this can do to knowledge work. But then there is the actual reality of creating an enterprise-ready offering that uses these new capabilities to deliver those. So there is a gap between them. The gain in productivity because of using generative AI can be quite substantial. I have seen examples of 20, 30x productivity gain and things like that. The important thing is that do we want to keep looking backwards? Do we want to keep looking at tasks that we already do? And do we want to limit ourselves to what we did in the past? Do we want to be afraid of the disruption and automation to the things that we did so far that brought us here? Or do we want to look at the opportunities of what are the new things that I can do with what we have in our hands? And I think, I focus much more on the latter. I have a small company, and life is a lot more interesting when you think about, my God, we have this incredible ability. What can I do with it? And I think when I look at it from that lens, it is incredibly exciting.
Okay, that is the big story. We'll keep getting you more reactions on what AI could mean for IT services. But for now, we'll take a leave on this edition of Midcap Radar. Stay tuned. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Arundhati. As always, Arundhati, good afternoon. And today is not a day, it's more of a freaky Friday. But
absolutely,
some recovery in the IT from that fall. 11% fall almost I saw for the week to date for Nifty IT this week. And as of now, some bit of a recovery. If you would pull up the Nifty IT, it's seen a recovery from the day's lowest points. That will be interesting now to see, given the AI stocks fall across the globe as well. So that is something we're watching out for. But other sectors also are not doing well today. You know, most of the sectors today are trading in the red. Actually, all of them today are trading in the red as well.
All of them in the same colors as what you're wearing today. So we've got that metal pack.
I decided to twin with them. Huh?
You clearly did. So good afternoon to everybody, but not for the markets per se. But the metal stocks also, you know, feeling the heat. All of those stocks under pressure. We've got Hindalco, which is down about 5% in trade, if we can bring that up for you. And it's reacting negatively to its earnings. And then apart from the metal pack, we've got those realty stocks as well that are feeling the pressure. So all in all, almost all the sectors in the red. Sensex and Nifty about 1% lower. But let's get to our queries then. Joining us today are independent market expert Shaina Mukaddam and Vaishali Parekh, the Vice President Technical Research at Prabhudas Leeladhar, to answer all of your stock queries. Good afternoon, ladies. It's great to have you on the show today. But, you know, let's get straight to our first guest, our first query of the day. Sakaria writes to us from Kerala. He holds 1,000 shares of Z Entertainment at 112 rupees. He says he can hold the shares for 6 more months. Wants to know the outlook on the stock. So, Shaina, let me start with you. Can you tell us what the outlook on the stock is for today?
Well, see, for the longer term, I think Z in terms of valuation looks pretty attractive. It's just about 10 times EV by EBITDA 1 year forward. Having said that, the investor queries for the shorter term. So for a 6 month, I think it could be volatile, but I will still recommend to continue to hold because, you know, Q3 numbers were a bit mixed. You saw advertising revenues a bit depressed in terms of growth, but they're doing very well in their digital vertical of the business. And there, I believe the overall strength is going to be much better going forward. They have turned, you know, the losses into profits. In terms of EBITDA. So I would say that you continue to hold Z. The only issue out here is that the low holding of the management. They have a very small percentage in terms of equity, which also could throw up an M&A activity possible for the longer term in Z. I will take the risk and suggest continue to hold.
Okay, continue to hold. You would take the risk there. On the technical front, Vaishali, good afternoon. Would you take the risk as well?
Hi, very good afternoon, all of you. I would say actually purely on technical terms, the stock is really corrected. When I'm looking at the weekly chart as well as the daily chart, we've seen from the recent data of 140, the stock is corrected. And we see the stock now showing signs of bottoming out at 80 levels. And from there on, and especially today, we are seeing very good volume, good pickup, good bullish candle. So I would say hold on. And if you want to average out your cost, do add more at 90 levels because I see this stock can go towards 110 to 115, which is nearly the cost. So to better your price, I think one can average out.
Okay. Average out, better price, and one could average out there. That's the word on the technicals. Let's move on then to the next query. We have Vijay Kumar, who's writing to us from Bangalore. He's holding 240 shares of IndusInd Bank. Price is 991 rupees per share, making a bit of a loss on this one. Wants to know the prospects of the stock for the next 1 year. Shaina, 1 year view for IndusInd Bank. Should they continue to hold this?
Yeah, I would suggest continue to hold, but you can keep a stop loss actually, because we have seen in the last couple of months or quarter that, you know, the performance has stabilized on mostly all fronts. You've seen the cost of funds coming down. You've seen, you know, provisions coming down, which has actually supported the profitability to some extent. And if they have no major provisions coming in the rest of the say 1 or 2 quarters, then I would believe FY27 they could end with a price to book attractive. So I would say hold with a stop loss.
So Shaina saying to hold, but Vaishali, what would you say he's willing to? He wants to know what the prospects are for the next 1 year. So we can assume he's probably okay to hold it for that long. But are there any levels at which he should exit, or do you think he should continue to hold the stock?
I don't think he should exit because I was looking at the worst seems to be over and we are gradually, right now, currently it's into a long consolidation phase. But gradually, if you're looking at 6 months to a year's horizon, I think this can go towards 1150. So that would be the level, which is an actual crucial resistance level, 1150. So till 1150 is met with, I think partial profit booking can be done. You can have a relook once we see a close above 1150. That gives us a conviction for further high levels. But for now, it's 1150 and 850 acts as the support.
All right, so 1150 is the key level to watch there. But let's move on to our next query then. Preetham writes to us from Karnataka, and he holds 52 shares of Infosys at 1,612 rupees. He wants to know if you should continue to hold or sell. I mean, the IT stocks, as we can see, getting battered. You know, the AI disruption is a little bit of an unknown for these IT stocks. So, Vaishali, in the longer term, Shaina, in the longer term, what do you make for the IT pack in general, and what's your view on Infosys?
Well, the correction has been quite staggering. And what I feel is at current levels that valuations are not expensive. If you look at EV by EBITDA 1 year forward, it's about 13 times. And also the quarter numbers did show that there is, discretionary spend by US companies coming back. Yeah, there is this big issue of a lot of companies spending more on the AI related expenses rather than actually the normal service expenses, which mostly the mid to smaller cap IT companies are, focused on. But I think larger companies like Infosys, TCS, they would be able to adapt to the changing marketplace. In terms of valuation, as I said, it is not expensive. And even in terms of deal wins, they are doing pretty well. So I would say continue to hold for the medium to longer term, and also don't average now, but you could look at lower levels to average if you have a long-term horizon.
Okay. Can look at lower levels to average if you have a long-term horizon. Vaishali, what is your view for the IT pack? Like we've said it also that we've seen that fall coming in, especially, post that AI news coming in the last couple of weeks, actually, we could say. Infosys, maybe if one is looking to average also, what level now to look at to average?
Yeah, I totally agree. This sector is beaten up as if it's getting obsolete. But no, I would say right now it's just a bounce. But for a further clarity, I think Infosys, talking about Infosys per se, we have a good support band coming between 1250 or 1220 levels. So I would say better to take it as an SIP mode because, exact bottom fishing won't be really possible. But from here on, every decline, as I said, 1220 would be the support. Start accumulating, and when the reversal takes place, you'll be in a better strategy to move higher.
Okay, better strategy to move higher if you follow that. Vaishali, thanks so much for that. Next query for today, we have Sriram, who's writing to us from Chennai, holding 50 shares of HPCL at a price of 199 rupees. And he wants to know 1 year view for the stock. What should they be doing with this? Shaina?
I would suggest hold because valuations are extremely expensive. It's just about 5 times 1 year forward EV by EBITDA. Also, the GRMs, if you saw the third quarter, were pretty strong. They increased to about 8.89, 8.85 per barrel. And the current Singapore GRMs are stabilizing around this range. So I believe that over the next couple of quarters also, they should continue to do well unless there is some big war in the Middle East, and then we see the crude oil prices moving up sharply. Otherwise, in this crude oil price at $62 range, looks pretty decent for HPCL to continue doing well over the medium to longer term. Valuations being very attractive, I would say hold for now.
So you would say hold HPCL for now. Vaishali, if you could tell us, he's got 50 shares at 199 rupees, clearly making a profit. So, and he wants a 1 year horizon. So any levels that he should watch out for? Should he book profits or continue to hold?
At very lower levels, I would say keep a stop loss below 430 because still as long as 430 levels are held on, the trend is intact. And I think if 480 is crossed, you may expect a further bounce coming towards perhaps 510 to 520. So this is the way to look at it. If 430 levels break, then one must exit. But if 480 levels are breached, then look for higher targets.
So 430 and 480, those are the levels to watch for that stock. All right, ladies, it's time for us to take a short break, but we'll be back in a jiffy. We'll answer more stock queries on the other side. Stay tuned. Welcome back. You're watching Your Stocks on CNBC TV 18. We still have with us Shaina Mukaddam and Vaishali Parekh to answer all of your stock queries. So let's move on to the next one. It's another one from, the IT pack. Deepak writes to us from Noida. He holds 25 shares of TCS at 3,141 rupees. He wants to know the outlook for the next 3 to 4 years. Obviously, right now making some losses. But Vaishali, what would you say from Shaina, sorry, let me come to you first on the fundamentals. What would you say for the stock in the next 3 to 4 years?
Well, 3 to 4 years, I would say that, hopefully the interest will come back into the overall sector. See, if you see a last 5-year period, the stock currently is at its lowest levels, both in terms of stock price as well as in terms of valuations. Also, of course, as we've been discussing the whole day, the problem over here is a lot of the US companies are shifting their incremental, spending to AI related services. So now, while there is a bit of slowdown in terms of overall revenue growth, we've seen across the IT pack. But what I believe is that the deal wins remain quite robust. If you look at TCS, we saw deal wins. I think TCV is close to about 4.8 billion US dollars, which is a decent size for revenues to take it over the next 1 to 2 years. And also the guidance for the fourth quarter and beyond has been reasonably stable. Cash flows are strong. So I believe that, EV by EBITDA of about 15 times FY27 is not too expensive for the quality of TCS. So I would suggest you can hold for the long term.
Hold for the long term. Vaishali, just hold on. Before I come to you, there's flashes at the bottom of your screens, and this is coming from Reuters. Reliance wins general authorization for from US to buy Venezuelan oil. This is according to sources. We'll keep an eye out on more updates here, but as of now, that's the update. Reliance Industries for you all on the screen. They've won general authorization from US to buy Venezuelan oil. This is according to Reuters, is where we're picking it up from. Vaishali, coming to you. Your thoughts on TCS now?
I would say I would wait it out because right now the trend is totally down. So taking a 5-year horizon, I would say, 2000 is the support level. So I would start cherry picking right from, below 2500 levels. So that would make a very favorable risk reward. And then from there on, we can have a view as to where the cycle goes.
Okay. Once we have a significant view, take it from that level over there. But Vaishali, thanks for that. Let's move on to the next query. Kanan is writing to us from Chennai. He's holding 250 shares of EM, and this is at 1,525 rupees. They're making a profit on this one. Long-term investor wants to know if he should continue to hold or book his profits. Shaina, your view for this one. Should they get out of the stock and maybe look at something else?
FEM, in terms of valuation, it's not expensive. Also, if we are seeing the numbers that they're coming out is pretty good. It's a small cap. And I would suggest that, the investor can continue to hold. He's making good money. You keep stop loss and continue to hold.
So continue to hold. Vaishali, what's your take on this? If he should book his profits, then at what level should he exit?
So, I would say actually the stock has, even from a long-term perspective, it's taken a one-way rally right from 400 levels to now 2300 levels. And indicators also are showing some signs of exhaustion. So I would say keep a stop loss of 2100. If the stock goes below 2000, it can see some further profit booking going towards 1800 or so. And the upside potential, what I would be looking at, I don't see this going about 2500 to 2600. So partial profit booking and the rest keep with a trailing stop loss.
All right, so partial profit booking is what you're advising. But let's move on to our next query. Venkatesh writes to us from Hyderabad. He holds 50 shares of Mankind Pharma at 2,908 rupees. He wants to know if he should continue to hold or exit at current levels. He is making a loss. So, Shahina, what's your take in the long term? What's the view for the stock?
Well, here I would suggest you take half the book half loss, book half your quantity as a loss and hold the remaining and review. The problem out here is that they had made a huge acquisition a couple of quarters back in Bharat Serums, in which they are investing, close to about 14,000 crores. And the impact of this is coming on the interest, has come on the interest cost, which has jumped. The debt has jumped, interest cost has jumped, and it is affecting their overall profits. Also, in terms of revenue, this acquisition has not started contributing to the top line. So the overall growth across the board in terms of revenues, EBITDA, profits has been in single digit. While valuations are expensive if you compare it to other pharma companies. So I would say book half your loss, book half the quantity and hold the remaining. Review it after a couple of quarters and let's see the impact of the acquisition on profitability and then take a call.
Okay, and Vaishali, your view for Mankind Pharma?
So, of course, the trend is down. So I do concur with China. But since he's held on for so long, keep a stop loss of 2000 because in all likelihood, if whole of pharma and along with Mankind, we see a bounce coming in, this can go towards 2250. So that would be the level to exit.
Okay, that would be the level to exit over there for Mankind Pharma. Let's move on. Krishna Kumar is writing to us from Chennai. He's holding 1,000 shares of Keynes Technology. 3,900 rupees is what he's bought it at. And otherwise, he's 500 shares of Dixon Tech at 11,000 rupees. Time period for holding is 1 more year. Should he continue to hold, average, sell? What is the view on both these names? Shaina?
Unfortunately, both these stocks, in terms of valuation, are expensive for a 1 year period, and they are reporting. Both have reported disappointing numbers for the third quarter. The reasons given are different. Keynes Tech, of course, because they have had some increase in cost in they have had a lower growth in revenues, which was like we were expecting something like 50%. They have come out with a much lower growth in revenues. And in terms of Dixon, they have been affected by the higher cost of chips and also some lower revenues by some of their the revenue turnover was impacted by lower mobile sales. Now both these issues could be sorted out over the longer term. But for the shorter term, given the fact that the valuations are expensive, I would say at least book half your losses for both the stocks and review both the stocks after a couple of months. Of course, I would prefer Dixon over Keynes for a 1 year period.
All right, so you prefer Dixon over Keynes for a 1 year period. But Vaishali, what are the levels you're looking at for both these stocks?
About Keynes. The recent rally what we witnessed was from 7,500 and we saw an erosion going right towards 3,300. Currently, it's at around 4,000 levels. I'm talking about Keynes, yeah? So I would say hold on because it is showing signs of reversal. 3,300 should be the stop loss maintained. And if this stock moves above 4,200, I am looking at a target of around 5,000 to 5,200. So for now, my view is positive. It only gets negated if the stock drops below 3,300. Likewise, even for Dixon, if I talk about, this too has witnessed a lot of profit booking right from the recent high of 18,500 to nearly 10,000. So if 10,000 levels are broken, then it's definitely an exit. But currently, it is in the process of making higher bottom. So the nearest support that I see is at 11,000 levels. And once the stock moves about 12,500, this too can go towards 15,000. So act accordingly.
Okay, act accordingly. All right, Shaina and Vaishali, thank you so much for taking time out and answering all of our viewers' queries. But with that, we're completely out of time on this episode of Your Stocks. But do remember to email us your queries and we will address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
We have the Taiwan index that's shut, but Hang Seng that's trading with cuts of more than 1%.
It is higher than the old series, which was expected to come in at 2.3%.
Sharp corrections, and this is not, a small 2-3% kind of pullback.
In principle, that message is clear. It is real. This disruption is here. Like you said, it is on our doorstep.
Stellar set coming in for Honasa, a 16% revenue growth.
It's another 1% cut, near 1% cut, 25,600.
I think gold and gold-related companies have seen a tremendous amount of value growth-driven growth.
It is incumbent upon us to, definitely evaluate every opportunity that comes our way.
I think as the price increases or the LTV goes up, the tonnage has to come down.
All in all, we see the demand outpacing supply.
I think you have a tight supply-demand situation. And then when you look at the investor sentiment, commodities are now very much in favor.
Right now, the Nifty is below that 25,600 mark as well.
At the session low today, the Nifty IT index had seen a fall of 11.7%, and that would have meant the steepest weekly decline in 6 years.
It's been a down day for the markets, and for the IT index, it's lost around 8% on a week-to-date basis as well.
Well, that is the day so far. It's another tough day, 270 points off on the index. IT stocks, of course, the culprit, but I have to say, smart recovery as well from the day's lowest point. The IT index was down 5% in the morning. I think it's down about 1.5% the last I checked. This is Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, Nigel and Rima with me. Guys, afternoon.
Hi, afternoon. IT has recovered about 4.5% from the lows, but the sentiment in the broader market is hit. The mid-cap index, small-cap index, even the advanced decline ratio, 2,200 stocks in the red, Nigel.
Well, Rima, the tech stocks actually good recovery. It appears someone is going in there for a longer-term horizon. Otherwise, it's just being sold into on a day-to-day basis. Today, at least, there's actually a 3% recovery from the lows. And yes, Rima, I take your point with regard to the advanced decline ratio, but it appears both those two lines actually have at least got a little closer to each other than what we saw at the start. It was only 300 stocks that are advancing. That number's moved to around 710 odd, far away from kissing each other. But, it's 1:3 now. In the morning, I think it was 1:6.
And there's no sector which is in the green right now. So it's not that the sell-off is just an account. Sell-off is just on account of IT. Even the metal index is down 2.5%. The realty index is sold off 2%. CPSC 1.8. FMCG 1.5. So it's a fairly broad-based selling pressure. Can't pin the blame only on tech.
Can't pin the sort of blame on tech. By the way, Nigel had a slight smile on his face. Nigel will tell us later through the course of the day.
No, it's case today. I mean, the bulls would want both those two to come closer towards each other. The advanced decline ratio far away, but let's focus on the
But there's
market
red
action.
color for Valentine's.
Yeah. As they say in Hindi, mein dil behlane ke liye. Otherwise, aur kya? Well, let's take a quick look at what's coming up here, right? In terms of interactions, etc. So, selling pressure, of course. Nifty tech counters are weak, but off the lows by quite a bit. Broader markets is something we'll talk about. India Wix is up about 9%. Muthoot Finance spoke with us earlier today. Numbers are strong. Guidance has been up. Stock still down about 11.5%. We'll play out those sound bites as well. Hindalco reported largely in-line set of numbers. More details, fine print coming up there. EIL, the last I checked, was up over 10%. Honasa is up in a weak market. So, some of these smaller earnings also will find their place over the next 60 minutes as we wrap things up. Mitesh is with us with what he'd want you to do as far as specific trades go. Mitesh, good afternoon. Good to have you here. Going into a weekend, it's been just an absolute tsunami of news flow over the last 5, 6, actually last 10 days now, right? But what would you do? What would you want to tell viewers to do in terms of index and then stocks?
Good afternoon, Prashant.
In the afternoon, I was saying that, we'll look for, in the morning, I was saying that we'll look for some reversal around this 25,600, 550 zones and then take a long, which has not happened. So fortunately, I think, there has been no false bounce back, which could be trapping the bull side trade. So that's a positive. I think on the stock side, with the markets now trading below this 25, 550, 600 zones, I think one, cut down on your long exposure, exit if possible, if it's not too much of a loss, or if you have some profits there as well. I think that's a good strategy. And wait for 25, 600, 650 to be captured before thinking of going long again in the short term. So I think the idea is that the bias has turned slightly on the negative side with today's price action, kind of confirming a minor breakdown. And that's why the position should be like that. On the stock side, I think Prestige Estate is breaking down on the hourly chart. So we'll take a slight negative call here. Keep a stop at 1550. Look for targets of around 1455 to about 1450 on the downside. And SBI Life is still, showing some positive traction, some strength on the chart. So that's on the long side, a trade with a stop at about 2018 for targets of 2070.
Okay. Just on IT, there was an interesting note which came out from JP Morgan. It was just all sell, sell, sell for the last few days. Now, JP Morgan says that the free cash flow to dividend yield are now screaming deep value. And they're reaching levels or crossing levels which were last seen during the GFC and COVID. So severe market dislocation. They're arguing for valuations being at ultra low levels. Now, they've also done some scenario analysis. What can cause a further 10% downside from here on? They're saying that in the last 3 years, we've seen a revenue growth of 2 to 3%. If we assume that is going to be the terminal growth rate, that IT industry continues to see this low single-digit revenue growth, then there is a case for a further 10% downside. But if you assume that there is going to be some recovery in the earnings growth, not at the current 2 to 3% that it's seen for the last 3 years, not at the long-term average of 7-8%, but somewhere in the middle, a mid-single-digit kind of a revenue growth, then stocks stay where they are. But what is a deep, bear case if you assume absolutely no growth, which is for the next many years, IT industry top line remains where it is, zero growth, terminal growth. Then there is a downside case of about 30%. But in a nutshell, I think they are saying that valuations perhaps the sell-off got a bit overdone, and valuations, when you look at it on a free cash flow to dividend yield, are looking fairly attractive, and that maybe explains that that 4.5% recovery that we're seeing from the lows on the Nifty IT index. Maybe the pessimism got too much. But let's also talk about Muthoot Finance, that's trading with cuts of about 10% despite good numbers and the company raising the guidance. Gaurav now joins in. So Gaurav, the company told us that the AUM growth guidance stands at 45%. Earlier it was 30 to 35%, yet the stock hasn't recovered.
Well, if we look at Muthoot Finance and the numbers, let's revisit the numbers first. First, we saw profit increasing almost by 95%, and this was aided by the NPA recoveries worth 960 crores that the company recorded in this quarter. Apart from that, what it translates as the ratios. Now, net interest margins that increase almost by 11 basis points, and we have got a company which is delivering the ROEs in the tune of 30% now. At the same time, even if you look at the AUM growth, there was no disappointment here at all, because gold AUM that grew almost by 50%. In fact, the Belstar, which is their MFI arm, also showed some kind of recovery in the AUM growth. On a sequential basis, it grew almost by 2.5%. But still, if you look at the market, it is not appreciating the fact that the result was good. And there are three key reasons that we have highlighted. First is that if you look at the gold AUM, although they have increased the guidance from 30 to 35% to 45%, let's not forget that in 9-month FY26 so far, they have already achieved that 35% mark that they were guiding for in FY26. So the revision in guidance, that was mostly warranted for by the market. Second is that if you look at the AUM growth, now that remains strong, but at the same time, there are two concerns. First is that the tonnage growth, that has remained flat on a sequential basis, and second is the number of customers. They have also remained flattish on a sequential basis. Management did not show any kind of concern on these factors, but these were some of the points raised by investors. Third, if you look at the valuation, now even after the fall, it trades at 3.9 times price to book. If you compare it with its closest peer, which is Manappuram, it trades at just 1.7, and IIFL Finance, which is again one of the gold financiers, it trades at 1.4 times price to book. So there is a huge gap of valuation between all these companies and Manappuram Finance, which actually also results in some of the fall in that we are seeing right now. So all in all, numbers were not bad, But the pessimism that was built in because of the numbers coming ahead and at the same time some profit booking is the reason why we are seeing some fall in Muthoot Finance today.
Okay, all right. Thanks a lot for that, Gaurav. In fact, we spoke earlier today to Mr. George Alexander Muthoot, the MD of Muthoot Finance, where he hiked the guidance for the loan, gold loan AUM to 45%. He also commented on the lower tonnage and the LTV in the quarter gone by. Let's hear out what he had to say.
This quarter, the first 3 quarters have been good growth. We have seen in the last 3-4 quarters have been quite good. We have already grown the gold loan AUM by 36%. I feel that we should be able to do around 45% by the end of the year. We should reach that by 45% by end of the year. So that is, I think, something which we plan to achieve by the end of the year. So the LTV goes up, the tonnage has to come down. Having said that, today, if you look at the price of gold today and the amount lent by us, the LTV is only 57%. So there is always headroom, more money to be given, but people take money only what they really need. So the tonnage is dependent on the gold price. Incremental people generally take about 69 to 70% average. Today, if I give, some people take 75, some people take 60, some people take 65. On an average, the today's price, the LTV would be maybe 69 to 70%. That's all.
Okay, on Belstar, he said things are improving, but as of now, no IPO plans because Belstar does not need any sort of capital. They will tap the markets only when they need the capital, but there has been an improvement in the profitability. But the growth from here on is going to be cautious and not aggressive. Mehraboon Irani, market expert, is now joining in on the show. Mehraboon, you want to comment on Muthoot Finance, 12% down?
Well, I've been a bull as far as Muthoot goes for the last at least 7 years. And to those people who look at the results with some doubt, saying that there are some write-backs and client growth has not picked up much, my answer to them would be that, except the fact that the stock has doubled in the last 12 months, and there is definitely reason for the stock to correct. So from 4,000 odd coming to 3,600 is no big deal for a stock which has gone up from 1,800 odd rupees to around 4,000 rupees in the last 12 months. Let's accept the fact that Muthoot Finance is fundamentally strong, solid growth prospects, and I think it would be a great core NBFC stock, even around 34, 35, 3,600, where it could move in a narrow range for some time to come. I think it would be a great core NBFC stock for investors at this present price. The price to book value at 3.5 to 3.7 at the present price honestly is not expensive. Even if you look at the PE ratio, which is not the right way to look at a company with Muthoot, which is keeping on growing at around 20 times, is also not very expensive. It remains fundamentally strong. It is a market leader. Comparing it with Manappuram and IIFL would not be a fair thing to do because Manappuram is in one or two other businesses where it is facing the pressure. The profit growth was good. The management guidance is good. No complaints at all. The complaint is that the stock had gone up too sharply and people questioning it, saying that, oh, it has become expensive and all. It's post-mortem people are doing. The fact is the stock needed to correct a little bit. And I think they have found out a reason by pointing out some write-backs and not too much of growth in the number of clients, and sequentially there's not too much of improvement in margins. If you have reached a level at this particular scale, I think such type of things could happen off and on, except the fact that there is no problem as far as debt recovery goes. So this is the company we should continue to do well. I'm quite comfortable holding on to it. Clear disclosure, I'm holding it, and I have no intention to sell it. And if you give me another 10% lower, possibly I'll go and add to my holdings.
Got it. Okay, all right, Mehraboon, taken that point. Let's focus on another big loser, which is Hindalco. And let's explain this to you. Reports suggest that President Donald Trump has planned to scale back some of the US tariffs on steel as well as on aluminium goods. These are unconfirmed reports. Remember that Mr. Trump had doubled the import tariffs on steel as well as aluminium to around 50% in somewhere around June last year. So let's do a quick analysis. What could this mean if these tariffs actually are lowered? It could be sentimentally positive for global steel as well as the aluminium industry because that fear of demand destruction, that will go away. That's a sentiment positive. But overall, it will be neutral for most of the steel as well as aluminium names, assuming that this reduction in tariff is universal and it's not country specific. So we'll have to keep an eye out on that. Hindalco, that one could have a bit of a problem. As Novelis, well, it will get impacted by the reduction in tariff rates, which could in turn lead to lower US aluminium Midwest premium. That has doubled, remember, in the last 6 to around 8 months. And that has hit an all-time high of around $2,250 per ton levels. And assuming it would hold at current levels, actually the tariff impact which has pushed up this Midwest premium would have been beneficial for Novelis. So if the Midwest premium comes down, it could probably have an adverse impact on scrap spread, which in turn will hit Novelis' profitability. In fact, I spoke to Hindalco management earlier today, Mr. Satish Pai, and he said that with the Midwest premium at around $2,200 per ton, the negative impact of the higher tariffs, which has been plaguing them over the last few quarters, that is behind them. So they were bracing actually for better times if the Midwest premium holds at current levels. And now if Mr. Trump pulls back on these tariffs, it could be actually a negative because the Midwest premium will come down. That in turn would hurt Hindalco, that is Novelis' profitability. What's your view, Meribun? The stock had a one-way run. It's underperforming today because of this fear that the tariffs get pulled back, Midwest premium comes down. If I got the number correct, I think in June last year it was around $800 to around $900. That number has gone dancing away to around $2,200 per ton. And if that comes down, it'll hurt the spreads. Your view on Hindalco?
I think there have been disruptions also as far as production goes at Novelis.
That's true.
Two accidents happened. And now Hindalco is planning to put in more capital over there. So it can affect the cash flow of Hindalco, which is another negative. And the tariffs part also could turn out to be a little bit negative. But personally, if you ask me, I think, and I know you track commodities very closely, Nigel, and I really respect you for that because you were perfect and accurate always. Let me also state something that my personal view is that some of the commodity stocks where I will include Hindalco at a particular price someday. I think some of the commodity stocks will be market leaders in the next 3 years. That's my personal feeling. So Hindalco, I won't be very, very negative. Again, for Hindalco, I would say this is a stock which has gone up by 50 to 60% over the last 12 months. It's corrected today for the right reasons, but let's understand the Indian operations. Indian operations, record high, the profit-wise. Novelis took a big hit because of the accidents. Company is planning to put in money. The short-term momentum as far as the Hindalco stock goes has definitely softened, given the results, mainly because of the global operations and operational uncertainties, as well as this tariff issue right now. But I don't think there should be too much of a further fall from here. I have a biased view because I am pro-commodity stocks right now, so maybe I'm a little bit biased, but I would say that it may spend some time in the range after the sharp run-up the share has seen. And maybe a little bit more correction could induce more buying at lower levels. That's my personal gut feeling. So not to buy in a hurry, but certainly look at what happens to Novelis, the money which Hindalco pumps in, what happens as far as the actual news comes out on the tariff front. Let's wait for that. So I would say comfortable holding on to it, knowing that the stock could be under pressure for maybe another 5-7% here and then spend some time over here, but not too much perturbed or worried as far as the overall number goes, because I understand Indian operations have done well, and I also understand Novelis was hit more because of the accidents than any other reason.
Got it. Okay, all right. Meribun, since you said you're biased towards some of these commodity stocks, what would be your top buys be? Hindalco, you're sounding reasonably optimistic, though it won't be a runaway winner. But any other names, some niche ideas?
I am very positive on copper as such. Unfortunately, Hindustan Copper, I don't have a great regard for the company as such, but not too many options open for us. As far as Vedanta goes and Hindalco goes, I think that's only 10 to 15% of the revenues come from copper. So I would say Hindalco, Vedanta, even in Hindustan Copper by default are decent bets for me. But the real value stock, if you ask me, with clear disclosure, I'm holding it. So honestly, the only IPO applied in the last 3 years, and that is Bharat Coking. I think there's a deep value in this particular stock, and closer to its IPO price, if the market gives me an opportunity, I would advise my friends, my relatives to go and buy into the stock, and I personally will buy more into Bharat Coking. So I think there are decent options available for investors to go and buy into commodities. Deep value wise, I would rate Bharat Coking at number 1.
To come down a lot, you have to come down by 35% or 40% to get actually to that IPO price, Meribun. But take that. that point on board. By the way, guys, you know, yeah. Go ahead.
What I meant was the numbers for the quarter never impressed many, and I was hoping that the stock comes down sharply. Unfortunately,
you were
it never
hoping?
felt that day. It
Okay.
went around 35 and bounced back. I was hoping that you get an opportunity to buy at lower levels if it comes, but unfortunately, it never went below 34, 35, even on the day of the results, which on the surface never looked good to many.
Got it, got it. Okay, all right, everyone got that. By the way, guys, T20 World Cup, one of the biggest upsets have taken place. Zimbabwe has beaten Australia by 23 runs.
And yesterday, Afghanistan came very close, right?
Very,
very close. So, yeah, I mean,
one of the biggest upsets. I don't remember the last time when, you know, Australia lost to Zimbabwe, but good on Zimbabwe. A good fight out there.
There's an interesting match over the weekend in Sri Lanka. I heard some chatter in the newsroom, plans being made.
That's going to be a big one, Sunday.
Well, yeah, absolutely. But I think the markets have taken a bit of a dip more, right?
Yeah, leg down, but tech is back in the green.
Yeah. Tech is in the green?
Yeah, many tech stocks in the green. Persistent is in the green. Emphasis is in the green, to just name a few. And I think the tech index has recovered 1,200 points from the low point of the day. So good one out there.
I was told that some insurance companies, etc., have come in at lower levels and bought in. Perhaps I don't know if it'll show up in any way. I don't think so. It'll show up in data in any which way. But yeah, Meribur, any thoughts on this space really from here? I mean, is there a strong view on this one?
Won't be,
yeah, go on.
It won't be fair to say that the wolf is at the door as far as tech goes. It won't be fair because if you look at it purely from the angle of cash flow, dividend yield, I think at the present level, not too many complaints. Investors are justifiably worried about earnings compression and PE re-rating. We have to understand that all the frontline stocks, the stocks which are considered to be absolutely dear to investors, they don't look at it at all. The TCS, the Infosys, the Wipros are all down 40, 50, 60% from their highs. This type of prices people have not seen since COVID. The point is, should I go and buy into it? Honestly, not too many reasons. Is there a bounce? There's a bounce. But if we look at the things from the cash flow angle, dividend yield angle, 100% it's a buy. I'm not recommending it because I really don't know what's going to happen. Investors have been selling the software stocks on continued AI disruption, while rotating towards other tech segments, such as, say, memory. Investors with heavy exposure to IT stocks and even mutual funds, which are IT schemes or IT stocks oriented, I think they will have to take a relook and understand as to how many of these companies will be able to adapt itself to the changing environment, which possibly could play itself out over the next 12 to 18 months. There could be other businesses which will be great winners. Some of these companies will be able to adapt itself well, but some of them unfortunately will go down the drain. So it is a very, very, very difficult call if you ask me, and I think investors will have to be very vigilant, very active and trying to identify those type of companies which could not possibly get up again. I hope there are not many, but there could be names which will ultimately benefit because there is something like where you deploy AI, protect your data modes and defend pricing. If the companies can do themselves well, hopefully we will all look at the present day and say, okay, there are quite a few stocks which are great buying opportunities. But personally, I don't have the courage, don't have the guts either to buy them or to recommend them, while stating that from the cash flow angle and dividend yield angle, quite a few of them are looking otherwise attractive now.
Right, just a few months back, we were all looking for AI winners. Now we're all looking for AI survivors. But if you look at the mid-cap action, EIL continues to stand out in terms of the price action. Physics Wala, stock that you were telling just yesterday, and the one-way slide that it had, it's rebounded 8.5%, very large volumes. And across the board, these textile stocks, which got hit on account of the India-US trade deal in 2025, are rebounding. Gokuldas 7.5%, KPR Mills up 5%, Vardhaman Textiles up 4%. So that's a pocket where you are seeing some grain. But I think the Vishal Sikka?
Yeah, I mean, I think we should play some sound bites out, right? And I think he's quite a mind. Of course, led Infosys for a couple of years, but has been deeply, deeply embedded in the AI revolution for the last many decades. So I spoke with him earlier today. And I mean, if you had to take, there's no, and I think Dr. Sikka put it saying, well, it's not black and white. So if you're looking for an answer, whether this is completely overblown, So his point was this, that the technology is real, it is disrupting, it is very much here. But the question for investors really is who will adapt faster, who's lag behind, and that basically depends on company to company and what kind of work these companies are doing. Repeatable work, at a workflow level, that perhaps gets hit the hardest. If you're one layer below on the application level or even lower, which is more complex to replace, I mean, I guess it's harder in that sense to replace. But his message to IT companies essentially was, don't look back at what's getting disrupted and try and protect that, try and evolve and become innovators to try and meet the needs of the market, which of course now are working with the assumption that AI and generative AI and some of these technologies are here to stay. Some sound bites, listen in.
Things are always slower than we expect. Adoption takes time. Enterprises are very complex. They are like countries. Large companies are like civilizations. Some of them have been around for, hundreds of years, if not decades. So it takes a long time and even in terms of autonomy, there is a lot of still advancements to happen. Similarly, in the services industry, there are dozens of service lines. AI's impact on those service lines is not all uniform. It is not, it doesn't happen overnight to all of them. Some systems are much more complex than others. And so the rate of change is always as slow as the slowest pipe in the network. But having said that, I used to say this 10 years ago, 9 years ago, whenever that was. And it is here now. And we have a short window of time in which to sort of transform. I think we have to separate the potential, the promise, if you will, of this disruption from how it impacts in the here and now. In the here and now, you have particular projects that people are executing on, and if a client expects that you now do this project dramatically faster or cheaper or with less people or whatever, then that would impact the here and now. But that is something that takes time. That's what I meant by depending on the service line, depending on the nature of the work, depending on the team that is involved, and things like that. So there is the fear in general of the potential of what this can do to knowledge work. But then there is the actual reality of creating an enterprise-ready offering that uses these new capabilities to deliver those. So there is a gap between them. The productivity, because of using generative AI, can be quite substantial. I have seen examples of 20, 30x productivity gain and things like that. The important thing is that, do we want to keep looking backwards? Do we want to keep looking at tasks that we already do? And do we want to limit ourselves to what we did in the past? Do we want to be afraid of the disruption and automation to the things that we did so far that brought us here? Or do we want to look at the opportunities of what are the new things that I can do with what we have in our hands? And I think, I focus much more on the latter. I have a small company, and life is a lot more interesting when you think about, my God, we have this incredible ability. What can I do with it? And I think when I look at it from that lens, it is incredibly exciting.
Fly Emirates, fly better.
Okay, welcome back. There is news on Reliance Industries, which I think I should quickly mention. This is, of course, on all wire agencies. Reuters is reporting, Bloomberg is reporting as well. And the news is that Reliance has won a general authorization from the United States to buy Venezuelan oil. Stocks, I think, come up a little bit from the lows. And this is actually quite positive for RIL. And the reason, of course, is that Venezuelan oil, Venezuelan crude, is basically, I mean, there are different types of crude. Saudi Arabia, for example, is light sweet. It's easier to process. But Venezuelan crude is heavy and sour. And, the Jamnagar refinery of Reliance Industries has, the most complex. It's called the Nelson's Index, which basically measures the complexity of the refinery, which how, it can basically process very, very heavy types of crude, sour types of crude, which is exactly what Venezuela produces. Back in the day, I think 2010 and before that, actually Reliance at one point, I remember, used to be perhaps one of the largest buyers of Venezuelan crude in terms of private refiners around the world. So they're sort of familiar with it, and now there's authorization coming through as well. So this is positive, because not very many refineries can process that crude the way the Jamnagar refinery can, which essentially means that we'll have to see pricing, etc. If there are some contractual agreements, and those details are not there yet, but this is a license to be able to procure crude from the United States, of course, because of what has happened in Venezuela a couple of months back with regards to U.S. intervention. I mean, the president being deposed, and of course, U.S.-backed person there at the helm of things. So 1420, 1421, stock still down about 1.9% or so. So that's the important bit for RIL. Now, F&O positioning, and where do we stand? Nigel is here with details. Nigel.
Well, that's a bit of risk-off playing out in today's trading session. So the India VIX on expected lines, that's perked up a little bit. And the call writers, they are feeling very, very good. Just take a look at the 25,600 call. The premium at the start of today was around 270 rupees. That's come down by a third out there, or less than that, in fact. That one's come down to around 70 rupees. Yeah, so big downtick out there. Aggressive writing is what we're seeing. As is the case with the 25,700 call, premium down to around 40 rupees, compares with around 193 rupees that he left off yesterday. And because of this aggressive call writing, we are back down to the lower end of the range. We've come down to around 0.68. I think it's 0.67 now. So the Nifty PCR has come down. It normally bottoms out at around 0.62, 0.63. So I think, we should be bracing for a bit of a bounce on Monday's trading session, given that this technical level is already stretched. And we're at a very, very crucial juncture. The 20 DMA, the 200 DMA, that's the important mark. So 25,250, 25,450 is the important level that we're looking at. Individual stocks, there's some fresh buying being seen on Bajaj Finance. There's some fresh shorting, though, that's been seen on Muthoot Finance, as well as Inox Wind. Good amount of shorts being added out there. And Angel One saw a bit of a bounce, but that one as well has come in for some profit taking. So unbinding oppositions is what you've seen out there. That's about the F&O space, but let's welcome Rahul Vira, the fund manager, equity investments, Nippon India AIF, who joins in. Hi, Rahul. Good afternoon. Good to see you win. What do you do with tech? How much lower can it go? Are you getting constructive? I think Emphasis is one stock that you have in your portfolio. Will you look to add to tech?
Right. So I'll start off with one of the very interesting quotes from Mr. Bill Gates. He said that disruption, right, is always overestimated in the near 2 to 3 year terms, but is underestimated from a 10-year perspective. So we are in that kind of a phase as of now, where very difficult to say what is going to get disrupted and how much is going to disrupt it. Valuation-wise, dividend yield, FCF yield at 4 to 6% for some of these large cap names seems very, very interesting in the sector, no doubt. But incrementally, given the very hazy outlook in a gray area, we would prefer to be on the sidelines as of now. No incremental allocation to IT as of now.
But you own IT in your portfolio. Can you tell us a little bit more about, which stocks do you own? And is there a reason to reduce exposure?
No, we'll continue to maintain the position as of now. And we are slightly tilted towards the BPO space more rather than the pure play IT names in the portfolio.
And for the BPO space, so I presume you mean the kinds of, a Sagility, a First Source, eClerx. These are the companies that you're referring to. And to your mind, when you interact with the companies, how is AI disrupting their business model? Is there a risk of margin correction in these models or revenue growth coming in lower on account of higher deflation?
Right. So see, a couple of things that we understood by doing a lot of channel checks, speaking to a lot of managements. One thing was very clear. Nobody knows the right answer, how things will look after 5 years. From an analyst or a fund management perspective, we need to understand one thing is clear, that the revenue models that we are going to build going forward is going to be disconnected with the headcount, right? So whatever CTC that we're seeing on an average for the freshers, the 3 lakh CTC that we've been hearing for the large cap names, we hear that instead of 4 freshers, there's going to be a 1 lateral hire of 12 lakhs instead of 4 3 lakh guys. So the headcount versus the revenue correlation is getting disrupted for sure in the medium term. Now going forward, of course, in the transition phase, which companies will adapt or not, we'll have to wait and watch. But as of now, it's the discussion between the terminal value, the business model is going to be very, very challenging to see 2 years out. So better to wait and watch when the storm is out.
Rahul, hi. How will we know when the storm passes?
The best part would be look at the valuations when FCF yield instead of 4%, we'll have to discount it at the DCF level directly or indirectly and try to see whether we are moving towards 6% yield or not. At 6% yield, probably some of these large cap names will become very, very attractive.
Where are we now for some of the, have you looked at the numbers?
Closer to 4% as of now for the larger names.
I see.
Okay, all right. Rahul, a couple of stocks that you were bullish on. Edelweiss, I think that's the one you briefly mentioned on the last time around, Edelweiss Financial Services. The stock, I think, has done pretty well of late. How much more to go?
We are seeing decent upside in this one. We believe the management is on the right track in terms of the valuation unlocking story over the next 2 years. We continue to maintain the positive stance over the name, but it will be largely an event-driven name. A lot of corporate action has to take, value unlocking has to take place over the next couple of quarters.
Any other fresh additions to your portfolio?
We recently added one of the small cap hospitality names. We are very, very bullish across the hospitality space. Even if you see the recent numbers that have come out from the larger guys in the sector, the hotel space, right? Your RevPARs are still trading at high single digit to double digit. Your EBITDA margins are sustaining at 30-35% across the sectors. And we believe the kind of EBITDA growth over the next 3 to 4 years that most of the companies will be doubling their EBITDA over the next 4 to 5 years. And if the valuations are in favor, if your entry point is right, you should definitely look at this space.
I think the stock was Taj GVK, right? That's the one. Got it. Okay. All right. Give us some few more details then with regard to how do you see the telecom space evolve? Bharti Airtel is a stock that you'll have. What about Vodafone Idea? There is suddenly some optimism and the promoter entity has been creeping in. Your view?
Definitely. See, with along with the 2 names that you take, even if the Jio IPO is around the corner now, people are estimating that the ARPUs from here on will incrementally increase very sharply. Street is estimating that. But in terms of our allocation, we prefer to be on the larger names rather than being a little bit more adventurous and taking the small cap names that we discussed.
All right. Rahul, we'll leave the conversation here. Thank you very much for joining in. It's time now for a segment D Street Chatter. Nimesh, we've been waiting by. It's been a bit of a cruel session. IT is recovered, but the rest of the market is still downbeat. What are dealing rooms telling you?
I remind when the IT has recovered, the index has recovered 4% from the lows. But the sense is that there is aggressive selling in the IT names, both from FIs and from the DIs as well. My sense is some large domestic insurance companies would have bought and nibbled into some of the IT names in today's market. So that's from a flow perspective. But barring IT, even metal stocks are under pressure today. All the metal stocks are down. And even that's dragged the overall markets down. For a change, today there is a bit of selling in the broader markets as well. And that too from larger institutions. So not only in the large cap names, but there is selling from in the broader markets, the mid and small cap as well, from institutional investors. And some of them are part of my charter list as well. Broadly, I guess for the broader markets, it's a bit of a Friday factor as well, that you're seeing some selling pressure. But even then, the institutional investors are sellers there. Technically, 24,450 is a level to watch on the downside. If that gets taken out, you will see further selling pressure. But now the PCR has moved toward the lower end of the range, so you might see a bit of a pullback. But the street seems to be a bit divided on IT clearly. There is selling clearly from both domestic as well as from FI investors, even in today's market.
Nimish, we're very close to that support level. It's 25,475 on the Nifty, so just about 25 points away from the resistance level, and markets have retreated lower in the last 45 minutes since we started the show. We were well above 25,500, but now taking a leg down. It's more than a 1,000-point fall on the Sensex. The Nifty decline has now extended to 350 points. What about stocks, Nimish? What have you picked up in your chatter?
So the first stock on my list is Nazara Tech. It's been consolidating in a very narrow range of late, but I understand the city is anticipating a corporate development. A potential fundraising via preferential issue seems to be on the cards as far as Nazara Tech is concerned. So that's something to track there. The second name is Elin Electronic, a thinly traded stock, but down 6% in today's market, largely because I understand one of the large domestic mutual fund who owns a sizable stake is looking for a block exit in Elin Electronics, and hence you're seeing that pressure on that stock. The third name is OneSource. Again, has seen a big correction post the weak Q3 earnings. There has been selling as well. The promoters did buy a little bit in the last few days, but I understand there was a selling from a domestic mutual fund. That's largely over in yesterday's block. Some institutions have bought, but again, a bit of selling still continues. But at least a large part of the selling from a domestic mutual fund is over in OneSource. The last is Oswald Chemicals. Even if you look at the stock price from the recent peak, it's almost half. And at these levels now, you're seeing selling pressure from larger institutions. I understand a domestic mutual fund is likely to clean out in Oswald as well in the days to come. And hence, even that stock has been under pressure today.
Yeah, interesting names there. Nazara, Elin Electronics, OneSource, Oswald. Nazara, Nimish, I mean, kind of fell off the radar, right? It used to be news every day with acquisitions after acquisitions.
Yeah.
I think there was some change in shareholding, etc. as well. So what's the shape of things there at Nazara now?
So my sense is there's going to be a preferential issue to non-promoters. So even some large investors are likely to invest in via preferential issue. And most likely this fundraising is going to be a couple of acquisitions as well. It was part of my charter a few weeks back that the company is looking for a couple of acquisitions. So maybe this fundraising would largely be to aid further couple of acquisitions that they've been eyeing in the domestic market. So that's the broad sense that the fundraising is to non-promoters, and large part of the money could be used for inorganic moves.
I see. Okay. Thank you very much, Nimish. For that, keep an eye out on all these names as we track them. We'll take a quick commercial break here. We come back with some short-term trading ideas and more market conversation. There is 19 minutes to go for market close.
Fly Emirates, fly better.
Welcome back. Markets actually at the low point of the day. So we're going to go into the weekend with the bears feeling on top actually. The Nifty is down 500 points now. Mitesh Thakur is back with us. Mitesh, just revise the levels on the Nifty and give us those fresh calls.
So Nifty, as I said, below 25, 650, 600 is slightly negative, and we could see further declines. I think I didn't expect the decline to be so severe, but it's playing out. The 25,400 is the next pivot, 25,400, 370. And then, you have this day when the trade deal was announced. Before that, we had a high of 25,110. So I think even those levels could be tested, but for the timing, looking at 25,400, 370 as the key level of the index.
Mitesh, what would your trades be?
See, it's an oversold market, but yet I think the directional bias is on the negative side, so we'll take some sell side trades. Vali Energy is a STBT with a stop at 3120 for targets of 3050, 3060, and the other one which I have is Alchem Labs. I think there's a big red candle over there, so that's STBT with a stop at 5425 for targets of 360.
Got it. Okay. All right. Since you mentioned Alchem Labs, let's talk about it. They report their third quarter numbers. Ekta joins us to break it down for us. Ekta.
Thanks for that. Well, yes, Alchem Labs, the revenue is up around 15% this quarter. So and they had the EBITDA margins, which came in at around 25%. The profit was lower because there was a labor cost outflow this quarter. But what really stood out in terms of the geographies was that the India business was up only around 5.5%. The street was anticipating around early double-digit growth, at least for the India business this time. And we had the international business, however, which did well. So that compensated for the India business. But the company, interestingly, and that's possibly one of the reasons why the stock has seen a sharp downtake, is that they have made an acquisition in the medtech space. So Alchem is going to be acquiring majority stake in Occlutech Holding, which is basically a Swiss headquartered global medtech firm. And this is going to be 55% for 180 million euros. It is expected to be the third largest global player in minimally invasive cardiac implants. Now, remember that this particular company, however, is loss-making. So 2024 revenue was 397.8 crores, loss was 185.7 crores, and 2025 loss is expected to be around 67.65 crores. So that's possibly one of the reasons why the stock is lower. Separately, the company said that GLP-1 semaglutide launch in March is going to be one of the key things to watch out for and will be a key near-term growth driver.
Okay, all right, Ekta, thanks a lot for explaining that to us. Anand Tandon, market expert, joins us on the show. Hi, Anand. Good afternoon. Good to see you in. Any view on Alchem or any of the pharma stocks?
I think it's generally looking quite good, especially given that you're expecting to see, diabetes medicines going off patent in the near future. And many of the domestic companies have obviously positioned themselves for that. So that would be the next big opportunity besides the regular generic space that they have been operating in. And not a sector that has done exceedingly well in the near past. So therefore, I think there is some valuation comfort as well.
Okay, all right. So pharma is something that you're sounding reasonably optimistic on, Anand. But Anand, otherwise you've been quite, circumspect on some of these broader market stocks. How are you feeling about the mid and the small caps now? Still stay away from them?
Well, some of them have come down to some reasonable levels. If you look at media, for example, whether it is the distribution side or channels like Z, etc. I mean, the Z5 reported profits for the first time this quarter. And that would mean that subscription revenues have actually picked up enough to be able to start showing up as an EBITDA positive business, while they are still struggling with their overall channel. And there is still, I would argue that the jury is still out on whether people will watch channels anymore, other than through OTT. The thing is that the valuations are not very stretched. I mean, you have roughly 5,000 crores of enterprise value to justify after taking out the cash, or maybe 6,000 crores. And you have a depressed earnings, which is now giving you maybe 11 times. So similarly, if you were to look at the distribution side or the exhibition side, sorry, not the distribution, the exhibition side, that also, you have a company which is the market leader, which has actually trimmed off made their costs more variable, have actually started to show some kind of positive cash flow coming through. And all you need is a few large blockbusters like we saw in Durandar, etc., for them to start showing positive numbers. So there are opportunities in small spaces, but by and large, I think India is a small cap company compared to the rest of the world. And we are operating in a global world today. So if there has to be any change in terms of global outlook, and India were to become a little more favorably positioned in most portfolios, it is the large caps that need to move.
Anand, stay with us. I'm going to take a quick commercial break here. Coming back to you with more questions. Stay with us.
Welcome back. Actually, the Nifty is selling off even more. A few stocks have moved to the low point of the day. BEL intraday chart comes up for you. That's coming for some big profit taking as we speak. Year to date, the stock was up close to around 10%. It was a relative outperformer. That's coming for selling. Apollo Hospitals, that's the other one, actually has moved a little bit lower. And there appears there is some kind of selling on select counters. Even Geo Financial has moved lower. And I think Asian Paints is the other one. That after rallying from around 2,200, I think, to around 2,800, that as well has seen some kind of profit taking. Anand Tandon is still with us. Anand, what about tech? You've seen this play out in the past where there is a scare and some of these tech companies come out stronger. This time around, what's your view? And would you be a buyer after a particular percentage point correction in these stocks?
Maybe after they fall from you. Last year, I had actually, in one of your interviews, said that you should be worried about tech because the manpower requirement will fall off a cliff. You know, people keep worrying whether services industries will remain. Of course, they'll remain. Except that you, instead of having 50,000 people in a company, you should be looking at companies with 500 people. Because that's what you're going to get. So, you know, are you ready to take that kind of risk? Frankly, when companies say that, they cannot be replaced, they are talking to themselves, not to the investors. They are hoping that they will be able to do something where they will not have to worry about where their next revenue is going to come from. So frankly, plain vanilla IT services is not going to survive in the shape and size that we see today. It will have dramatic changes, whether the industry agrees to it or not. Now, as I said, it's not as if everybody will vanish. There will be smaller companies, more specialized companies that will emerge, and some of them will continue to do services. But the days of the monoliths, in my view, are over.
You know, yeah, so from an investor's standpoint, I mean, if these companies are able to adapt and productivity increases, I mean, it's a different equation, right? So you think there's blood in the water, but there will be opportunities along the way as well, right, Anand?
Yes, there will be opportunities, but see, what is happening is that, you know, AI, for example, is driven by 200-300 people around the world. I don't think even the large companies know exactly how the next steps is going to emerge because it is coming out of the labs and the researchers. Now, obviously, you can hype it up and say that everything will change tomorrow, but it doesn't have to. There is enough evidence to show that new hiring is going to be a problem. Just take the Indian companies itself. This year, the total net hiring is negative from the top companies in the country. And I keep suggesting that people should be worried about what that does to overall consumption demand, because if you don't have high-paid jobs coming through, and this is not only in tech alone, anecdotally, you can hear that happening in almost all high-paid services industries like legal, for example. There are legal AIs available which are preventing new interns from being hired in companies because that job can be done. There are research people who can be replaced early research people, because without the experience, the AI does much more on its own. So the point is that you are going to see a major issue with what you're going to do with the already surplus trained manpower. Forget the untrained ones that you're talking about. And that is not a problem that's going to go away. So like I said, I have been somewhat bearish, perhaps prematurely, on what it will do to consumption demand domestically. But I think, it is only a matter of time before it starts to play through.
Got it. Okay, all right. Thanks a lot, Anand, for that. By the way, I think we should pull up the intraday chart of Oro Pharma. That stock has seen a sharp recovery from the low point of the day. So big move is what we're seeing on that name, ending more or less flattish after being down close to 3%. What did well in today's trading session? Bajaj Finance, showing who's the boss. That one has bounced back after going through a time and a price-wise correction. Eicher Motors as well was up close to 1.5%. That's where the good news ends. Hindalco is down. The tariffs could come off. Midwest premiums will narrow down. Scrap spreads will come under pressure. That's the fear. Stock down 6%. HUL, profit taking yet again. The stock is down after the results. In fact, the stock has seen a correction of around 7%. Eternal, after having a run from 250 to 300 rupees, that one as well has seen some selling. And Adani Enterprises, another stock that did see some profit taking. Coal India, numbers a little bit disappointing. Unsure what's going to happen going ahead, given that captive coal blocks are ramping up as well. So that stock is down close to around 2.5% in trade today. The tech index, that actually recovered substantially from the lows of the day. So the Nifty IT index goes home with a cut of around 1.4%. You'll say, what's the recovery in that? Well, it was down 4% earlier. And the index that actually broke the back of the market was the Nifty Bank. That one, in fact, goes home with a cut of around 600 points. Routine profit taking, one could say, because, we have seen already a big run. The good news is it at least defended some of those crucial levels on the downside. So net, disappointing trading session. The bears going into the weekend feeling on top. Can the bulls fight back? That's something that we'll be tracking next week. I'll tell you what. Slip into a short break, come back. Editors Roundtable on the other side of the short break. Stay tuned.
The big sell-off in IT stocks dragged the Dalal Street lower. The Nifty and the Sensex end this week with a 1 percentage point cut. The IT index takes a big beating, sees a fall of more than 8%, its biggest weekly fall in more than a year. Over the next 30 minutes, we'll decode the week on the Dalal Street. We'll tell you why the IT stocks are getting battered in trade, and we'll decode whether the tide is turning for the mid-cap stocks. Hello and welcome to Editors Roundtable. I am Reema Hindalco. With me are Nimesh and Nigel. And joining us on Zoom today is Anand Shah, Chief Investment Officer, Portfolio Management Services and Alternate Investment Funds at ICICI Prudential AMC. Gentlemen, good afternoon. It's been a tough week, particularly for IT, but the rest of the market at least managed to hold on. Okay.
Yeah, I was to tell that it's a tough week for you specifically. So much noise, so much of news on IT sector. Take us. What's your take?
Well, so IT, this is one of the worst weeks that we've seen for the IT stocks in a very long time. So at the session lows, the Nifty IT index was down nearly 11.7%, making it the worst weekly fall since the COVID lows from March of 2020. Of course, towards the end of it, the index recovered and it ended down close to about 8%. But just the slide in the last 2 days at the lows had erased close to about 8 lakh crore in market capitalization. And many of the stocks are now down 30-40% compared to their record high levels. Take a look at, something like a TCS Wipro, 42% lower. For Infi, the fall is close to about 33%. And even for these mid-cap companies like a Persistent, Coforge, we've seen a very sharp drawdown of 20-30% from the lows. So the question now is this just another tech cycle where IT companies will come on top, they will be able to pivot, and therefore the weakness, the sell-off that we've seen is overdone? Or is it going to be different this time, and as a result of which the pain is not yet over? Let's quickly run through what some of the brokerages are saying. Yes, the Indian IT company Citi argues they've weathered many storms, Y2K, cloud, but they believe this time it's very different. For one, it's the incumbent risk. This time, the IT sector goes into the AI cycle as the dominant player. Rather than, so it's going to be the one which is going to get disrupted rather than being the disruptor. It's doubled in size since the cloud era. So that's reason number one. Secondly, they say the AI impact is far more pervasive because when cloud came in, it impacted only the infrastructure, the way data was getting stored. But now AI is threatening to reshape the entire way business is getting conducted. And also, unlike the cloud cycle, when new deals were coming in, they were very large migration deals, more than $100 million. Now, new AI pilot deals are coming, but they're much smaller in size. They're exploratory and they're not enough to offset the deflationary pressure. But on the other hand, with the way the markets have reacted, the sentiment has gotten hit. JP Morgan believes, in a way, they've not said it, but the pessimism could have been overdone. And they're saying that the free cash flow yield, the dividend yield, scream deep value. The kind of valuation that we're seeing on free cash flow and dividend yield is comparable to what we had seen during the GFC or COVID. And they've laid out 3 scenarios for the market. Now, the first is from 2023 to 2025, the Indian IT companies went through a period of 2 to 3% revenue growth. Let's assume that is the growth rate into the future. If that is the case, then the IT stocks maybe have a downside of approximately 10%. But if you believe that this 2 to 3% growth gets a little better, maybe we get to mid-single digit kind of revenue growth for the IT industry. Better than what we've seen in the past, but not the long-term average growth rates of 7 to 8%, then stocks stay where they are. But the dire scenario in this is that you assume that this is really an existential crisis and that IT companies, Indian IT companies, see absolutely no growth in the future, zero terminal value. In that case, the bearish scenario, the downside that JP Morgan sees is close to about 30%. So that's the way the brokerages are still very divided. The pace of innovation has been so rapid that people are still coming to terms with what the impact is going to be, to the extent of the impact. The Indian IT companies we've spoken to do believe that the disruption is going to be very manageable. They've completely said that risks of existential crisis or the fact that the entire pyramid structure, employee pyramid structure, is going to change is overblown. But the street is a worried lot. Maybe what we saw, the recovery from the day's low on an intraday basis, could suggest that maybe the pessimism got done. The pendulum swings on both sides.
Let's get Anand's view then on this one. Thanks, Reema, for that. Anand, what do you make of it? The tech wreck all through the week, and from the recent highs, well, some of them have corrected big time. How would you view this? Do you think they can get past this challenge? And more importantly, the price-wise correction is quite substantial. good time to look at it, or you believe there's too much of uncertainty and this is an actual threat that you'll just stay away?
Hi, very good evening. So I think, look, price has two elements. Price has the element of EPS and PE multiple, and exactly what is happening just now is, look, there is no near-term risk to the earnings, and even if it's there, it's very marginal immediately. But what is happening and why the stock prices are, falling the way they are falling is because the narrative is changing. The PE multiples, as Rima spoke about, the terminal value. That what does the AI disruption mean in terms of, one is obviously the deflationary pressures, which will sooner than later will have impact on the earnings also. Revenue growth and earnings both, that would be much sooner. But eventually how the industry gets disrupted, and to that extent, how long would be this deflationary pressures and this degrowth in the revenue and bottom line, if at all any, and again that's not given, would be there, and that's all people are speculating / trying to understand, trying to analyze. We believe as the prices, and obviously the prices for the IT services will fall as a low end of the work would be done by AI. It is very much a possibility, like it has happened in the past, that at a lower price the demand goes up. There are new use cases for IT services. People who have not used IT services in their industry structurally will start using, including our industry, where we have not been so much invested in technology. We would invest more. So I think I won't say we know for sure what's going to happen, but as we speak, the starting PE multiples were not cheap, and the growth is completely uncertain, and to that extent there is a rightly derating that's happening in the sector at this point of time.
Ananda, hi. Do you own any IT stocks, any part of the IT segment in your portfolio? If yes, what are you planning to do with it? What are your conversations with companies? Is there a case to continue to hold on when there's so much uncertainty?
So again, we've been sort of underweight to zero in IT for almost last 4 years, and partly also because what we are discussing today is not new. It's been there for a while. We always had this fear of deflationary pressures on IT services, initially because of the demand slump, and now more so because of AI. So we always were of the belief that the valuations at which these companies traded versus the growth opportunity that they offered was not commensurate, and to that extent we were underweight. We are watching this space very closely. We were thinking, or at least nibbling some bit of adding a percentage point here and there in IT services in our portfolios. But now this is a completely new scenario, and to that extent we continue to evaluate this sector. Again, I'm repeating, we don't have a final word on this. We don't believe we exactly understand the implications of various developments in technology at this point of time on the long-term growth of the IT services sector. But I will pause here and at least make this point that this is not the first time that the Indian IT service is getting disrupted. So it's happened in the past, and we are in the services business, so we'll have to remain relevant for software development. We'll have to remain relevant for even execution, which is a new software as and when gets created. Interfacing that with the enterprise software is another job that we do, and plus the various infrastructure and maintenance work which we anyways do. So I think there's a lot of part which will not change, and some of the part which will change.
Sure. Anand, are you fearing any second level impact on any particular sectors because of this big drawdown in the IT names? Because, you know, there could be sentiment impact on jobs, there could be sentiment impact on the real estate as well. Anything that you're looking to avoid now, given such a sharp fall in the IT names?
So look, again, yes, we worry about all those, and we keep on doing our channel checks. There are no early signs of slowdown in terms of the offices which are being hired by GCCs. But nevertheless, look, it would be naive on my part to say that the other sectors are not going to be affected. To me personally, while there is one-off sector which will get impacted negatively, I think many sectors will actually positively benefit. Those who would consume AI and benefit from the lower cost, lower number of people that you would need. So indeed, your question is right that would there be job losses? There would be job losses not only in IT sector but in other sectors also, because a lot of repetitive jobs which otherwise being done by a human being would be replaced. And to that extent, yes, we look at opportunities as well as threats across companies, across sectors to see how individual businesses are adapting. So when the internet banking came, when the mobile banking came, the banking and financial services also had impact. The number of people walking into the branch, and to that extent, the consumer-facing employees in the branch, the need for that keeps on coming down. So I think all the gamut of services business and the manufacturing business will get impacted by AI.
Got it.
Okay, that's on the tech sector and the kind of disruption it's going to have, not just on services, but even in our day-to-day lives. But, Nimesh, the earnings season, the fag end, and it's not been bad, particularly for the mid and small caps.
Yeah.
And stocks have corrected, very sharp drawdowns, 30-40% in some cases. What's, when you speak to people, what's the reading on mid caps? Is the tide turning?
That's what, that's a big question. In fact, I was at the conferences and even there I similarly asked a lot of the fund managers on basically is the tide turning for the broader markets? And there are enough indications to suggest that maybe there is a tide which is turning for the broader markets, and you can look to bottom fish here. I'll give you some top numbers first. Y2D, look at the indices on how they have performed. The mid-cap index is absolutely flat, given that there is so much of pain in the Nifty in the broader markets. The mid-cap index is flat, small-cap index down just 2%, and micro-cap index down just 1.4%. In the carnage that we're seeing in the bigger names, this is relatively an outperformance to my mind. The Nifty is down 1.2, and vis-a-vis if mid-cap index is flat and small-cap is down 2%, looks like it's a bit of an outperformance there. And the Bank Nifty, of course, is the big gainer there, up 2%, Y2D. This is the indices in the since the beginning of the year. Now, as Rima rightly pointed out, if you look at the Q3 earnings, if you dissect the PAT growth for across sectors, it is in the large caps, the PAT growth is 13%, in the mid cap it's 16%, in the small cap, the PAT growth is 32%. So clearly there is outperformance in terms of earnings as well in the broader market stocks. Now, in the last couple of years, the big trend has been the insiders were selling. That is the promoters, the private equity, they've been selling a lot. Now you're getting a change of creeping happening from promoters and strategic investors. Some 4-5 names I'll highlight. Vodafone Idea, the promoter has been doing creeping acquisitions. KMB has bought nearly stake worth 50-60 crores in the last couple of days in Vodafone Idea. In the last 2 days, there has been a lot of updates coming in from Bharti Airtel in terms of doing creeping acquisition in Indus Tower. So again, a bit of insider buying there. OneSource, the stock has actually collapsed after the Q3 weak earnings. And now at these levels, you're seeing a bit of creeping from the promoters as well. Nearly 4.5 lakh shares is what the promoters bought. And even Kalyan Jewellers, right? I mean, it's been a big underperformer to the likes of Titan and all. And now after Q3 earnings, you saw a bit of nibbling and a bit of creeping from the promoter in Kalyan Jewellers as well. So that's also a bit of indication that maybe the promoters themselves are finding a bit of comfort at these valuations. Now just look at the big winners in the last, since the beginning of the year in the broader market names, and many of them are getting benefited also because of the change in the overall US-India deal and the US-Europe deal as well. So you'll see a lot of winners in that name: Avanti Feeds, Apex Frozen, GE Power. A lot of these small and mid-cap names have gained 50, 60, 70% in a very short period of since the beginning of the year. So clearly, it looks like there is a bit of outperformance coming in the broader markets. Lastly, I just looked at the 4 indices in the month of March. Bit of mid and small cap, there is a bit of volatility. Last year was quite good. The previous year was a bit weak compared to the Nifty and the Bank Nifty, which have consistently done well in the month of March. So you might see a bit of volatility because of various factors in the March, because of unwinding of book and everything. But broadly, if we look at the indicators, and when I talk to some fund managers at the ground, they do suggest that maybe you're seeing a bit of tide turning for the broader market. So let's ask Anand as well. Anand, what's your sense? I was reading your start of the year newsletter, and you suggest that now the time is to look at micros and not macros. Is that something that you're also very bullish on, the broader market names and small and mid cap stocks?
Indeed. So what happened last year was very interesting. One, obviously, we were coming out of a very low growth. Last year was a growth issue, both on the broader economic front as well as on the earnings front. We had, having said that, we had some support coming back in terms of fiscal spending as well as monetary easing. So as we speak, starting into 2026, we believe from a broader economic point of view, we'll see gradual recovery. I'm not going to see a V-shaped recovery, but we're going to see gradual recovery. And that would offer opportunities to identify businesses which sort of got impacted last year because maybe the credit market was tight or the growth in general or capex, government capex was slow, and to that extent individual. The second element that happened last calendar year had been the India's underperformance versus emerging markets and global markets, particularly India being an anti-AI play, whereas the world was all talking about only AI last year. So a lot of equity money moved from India or similar nations into Korea, into Taiwan, into NASDAQ, and so on and so forth. So we had an extreme move in the markets where AI stocks and AI-related stocks took the frenzy, and India significantly underperformed, almost 30% underperformance versus the global emerging markets and global markets. So obviously, the India's premium to the global markets also came off. Not that India became cheap, it's just that the global markets became very expensive. But so to that extent, there can be some reversal of flows also as there is some bit of slowdown or sort of a unwinding of the AI investing. A little bit of a sell-off in the AI stocks can lead to money moving back into emerging markets, especially India, or in the old economy markets, which is including manufacturing and other pieces of the economy. So we are very bottom-up this year. Not that we are never a bottom-up, but more importantly, we went out and told people that this year will be a year about stock picking, about identifying which businesses, and you would have sectors where some businesses will do well and some businesses will not do badly. So a lot of focus on identifying businesses will recover, which will benefit from the recovery in the economy and participate. Similarly, you already seen YTD what's happening into a particular sector, IT sector versus what's happening to the other sectors.
Yeah, got it, Anand. I'll tell you what, we'll just slip into a short break, telling our viewers not to go anywhere. We'll come back. We'll continue the Decode Market Action with Anand. Stay tuned. Welcome back to Airtel's Roundtable. Well, we're still in conversation with Anand Shah. Anand, I wanted to ask you about the sector that's been twinkling of late. That's the metal index. Now, you've made big money sticking with the momentum. Now, suddenly, there are some challenges that are creeping up. The dollar index is showing signs that, in fact, maybe it's bottomed out possibly, which will be negative for LME prices. And also, if these tariffs come off, a stock like Hindalco could get impacted because that Midwest premium will come up after going from around $800 to around $2,200. What's your preference from the metal pack? Do you believe the run is done, or do you believe there is still value in select counters?
So in metals, we've been always bottom up. To be very honest, it's much more than just dollar debasement. It's to do with underinvestment in the sector globally ex-China. I think for almost more than a couple of decades, China has been adding most of the capacities, be it in ferrous, non-ferrous, and all the way up to rare earth metals. So we have reached a point where there is a disincentive to invest more in China, given there are sort of tariff barriers being created. And to that extent, we would see there would be not only underinvestment in China, but there will be some unwinding also, in the sense as they don't make money, and there is the entire anti-involution drive that I don't know if you've heard of it, but that's been the buzzword in China across chemicals, metals, and other sectors.
Anand,
what I'm
yes,
saying about metals
Anand,
applies to many
yes,
manufacturing sectors.
Anand, that anti-involution, we are taking that on board, the dollar move as well. Just give us, if you could give us your preference between ferrous, non-ferrous, where do you see the bigger trigger out there? Because, as you're talking about anti-involution, in China, they're already at 97% capacity utilization on aluminium. So what the preference be? Non-ferrous or ferrous? Out there, they're still exporting a lot of steel. Please go ahead.
So obviously, we have exposure to both the sectors, and as I said, it's more bottom-up. But if you ask me today, we have seen significant rally in the non-ferrous sectors, whereas ferrous has not yet moved the needle. And to that extent, ferrous has a much more room to go up versus a non-ferrous sector. But otherwise, cash flows, profits, and even the relative valuations, I think we would identify businesses in both the segments of the market.
Hi, Anand. Quickly, a last word on in terms of asset class. Any view on gold and silver? Because that's something which a lot of investors and viewers do anticipate and keep asking us.
Indeed, that is one clear play on dollar debasement, and I think that the verdict is not out yet. While we for very long were convinced that it's a era of weaker dollar in times to come, which was significantly positive for gold in particular, but also had some bit of a rub-off effect on silver as well. But I think the larger, if you see if this metals and particularly silver is rallying, is I think there has been a sort of a repression of savers, in the sense that we are looking at global reflation coming through. Governments are very leveraged, and they're continuing to spend heavily to stimulate the growth. At the same time, there has been, as I said, there are supply constraints, there are tariff costs which are coming up. So inflation is going to remain elevated, while the central banks are, for some reason, going to cut interest rates or keep it low for longer, which means that savers will be punished. And to that extent, part of that saving would be encouraged to move out of financial assets back into real assets like gold and silver. And that is something which we are watching very closely.
Got it.
Anand, thank you very much for joining in. And to all our viewers, enjoy Valentine's Day. And next week is going to be the India AI Impact Summit. So all roads are going to lead to Delhi, with global tech majors and CEOs all gathering in Delhi. So it's going to be an interesting week, an exciting week, especially after the big fall that we've seen in tech this week. Thank you very much for watching Editors Roundtable. Stay tuned to CNBC TV 18 for more news and updates.
Hello and welcome to the Global Dialogue. I'm Shireen Bhan. Over the last few days, AI and its disruptive potential have spooked investors in the IT industry, but there are clear beneficiaries of this AI surge. German industrial giant Siemens is one of them. The company has raised its earnings guidance and beaten market expectations for the first quarter, driven by a surge in demand linked to artificial intelligence. Its digital industries division recorded strong profits powered by its automation and software businesses. Revenues and orders rose across all regions. The smart infrastructure division continued to see broad volume growth. Now, Siemens is betting big on AI, aiming to grow its factory automation business and tap rising demand for electrification products from data centers. The company calls it a mission to automate everything. But why this aggressive push? Let's understand the company's vision from its CEO, Roland Busch, whose career at Siemens spans over 3 decades now. Roland Busch, many thanks for joining us here on the Global Dialogue. Appreciate your time. You're no stranger to the move towards AI. You've been pivoting Siemens to a greater AI-led future for a good part of the previous decade, Roland. So let me understand where things currently stand. We've seen headlines talking about a white-collar catastrophe, about how jobs are going to be disrupted. What does it mean as far as smart factories go? Are we talking about completely robot-driven factories, no human factories? What is the future looking like, and how soon do we get there?
So, well, this will not be that dramatic. I mean, obviously. So you will see still manufacturing sites with labor on the shop floor, but we will see that also technology is evolving. The level of automation and digitalization is increasing. There's a massive amount of money going into robots, and they will make a change as we go forward. So, in short, I would say it's not that labor is disappearing from the shop floor. It's evolving into a different way of labor which you need on the shop floor. You need more people programming robots, dealing with technology, automation technology, and the like. And there's pluses and minuses into it. Think about the United States, Germany as well. If you have countries and economies where you have really a labor shortage, let alone a labor shortage on trained labor, then you obviously want to go as digital and as automated as possible in order to really run your plans less dependent on labor. It's a little bit different in India. I guess you still have many, many people which are pushing in the market, which you, by the way, have to train as well, because they have to have a certain level of knowledge to do that. AI is supporting that, is accelerating the way how we automate, how we design products, how we design plans. We create digital twins of a product, of a plant, and then we build it. And then you can come to a completely different level of automation and digitalization. Also in the shop floor, you have agents which are doing the job. They are working like supervisors, which can fix problems. You still need people on the shop floor. If you have to exchange a gearbox or whatever, you have to do something. But it will change as we go forward. So there's a level of disruption, a certain level of disruption in it. But it's not a world where you can shut down the lights on each of your manufacturing sites.
Okay, no lights out just yet, at least as far as humans on the shop floor are concerned. But, Roland, you said it's not going to be as dramatic as it's being made to sound at this point in time. I want you to comment. We just heard Elon Musk talk about the fact that surgeons are going to be replaced in 3 years. Now, when you hear headlines like that, people are wondering, like, what do we do? What do we train for? What is the workforce even going to look like? From your vantage point, you operate in different jurisdictions across different sectors. I mean, lay out for us, what kind of a world are you preparing Siemens for?
Yeah. So to give you an idea, we invested over the last 20 years, 30 billion in our software stack, in our software portfolio. And here we talk about our software is really software which creates physics-based digital twins of products, of manufacturing sites, of any kind of infrastructure. So, the first question is, would AI replace all that? And the answer is no, because this software, again, physics-based, gives you always a boundary, what's possible and what not. Hallucination is not an option in your design. It's not an option in manufacturing. So therefore, once you contain any kind of AI technology within the limits, which are really super important to have, to rely on the decisions you make, That's a super good combination. Yes, you can still accelerate your simulation by 10, 100-fold, 1,000-fold, and make it accessible to many, many more people using AI, but you still need this combination. So therefore, this is one area which I think is super important. Now let's talk about robotics and autonomous robots, which do everything. It will take a long time until you finally rely on a robot making surgery rather than having a human. I don't know what your choice would be, but there's definitely a way to go to do that. I see two ways. One is that everybody talks about humanoids. The other one talk about robots on a shop floor. They look completely different. Why would a robot on a shop floor have legs? This is complicated. It costs energy. You don't need it. If it goes to in a social area, we have to have service robots doing different things. You might have it because the whole world is made for human-like people or even robots. And again, the level of autonomy, if you really are serious about it, if you try any humanoids on a shop floor and let them work, it's not on that level yet. Technology will evolve. You will see a stronger and stronger way of AI impacting any kind of automation, traditional automation or robots. But at the same time, and this is what people very often underestimate, the level of quality, predictability, reliability on a shop floor when you manufacture something is so high that you really have to see how technology is evolving over time to bring it into a productive way in that space.
You know, Roland, I want to go back to the point that you made about the 30 billion investment in developing software, and that's large part of what Siemens does. And I want you to respond to what we're now seeing happen across the world. Tech stocks are selling off, and people are calling it the SaaSpocalypse. It's the end of SaaS as we know it. Do you believe that that's overdone, overblown?
Yes, it's overdone. You have to, I mean, it's a complicated matter, but let me give you a very simple view on it. There's one level which I believe is very much on the spot or even already has a huge impact in terms of being disrupted. And these are technologies like, if you talk about call centers, if you talk about, I mean, really developing software code and giving the next code line by AI. I mean, this is where you see already a huge pressure and also layoffs of people, people replaced. This is where AI hits in, or already hit in. So that's one thing, and impacts some business models, as you know. Second level is any kind of software which does repetitive things. So data in and repetitive, predictable things out. Call it workflow or multi-workflow software. Part of that is ERP systems and the like. Because they do the same. They do things according to certain regulations and processes. That's something which AI can do, assuming that you get your data straight. The very important point, you have to have your data really tagged and contextualized in the right way. Then AI can do quite a bit. And that's momentarily maybe the biggest thing what happens on the market. People are thinking that AI can do that. Here I would say, yes, that's a topic. You can do that with agents, orchestrator agents, and many of those. Can you do that right away for companies like Siemens? I mean, we have 320,000 people. We have 150 manufacturing sites. Our ERP system, I cannot just say throw AI on it. We have to really be very, very careful because while we deliver something like 80 billion of revenue, we have to make sure that this works. Can a smaller company go faster on that one? Maybe, but you see that impact. The third level, which I believe, and this is what I talked about, is not impacted, but accelerated more and made it more accessible to others. So I see rather an upside, is really the software, which is vertical specific, which is integrating, which is bringing the physics behind it. That's something where these models, and these are SaaS models too, they keep on going because they do something really different. And they are working on in an industrial world where reliability, precision, and predictability is super important. So here I would say this is more an enabler or an accelerator to really spread that software to many, many more people rather than a disruption.
Okay, that's a contextual response that you've given us in the context of a company that is 177 years old and dealing with that legacy as well as its future. But Roland, you know, I want to understand from you what the economic climate looks like and what that means as far as your business is concerned. Good quarter, you've raised your guidance, order book is looking strong at 117 billion for 2025. You know, with all the talk of tariffs, with FTAs, some done, some in the mix of being done, including, of course, the India-EU FTA. What's the outlook and what does that mean as far as business goes?
So, I mean, we had a good growth. Order grew by 10%, revenue by 8%, and the growth came from all our businesses in all regions. And by the way, India was contributing with 15% of revenue increase. So therefore, very strong pull here from India. But we see in other areas too. Particular growth areas were data centers all around the world, in particular in the United States. We see growth from software. Coming back to what I said before, our software business is growing nicely. Is it simulation software, PLM software, EDA software? And we saw a pickup, and this was very, very important for us in automation. Slow, but it's coming. Tariffs don't impact us so much because we are very much local for local. We are a global company, but we really have local manufacturing sites. We purchase locally. So the level of local content in the United States or in China is on a 85, 80, 70% level. So therefore, this is less of an issue. We have it in our views. We don't see constraints now from supplies of any kind of electronics at this point in time. So the hope is that automotive market is coming back, and along with that, supply and machine builders, which is still holding a little bit back. And then we see growth areas like, I mean, pharmaceuticals is growing. We see aerospace and defense is growing. We see a certain growth also in the food and beverage kind of area. So therefore, automotive still a little bit slow, but overall somehow picking up. Let's hope that we don't have other new tariff discussions coming up and trading restrictions that would not help. But other than that, we have a good start in Q1.
Well, a good start in Q1. Let me double down on India. You talked about the kind of growth that you've seen in India. Data centers, of course, globally for you, boosting business. And that's a big push, government push here in India as well. What will be the levers for future growth in India for you, Roland? And M&A in 2026, is that going to be a big part of the strategy?
Let me start with India. India does a very good job in building a substantial, better infrastructure. Is it energy infrastructure? Is it logistics, mobility infrastructure? I mean, India was electrifying 30,000 kilometers in the last 5 years, and there's 10 more to go. And then the whole country is electrified. We are delivering 1,200 locomotives, electric locomotives into the stock. So this brings the logistics costs down, which are quite high in percentage of GDP. You bring that down, which is super important to add then more and more industrial manufacturing, also more complex products. That's the way how I see India going. And you need obviously a good power supply and a reliable power supply as well. India is working on that as well. So therefore, my view would be that it's not only data centers, which you need as well, but that you also get more and more manufacturing, which you currently, and when you purchase parts from the outside, you can do that in India in a very competitive way. And one more thing is, India will demand also some local touch products. So localization, not only of manufacturing, but also the ecosystem of supply and local designs to meet the local demand is super relevant. That's what we do, by the way. That's our strategy. For your second question on M&A, it's always a part. So we're looking into the market. We have the firepower to do acquisitions. We are not going for huge ones. We go more for bolt-on acquisitions, but we did quite well in the last years. And the areas are, as you can imagine, it's software, but any kind of connected hardware which creates data, because that would feed into our strategy. Combining the real and digital world means that you really need data from the shop floor connected with software and create digital twins, which finally improve your operations.
Roland Bush, we would have loved to continue this conversation. Unfortunately, we're out of time, but we look forward to seeing you here with us in India and take this conversation forward. But for today, many thanks for joining us and appreciate you being here with us on the Global Dialogue. We're going to take a short break here on the Global Dialogue, but don't go anywhere. When we return, Raj Shah of the Rockefeller Foundation joins us right after this. Welcome back to Global Dialogues. 93 low and middle income countries, including India, could face nearly 23 million additional deaths by 2030 as global aid declines. And that's roughly equivalent to the population of Florida. This according to a report in the Lancet Global Health. The Barcelona Institute for Global Health, with the support from the Rockefeller Foundation, analyzed data from 2002 to 2021 and outlined two defunding scenarios. A mild reduction of about 10.6% annually could lead to 9.4 million preventable deaths. Sharper cuts of 15% or more, as seen between 2024 and 2025, could result in over 22.6 million additional deaths, including 5.4 million children under the age of 5. Notably, 2024 marked the first time in nearly 3 decades that major donors, including the US, UK and France, all reduced aid, with further cuts expected in 2026. Humanitarian assistance is now taking center stage at the 2026 Munich Security Conference as the security fallout of these cuts comes into focus. Meanwhile, President Trump has revoked a scientific finding that climate change poses a public health risk, a move that removes emission limits on vehicles, power plants and other major pollution sources. The administration says the rollback will lower regulatory costs and support businesses, claiming savings of up to $1 trillion. Well, joining us now from Munich to discuss the global impact of aid cuts and the humanitarian risks ahead is Dr. Raj Shah, the president of the Rockefeller Foundation and the former U.S. aid administrator. Raj, always a pleasure. Many thanks for joining us here on CNBC TV 18. You know, through the week, the headlines have been screaming disruption on account of AI and, the global IT sell-off that has captured imagination. But little attention is being paid to the numbers that I just read out on the cuts as far as global aid go and the impact that that's likely to have on global health outcomes. How concerned are you today?
Well, we're extremely concerned, and thank you, Shireen, for reporting on this. Look, about a year ago, President Trump shut down U.S. aid, and America pulled back 67% of its resources for humanitarian aid and assistance and global cooperation. The United Kingdom has reduced by almost 40%, France and Germany by almost 20%. And we're seeing those as just the first step in even further reductions coming in the future. So we now know, after a year, what the impact of these cuts will be. As you point out, somewhere between 9.5 and 22.5 million people will likely lose their lives if these cuts persist. 5.5 million of those kids are under the age of 5. And here's why that matters. At the end of the day, if we were today to have a 2008-style food security crisis or a 2014-style Ebola crisis, those would become global points of instability because we are taking down the ability to solve those problems in the places where they occur. And so far beyond the loss of life, which is tragic and a moral catastrophe, we're making the world less safe and less interconnected by embracing a highly transactional view of great power competition. This Munich Security Conference has the opportunity to lift up an alternative, a view of great power competition that includes some enlightened values, where we say, look, there are some common global threats, pandemics, health risks, climate risks, and if we work, and AI, frankly, as well, and if we work together to address those risks, we can all be safer and more secure.
But are you seeing any takers, Raj? That's the big question at this point in time. It's, the global attention and the focus is on how to deal with tariffs, how to deal with the volatile economic climate, how to deal with AI. Is this even getting any attention at the security conference in Munich?
Well, our goal is to elevate this issue and to make sure people understand that since World War II, a great part of the reason for why we've had relative peace and prosperity and stability across this planet has been a view towards global cooperation that's been informed by values and not just might is right. And so that's what we're working on, is to get that visibility. I will say, if you look just at the tariffs, the economic coercion is in the same direction. You know, prior to President Trump, America's generalized tariff rate was about 2.6%. Now, on a generalized basis, it's about 13%. For the 44 poorest countries in the world, most of which are in Africa, it is 27%. And so it's the tariff fight is actually doubling down on the humanitarian and development pullback to make life harder and more challenging for the most vulnerable countries on the planet.
Well, speaking about future vulnerabilities, Raj, President Trump has revoked the scientific finding that climate change poses a public health risk, a move that removes emission limits on vehicles, power plants, and other major pollution sources. What kind of a setback do you see on account of this?
Well, this is a tremendous setback, but one that I think almost everybody saw coming. The reality is in the last 3 years, we've seen the rate of global warming increase by nearly 40% over the prior decades. And the truth is, just by ignoring the issue isn't going to make it go away. A much smarter strategy is to play to win the future. There's no reason why every economy shouldn't be racing, including the United States, shouldn't be racing to win the fight, to invent the batteries and stationary storage solutions that can transform economies, to build renewable energy solutions that can power data centers and enable a clean, sustainable, and bright new future. And simply trying to win the past is not going to be an effective strategy for any single nation. And when it happens in a country as big and powerful and relevant to the global economy as the United States of America, it's a setback for the whole world.
Well, in this scenario, Raj, what are we talking about? Is there a silver lining anywhere in sight? 2026, are the cuts expected to get worse? And the role of the private sector, do you see the private sector retreating further even?
No, I actually think the private sector is the silver lining. So in India, for example, at the Rockefeller Foundation, almost all of our projects are large-scale innovation and science-based public-private partnerships that bring government, entrepreneurs, local, in that case, rupee-based capital into projects that are, for example, trying to reach hundreds of millions of people in rural India, farm communities mostly, with improved, more consistent and lower cost electrification so they can create jobs and opportunity. We see the same project taking hold in Nigeria, in Brazil, in many countries that are effectively middle-income countries and have greater state capacity. The silver lining is a new model of development, of inclusive growth, and of shared prosperity that brings the private sector and science and technology together to serve those who are at the bottom of these economic ladders. The challenge, of course, is in countries that are fragile states. In those places, right now, we're setting ourselves up for an absolute catastrophe should we face a food crisis or a pandemic that looks anything like the ones we've experienced over the last 2 decades.
So in the interim, the big vacuum that's been created because of government funding and aid being cut, the private sector can do its part. But what happens in the interim till we actually see, some governments take a call on returning back to the table?
Well, I think the answer to that question is also the answer to how we get governments back to the table. We at the Rockefeller Foundation have launched a partnership with Mr. Beast, for example, a young YouTube executive who's well known around the world, a YouTube influencer, who reaches 800 million young people. And when we do school feeding programs together in Ghana and Kenya and elsewhere around the world, those young people react strongly. They say, look, we want kindness to go viral. We want to live in a world where there's some degree of compassion and empathy. These are people who've grown up on their phones and who have ready access to the lived experiences of people all around the planet, and frankly have a bit more compassion, empathy, and understanding than some of our most cynical older leaders. So my answer to that question is we need to embrace a form of collective accountability where we're not just relying on governments, but we're tapping into the sentiments of the best elements of human nature across young people across this planet and getting people to do what they want to do naturally. No child wants to look at a starving kid far away, going hungry, skipping out from school, working in forced child labor because they don't have the opportunities that kid has. And we understand that instinctively. And so our effort is to try to unlock a movement based on that sentiment.
Well, we do need plenty more of that kind of movement, but you are going to be here in India in the next few days, Raj. Take us through what the plan is now for India and a status check on the projects that you have currently underway here.
Well, we're very proud of the work we do in India. A lot of it is with the government. It's with the private sector. The signature effort we have is called the Global Energy Alliance Initiative, which is reaching tens of millions of people with access to power and electricity. We're using technology of a small AI company that has helped digitize the entire electricity grid for Rajasthan. And we can literally see the outputs of that very tech-heavy investment where they use drones to map every single element of that grid. And now they can shift from coal to renewable sources where it's cheaper and more efficient to do so. Now they can have farmers build out solar infrastructure on their farms and sell into the grid and get a feed-in tariff. And the reality is, if we can lower the price of electricity and energy for rural communities in India, we can improve agriculture, we can improve farm incomes, we can improve women-led businesses and the jobs that they create and the incomes they have, and empower those women and transform India's lived experience for the, for the poorer rural communities and farm communities. And we're really excited about that project. It's a big part of why I'm visiting India, including going to Lucknow to see some of the new expansions of that effort. And that's just a great example of what's possible when we bring the best of modern technology together with policymaking and government partnership and a little bit of philanthropy. We can reach hundreds of millions of people and make their lives better.
Well, Raj, look forward to seeing you here in India. And thanks very much for joining us from the Munich Security Conference. We do hope that there are takers to the pitch that you're trying to make. But at this point in time, it does look like it is a fairly sobering reality. But appreciate you joining us here on the Global Dialogue. With that, it is time for us to wrap up this edition of the Global Dialogue. From all of us here on the team, for now, goodbye. Thanks very much for watching. Do stay tuned to CNBC TV 18. We've got plenty more lined up.
Hello and welcome to this special program. The recent very sharp sell-off in software stocks reflects a rapid shift in investor sentiment rather than a sudden deterioration in fundamentals. The IT index has sold off about 14% here in India in the last 7 trading sessions. The sell-off began in global software names, US-based companies like Cognizant, Accenture, Globant, EPAM, etc., which have also sold off really hard. Over the past several weeks, announcements around new agent orchestration platforms, Claude Cowork, OpenAI's Frontier, have created a powerful narrative that horizontal AI layers will coordinate company workflows, enterprise workflows, automate complex tasks, and ultimately capture a disproportionate share of software budgets. That's the basic core worry here. The concern is that if AI agents become the primary interface for executing work, traditional platforms could be relegated to kind of passive data stores with pricing power and strategic relevance migrating elsewhere. That narrative has contributed to aggressive multiple, that is P multiple compression across software companies, often with little regard for differences in business model, end markets, or actual AI execution. And add to the barrage of articles on social media platforms telling us how the world as we know it has ended. Well, too dramatic? I think so too. But one thing is absolutely clear. Things are changing. The pace of change is perhaps the only question. My guest today is a rare full-stack visionary in the world of technology. Dr. Vishal Sikka doesn't need an introduction. He's not just an observer of the AI revolution. He helped build some of the foundations of this revolution, which is at our doorsteps today. From, of course, pioneering the SAP HANA in-memory platform to serving as the first non-founder CEO of Infosys, he spent his career preparing the enterprise world for the so-called timeless software era. He's, of course, now the founder and CEO of Vianai Systems, where he's solving the hallucination problem for the world's largest companies. Dr. Sikka, thank you very much for joining us here on the program. Really appreciate your time here. Sorry for that long preamble, sir. Let me get straight to it.
It's okay.
You ran one of the largest IT services companies in India. Given what is happening in the US and all these technologies, is the Indian IT services business model prepared for this?
I think if you look at the application of generative AI to knowledge work, this disruption is real. It is here. In a broad strokes, you could say that all kinds of repetitive, knowledge work that we do can now be done using generative AI a lot more productively. But at the same time, we have to keep in mind a few important things. So in principle, that message is clear. It is real. This disruption is here. Like you said, it is on our doorsteps. But we have to keep in mind a few additional things. First of all, things are always slower than we expect. Adoption takes time. Enterprises are very complex. They are like countries. Large companies are like civilizations. Some of them have been around for hundreds of years, if not decades. I'll give you an example of Waymo, for example. In 2006, at Stanford, we had built a car which drove autonomously and won the DARPA Autonomous Driving Challenge. That was in 2006. That was 20 years ago. Sebastian Thrun, a dear friend of mine, built that. And now we have Waymo. Last year, Waymo did 15 million rides, but 15 million rides is less than 1% of all the taxi-type rides just in the US. So it takes a long time and even in terms of autonomy, there is a lot of still advancements to happen. Similarly, in the services industry, there are dozens of service lines. AI's impact on those service lines is not all uniform. It is not, doesn't happen overnight to all of them. Some systems are much more complex than others. And so the rate of change is always as slow as the slowest pipe in the network. So we have to keep those things in mind as well. But having said that, I used to say this 10 years ago, 9 years ago, whenever that was. And it is here now. And we have a short window of time in which to sort of transform.
Dr. Sikka, what has changed in the last 4 to 5 weeks, if I can put it that way, which is so dramatically different? Is something dramatically different? Because, I mean, AI is not new. We've been talking about it, but it seems like the pace has accelerated in the last 2 weeks. Is that correct?
It is. It is correct. The acceleration has been happening. Back in 2014, when I had started at Infosys, AlexNet had a couple of years before, AlexNet had beaten human performance on computer vision on ImageNet. And from that time onwards, transformers came around in 2017, 2018, and then the big models started to come. The ChatGPT was 3 years or so, 3.5 years ago. So there has been a continuous improvement. About 8 or 9 months ago, we saw the first reasoning models, O1, and then shortly after that, O3. And then one of the things that the big frontier model companies have done is integrated tools into the models. So within the chain of reasoning, they integrate tools. That's why software development becomes that much more powerful, is because tools like the shell, Python interpreters and compilers and other verification tools are all built inside the models themselves. And so that makes them much more powerful at creating correct code. And now, Anthropic launched this co-work thing, and Google has launched a bunch of things. Yesterday, Isomorphic launched a dramatically better approach towards the pharmaceutical drug discovery area. So yeah, there is no doubt that the pace of change is accelerating.
Pace of change, so there are these plugins, right, which you're talking about, the Anthropic, which happened, I think, last Tuesday, last week. I mean, basically, the general assumption is that Indian IT companies will integrate all this AI technology into an enterprise workflow, etc. So is that argument now on shaky ground? Because as you're saying, there are these plugins. But the pushback to even that is, well, you need plugins to plug in plugins, if I can put it that way, right? So that's my question. I mean, is the integration aspect of Indian IT there? What's your sense?
I think the prescriptive kinds of work, if a particular project or a particular service line is about work that can be repeated, that can be prescribed, such that people can be asked to do this, they can be trained to do this work. This kind of work can much more easily be done, using AI. This is already possible today, including complex kinds of transformation work, moving programs from one system to another, migrating, and things like that. A lot of this kind of integration work, writing code, glue code to connect systems and things like that, this can all be done much more easily using software, using AI. Can it be done 100% autonomously already? No, absolutely not. But people who know what they are doing can definitely see dramatic productivity improvement. So one could say that the gain in productivity because of using generative AI can be quite substantial.
Yeah.
At the same time, if people don't know the power of generative AI, if they don't have the fundamentals, they don't see that much gain from generative AI. So this is what Melanie Mitchell, who is one of the researchers in AI, called it the jagged frontier, that certain tasks, because of the nature of the task, don't see that much productivity gain. Certain people don't see that much productivity gain. And I was talking to a friend of mine who is he was a student with me at Stanford, and he's a genius. He rebuilt a site that earlier had been done by 15 people over 9 months. He rebuilt it himself in 14 days. So that's more than 100 times productivity improvement. I have seen examples of 20, 30x productivity gain and things like that. The important thing, Prashant, is that do we want to keep looking backwards? Do we want to keep looking at tasks that we already do? And do we want to limit ourselves to what we did in the past? Do we want to be afraid of the disruption and automation to the things that we did so far that brought us here? Or do we want to look at the opportunities of what are the new things that I can do with what we have in our hands? And I think, I focus much more on the latter. I have a small company, and life is a lot more interesting when you think about, my God, we have this incredible ability. What can I do with it? And I think when I look at it from that lens, it is incredibly exciting.
Dr. Sikka, sorry, this is we can have such an expansive conversation, but for now, and we will have that. But I'm kind of bringing you back to some of those particulars.
And I will be in Delhi next week, for the AI summit.
And we can have that. We can have that expansive conversation then. I mean, if you have time, and hope to see you there, Dr. Sikka. So, if, as you said, productivity goes up this much, which means effort falls, right? 10x, 20x. So, which means what then? I mean, as for Indian IT services companies which are servicing US clients, clients will see, right? I mean, you are using this and effort is now down this much. Is this deflationary in a big way on pricing? IT companies we speak to here in India so far have held out saying that it's not deflationary. So far, we've not seen that. What's your sense?
I think we have to separate the potential, the promise, if you will, of this disruption from how it impacts in the here and now. In the here and now, you have particular projects that people are executing on. And if a client expects that you now do this project dramatically faster or cheaper or with less people or whatever, then that would impact the here and now. But that is something that takes time. That's what I meant by depending on the service line, depending on the nature of the work, depending on the team that is involved, and things like that. So there is the fear in general of the potential of what this can do to knowledge work. But then there is the actual reality of creating an enterprise-ready offering that uses these new capabilities to deliver those. So there is a gap between them, and that gap, some of these services, there might be companies already offering new kinds of ways of doing the same services. And then, of course, you have much cheaper, much better alternatives available in legal services and many other areas. There are companies like that already. But then there are others where it might, take years for these new kinds of offerings to show up. So how much a particular services company is impacted by AI depends on how many of their service lines are being impacted by use of these or by alternate offerings that are much better than what they are doing or what the client's expectation is. I do see clients asking for discounts and all of that. There was a famous example of a large audit company that was asking for an AI discount on its own audits and so on. There was a report that I read about that. So there is that expectation that there is some productivity gain that is being baked into what you offer. But we have always dealt with that. So in other words, what I'm trying to say is, I'm sorry, it is not a simple black and white answer. In some cases, it might be something that people expect to happen today. In some cases, it might take years before you can deliver a transformed new kind of a service. And you have to see individual companies where they are at in that spectrum of disruption.
Yeah. No, it is not a simple...
Does that make sense? Because in principle, the disruption is here, but whether it hits a particular service, a particular project, a particular quarter, depends on the nature of the situation, and that can take time.
Hello and welcome to Business 360. I'm Arundhati Ramnan and these are the top headlines that we're tracking for you this evening. Fear surrounding AI triggers a massive sell-off on Wall Street. Top 7 stocks end lower. Indian benchmarks feel the jitters as well. Top IT stocks lose 2.6 lakh crore rupees in market capitalization this week. Microsoft's AI head says that artificial intelligence could take over most white-collar jobs within the next 18 months. Former Infosys CEO Vishal Sikka says that there's a gap between AI's promise and enterprise-ready reality. Also warns that it should not be assumed that slow adoption means no disruption. Money continues to flow into AI firms. Anthropic raises $30 billion at a valuation of $380 billion. The company has more than 500 clients who are spending over $1 million compared to just a dozen 2 years ago. India's sovereign bonds rise after government undertakes a debt switch with the Reserve Bank. Centre issues bonds worth over 75,000 crore rupees maturing in 2040 to ease redemption pressures and borrowing needs for the next financial year. Axis Bank CEO Amitabh Chaudhary says acquisition of Credit Access Grameen is pure speculation, but also adds the bank is in early evaluation stage of the opportunity. No decision yet on whether to pursue the acquisition or opt out. That's an exclusive. BNP reportedly registers a landslide victory in Bangladesh parliamentary elections, clears the path for Tariq Rahman to become the nation's next prime minister. Once a political pariah, the Jamaat-e-Islami emerges as the second largest party. Country's election regulator is yet to officially notify the results. 68% vote yes in the referendum on constitutional reforms. A tumultuous first leg on the budget session of Parliament draws to a close. The House saw heated exchanges over the India-US trade deal and the unpublished memoir of former Army Chief General Naravane. Parliament will reassemble on the 9th of March. The top lawyer of Goldman Sachs resigns after latest revelations in the Epstein files. General Counsel Catherine Rumela remained a close ally of the convicted sex offender through his arrest in 2019. The Trump administration revokes an Obama-era scientific finding which concluded that greenhouse gases pose a threat to public health and welfare. The finding serves as the legal bedrock for the U.S. government's climate rules. White House calls the move the largest deregulation in American history, says it will reduce cost of new vehicles by an average of $2,400. Those were the headlines that we're tracking for you this evening, but the top story today. Continued fears of AI disruptions reignited a massive sell-off on Wall Street, with the top 7 IT majors clocking steep cuts. Indian tech stocks felt the jitters as well, with top companies losing close to 2.5 lakh crore rupees this week. The Nifty IT index has fallen over 8% in the last 7 days, and this marks the index's steepest drop in 9 months. Rima Tendulkar is here with all of those details. Rima, what's triggered this sharp sell-off?
It was one of the worst weekly falls for the Nifty IT index in recent times. At the session low, the index was down 11.7%, making it the biggest fall since the COVID times, March of 2020. Of course, by the end of it, the index recovered and ended with a fall of about 8%. But it doesn't hide the kind of pain the Indian IT companies have been going through for a while. From their all-time high levels, from the peak levels, we've seen a fall of 30-40%. 40% plus for TCS and Wipro, 30% plus for Infosys. Even Coforge and Persistent have seen very sharp drawdowns, and these were some of the best performing mid-cap companies. I think the big question everyone's grappling is this just another tech cycle where Indian IT companies will be able to pivot, they'll come out on tops, and therefore the sell-off that we're seeing is a bit excessive, it's a good buying opportunity, or is this time really different? Well, Citi has a view, and they're saying that this time it's different. Yes, the Indian IT companies have weathered many storms, Y2K cloud, but this time it's different for 3 key reasons. One, the incumbency risk. The Indian IT companies this time are much larger. They've doubled in size. since the cloud era. So therefore, they're the ones who are going to be disrupted rather than being the disruptor. Secondly, the AI impact is more pervasive. When cloud came, it impacted infrastructure, the way data was getting stored. But the impact of AI is on the operations and the business model, the entire value chain. And finally, the third reason is new AI work is coming in, but it's smaller. It's more pilot, exploratory, and not enough to offset the pressure on the legacy business on account of revenue deflation. But JP Morgan has a contra view. And here they're talking more about the kind of valuations. They're not talking about the business impact per se, but they are speaking about the valuations where they say the free cash flow and the dividend yield are now screaming deep value. They're saying that these are levels that we had last seen during very severe market dislocation like GFC and COVID. And they've laid out 3 scenarios, and that is very helpful for us to gauge where Indian IT companies are headed. But of course, it depends on what your view is on growth. They're saying that from FY23 to FY25, IT companies grew between 2 to 3%. If you assume that is going to be the growth rate, low single digits, then IT stocks have a downside of 10%. But if you think it's going to get better, maybe IT companies can clock in a growth of 5-6%, better than what we've seen over the last 3 years, but not at par with the long-term growth rates, then maybe stocks stay where they are. But in the bearish scenario, if you assume that AI is going to severely impact the entire sector, there's going to be no growth, a 0% terminal growth, then the downside risk seen for the IT companies is more than 30%.
All right, Rima, thank you so much for decoding what's happening with those IT stocks. But here's a warning from Microsoft's head of artificial intelligence, Mustafa Suleyman. In an interview to the Financial Times, Suleyman said, and I quote, "White-collar jobs, those sitting in front of computers, whether lawyers, accountants, project managers or marketers, most of these tasks will be fully automated by AI within the next 12 to 18 months, end of quote. Meanwhile, former Infosys CEO and current CEO of Vianai Systems, Vishal Sikka, told CNBC TV18 that even though there's a gap between AI's promise and enterprise-ready reality, some disruption could be expected immediately. In an exclusive interview with CNBC TV18, Sikka warned that it should not be assumed that slow adoption of AI means no disruption.
Things are always slower than we expect. Adoption takes time. Enterprises are very complex. They are like countries. Large companies are like civilizations. Some of them have been around for, hundreds of years, if not decades. So it takes a long time and even in terms of autonomy, there is a lot of still advancements to happen. Similarly, in the services industry, there are dozens of service lines. AI's impact on those service lines is not all uniform. It is not, it doesn't happen overnight to all of them. Some systems are much more complex than others. And so the rate of change is always as slow as the slowest pipe in the network. But having said that, I used to say this 10 years ago, 9 years ago, whenever that was. And it is here now. And we have a short window of time in which to sort of transform. I think we have to separate the potential, the promise, if you will, of this disruption from how it impacts in the here and now. In the here and now, you have particular projects that people are executing on. And if a client expects that you now do this project dramatically faster or cheaper or with less people or whatever, then that would impact the here and now. But that is something that takes time. That's what I meant by depending on the service line, depending on the nature of the work, depending on the team that is involved, and things like that. So there is the fear in general of the potential of what this can do to knowledge work. But then there is the actual reality of creating an enterprise-ready offering that uses these new capabilities to deliver those. So there is a gap between
Moving on to the day's market action, Dalal Street ended lower for the second straight session, with the Nifty slipping below that 25,500 mark. 44 Nifty stocks closed in the red. For the week, market ended largely in the red, with Sensex and Nifty falling nearly 1% each. But the outliers were those defense and PSU stocks, which outperformed and climbed nearly 4% each. From equities to commodities, gold prices have bounced back from one-week lows following robust U.S. jobs data and a strong dollar. Further fears of AI disruption also aided the overnight sell-off in the yellow metal. Globally, prices of spot gold in the international market are now improving marginally. Crude oil prices are on track for a second weekly decline despite recovering marginally today. This as concerns over a US-Iran escalation subsided and geopolitical risk premium decreased. The International Energy Agency's latest report lowering its oil demand growth prediction for 2026 also weighed on prices. Axis Bank CEO Amitabh Chaudhry has said that the bank is evaluating Credit Access Grameen as a candidate for a possible acquisition, adding that the process is in a nascent stage. Chaudhry added that it's incumbent on the bank to evaluate all opportunities and microfinancing is an important business. These statements come after CNBC TV18 reported that promoters of Credit Access Grameen have initiated a process to sell their entire stake.
We will obviously evaluate this opportunity also, but we are in very, very early stages of the evaluation. We have not even decided whether we'll take the next step. But no, I mean, MFI is an important business. We've been building that business for quite some time. We have been trying to see how we can transform the business internally. Here, the question is whether you want to spend a chunk of money to buy a business from outside with all the, accompanying execution risks, or you want to build it internally. And that's a choice we will make at the right time. We are not in a hurry, absolutely.
AI giant Anthropic has raised $30 billion in a Series G round, valuing the company at $380 billion. The company has said that the investment will help it boost research, product development, and infrastructure expansions. Rachna Dhanrajani joins us now with all of those details. Rachna, how significant is the raise in the broader AI race?
Right. Anthropic's latest fundraise is a signal flare for where the AI race is headed. The Claude maker has pulled in $30 billion in fresh capital, pushing its post-money valuation to $380 billion and cementing its position as the clear number 2 in frontier AI. The round, led by GIC, quote, with participation from D.E. Shaw, Dragoneer Founders Fund, Iconic and MGX. What is driving that conviction, though, is not hype alone. Anthropic says its annualized revenue run rate has climbed to $14 billion. The customer mix is moving sharply upmarket. Clients spending more than $100,000 annually have multiplied by 7x, while those paying above $1 million have jumped from just over a dozen 2 years ago to more than 500 now. 8 of the Fortune 10 are already using Claude. Enterprise adoption is now visible on the ground. And that's the case across artificial intelligence and not Anthropic alone. We just saw Siemens say that AI co-pilots are embedded in parts of its engineering and manufacturing stack. In India, Bajaj Finance continues to highlight AI-led underwriting, collections and servicing as core to its model. Accenture and Deloitte are deploying internal AI agents. So the shift industry-wide is now pretty clear that Gen AI is moving from experimentation to operating infrastructure, and Anthropic is trying to position squarely for that in future. Now, even as the recent IT stock sell-off briefly rattled the AI trade, now to put AI trade, it was now being termed as the SaaS apocalypse. But how much of that holds up, we will find out. But to put the valuation in perspective, at $380 billion, Anthropic alone is now worth more than the combined market capitalization of the Nifty IT index, which sits near $300 billion mark. Still, the ride is not friction-free. Elon Musk has publicly accused Anthropic's models of bias, and the industry has seen some departures from safety and alignment teams at both Anthropic and OpenAI. That's number 1 and number 2 in the industry right now. Microsoft AI CEO Mustafa Suleyman also warned that the most white-collar computer-based tasks could be automated now within the next 12 to 18 months. Anthropic CEO had also warned that soon jobs will get disrupted just a few weeks back. And we are seeing that play out now. Now, all of this unfolding is amid an extraordinary capital cycle. Big tech is preparing to spend more than $650 billion on AI infrastructure this year, as we saw with the quarter earnings. Now, this brings us to the real test for Anthropic, which is execution. Now, OpenAI spent the last 2 years locking in distribution and is now under pressure to deliver margins and monetization, as we're seeing. And Anthropic is nearing a similar inflection point because the funding is in, expectations are rising. So what comes next will determine whether the capital surge translates into durable platform power. Back to you.
All right, Rachna, many thanks for taking us through those details. Now, moving on, the Supreme Court has rejected an appeal from Aircel, Reliance Communications and their lenders seeking to classify spectrum as an asset during the bankruptcy resolution. The petitioners argued that excluding spectrum from resolution processes would render any revival efforts futile. However, the Apex Court held that IBC cannot be the guiding principle for restricting ownership and control of spectrum. The court also said that spectrum is a material resource of the community and its control has to be secured for citizens. Indian Energy Exchange's shares fell after the Appellate Tribunal for Electricity dismissed its petition challenging market coupling. The order clears the way for power regulator CERC to move ahead with the move aimed at discovering a single uniform power price across exchanges. APTEL has told IEX that it can move a fresh plea to challenge them if it has any fresh grievances. The first leg of the budget session came to an end after weeks of acrimonious standoff between government and opposition over various issues, including the India-US trade and former Army Chief Naravne's unpublished memoir. The House will reassemble on the 9th of March after a 3-week recess. Tamil Nadu government has credited 5,000 rupees into the bank accounts of 1.31 crore beneficiaries under the Kalainar Women's Rights Scheme. The amount includes 3,000 rupees in advance, along with an additional 2,000 rupees as a summer special package. On that note, it is time for us to head into a short break. But coming up, the Trump administration revokes an Obama-era scientific finding, which concluded that greenhouse gases pose a threat to public health and welfare. More on that when we come back. Stay tuned. Welcome back. You're watching Business 360. The big international headlines of the day. BNP registered a landslide victory in Bangladesh parliamentary elections, clearing the path for Tariq Rahman to become the nation's next prime minister. Once a political pariah, the Jamaat-e-Islami emerged as the second largest party. Here's the caveat. The country's election regulator is yet to officially notify the results. 68% people voted yes in the referendum on constitutional reforms. Imran Khan's son has expressed serious concern over his father's health. In a post on X, Qasim Khan said that the former Pakistan Prime Minister has lost most of the vision in his right eye, with only 15% remaining. Khan's son also stated that he and his brother are still being denied visas to visit Pakistan. In response, Pakistan's Supreme Court has ordered a medical examination for Khan, particularly for his eye. US President Donald Trump has warned Iran that a failure to reach a deal about its nuclear ambitions would lead to a traumatic outcome. He also told reporters that an agreement is likely in a month, as Tehran will agree to Washington's terms. Quickly, this as the Pentagon sent USA's largest and most advanced aircraft carrier to the Middle East. President Donald Trump has revoked the Environmental Protection Agency's scientific finding in 2009, which concluded that greenhouse gases pose a threat to public health and welfare. The finding serves as the legal bedrock for the U.S. government's climate rules. Sonal Bhutra decodes the impact the move could have on emission norms in the United States. Sonal?
Well, it is a major shift in U.S. climate policy. The EPA, or Environmental Protection Agency, has rolled back one of its most important climate rulings. Now, back in 2009, they put out something called as the endangerment finding, which officially concluded that greenhouse gases like methane, carbon dioxide, they are impacting the environment and they're harmful for human beings as well. And now, the single scientific decision basically became the backbone of U.S. climate science and U.S. climate regulation as well. It allowed the government to set limits to pollution coming in from vehicles, power plants and other industries as well. But this has been repealed under President Donald Trump, and EPA Administrator Lee Zeldin, they said the finding has now been repealed, and they called it the largest deregulation move in American history. How does it change things? So basically, the US government will not be able to regulate pollution standards. They will not be able to set limits to pollution from motor vehicles, from powerhouses and manufacturing industries as well. And it will not give them any authority to regulate greenhouse gases in the country. They also plan to delay or weaken clean technology and vehicle emission standards which are linked to the ruling, and they have their own arguments. They say it will cut compliance for most of the businesses and it will lead to savings of $1 trillion. But you know, climate science says something extremely different. There have been papers as recent as 2025 and as old as 1979 which talk about how scientifically it is proven that greenhouse gas emissions cause temperature rise, they impact flooding, they impact the environment and actually cause climatic issues as well. So those things will come up for you on the screen. It's from IPCC, which is the Intergovernmental Panel on Climate Change. There have been studies from EPA itself which talk about it. In fact, as far back as 1979, one of the reports had already confirmed that human-produced carbon dioxide would heat the planet. So in simple terms, what it meant is greenhouse gases, they trap the heat and they increase the temperature of the earth, and these have been proven by scientific studies. So this has come in as a shocker and has received a lot of backlash from some of the activists and the industry as well.
All right, Sonal, thank you so much for taking us through those details. Goldman Sachs Chief Legal Officer Catherine Rumela has resigned after documents released by the U.S. Department of Justice revealed her close relationship with convicted sex offender Jeffrey Epstein. The documents indicated that Rumela accepted gifts from the late financier and advised him on how to address media inquiries regarding his crimes. Rumela and those around her have insisted she had a professional relationship with Epstein. Her resignation will be effective June 30th. The Epstein files fallout has also hit the top brass of the UK government. Britain's Cabinet Secretary and Head of Civil Service, Chris Wormald, has stepped down from his post. This after reports suggested that Wormald was responsible for conducting due diligence checks before Lord Mandelson's appointment as US ambassador. Mandelson quit after his name came up in the Epstein files. And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV 18.
Good evening. Thanks very much for joining us in India. This is how I'm Shireen Bhan. The headlines that we're tracking for you this evening. Global IT and software companies lose over $1 trillion in valuation. Frenzied selling continues due to fears of AI disruption. Shares of Salesforce, Adobe, ServiceNow amongst...
Hello and welcome to CNBC TV 18. India and the United States have finalized a joint statement whereby the two countries have agreed on an interim trade agreement, due to which the United States will reduce tariffs on Indian goods from 50% to 18%. To decode the fine print of this trade deal, we're joined by Commerce and Industries Minister Piyush Goyal. Minister Goyal, thank you very much for being with us.
Thank you.
So the joint statement is done. I think investors, exporters would now want to know, when does the 18% tariff rate become effective?
Since we had the weekend, Saturday, Sunday, after the joint statement was issued, I would suspect any day during this week, the executive order to reduce tariffs to 18% should be coming out.
Right. So does this mean that with that executive order, the rate would immediately come down to 18% in the federal register? Would it require a signing?
It would require a signing by the Honorable President of the United States of America. But now, having entered into the framework agreement and all terms being finalized, I see no difficulty in that.
Right. So are you also expecting a visit from the United States to somehow jointly announce this deal, or are you going to US?
We will have our teams now put the entire documentation in legal format so that we can sign the interim trade agreement or the first tranche of the bilateral trade agreement, for which I have invited the USTR, the United States Trade Representative, my good friend, Ambassador Jameson Greer, to visit India. He has indicated that he would accept the invitation, and maybe mid-March sometimes he would be visiting India.
All right. So for exporters, for Indian exporters, that would be the date possibly when the new tariffs would become effective.
No, the 18% would become effective immediately. There are other areas of concessions, some areas where we've got a zero reciprocal tariff. Those will become effective after the execution of the interim agreement.
Right. Now, over the last 1 year, there was uncertainty about the trade deal, and that was impacting investor sentiment towards India. The stock market sentiment also was impacted to some extent. What would be your expectation now?
Well, Indian economy powers on. It is the fastest growing large economy. Companies are reporting huge demand. January performance numbers should come out quite well in terms of the volumes. Recently, I was told steel mills are working at full capacity. I was told auto stocks are all sold out. There's no inventory at the dealers' end. Cement stocks were down to just about under a week or a few days. I mean, the indications which I have received from the market sources or public from industry, which clearly reflects that there's a good amount of enthusiasm in the marketplace. The execution and finalization of the EU trade deal coupled with the US trade deal coming in quick succession of each other, I'm sure will give a big fillip to the India growth story.
All right. Now, as far as the concessional rate of 18% is concerned, what would be the volume of the goods? If we ask you to quantify that, what volume of Indian exports going to the US will be now subject to a lower 18% tariff?
First of all, there are many goods which will get zero duty tariff. Some are already going at zero duty, some more will come at zero duty. In the aggregate, my sense is about half the exports will become zero duty, zero reciprocal duty in terms of tariffs. On the other half, almost 10 or 15% would probably be sectoral tariffs, which for steel, aluminium, and products and derivatives of that, in some cases could be as high as 50%. But then they'll have to look at how much is the steel or aluminium content, and accordingly it will be a calibrated or a calculated import duty as a Section 232 tariff, not as a reciprocal tariff. Everything else will be at 18%.
Right. How do India's labor-intensive exports benefit from that? Because majority of them will now be tariffed at a rate of 18%.
Well, they will benefit hugely. And it's not that majority of them will be 18%. Many of them will even be lesser. I see a great fillip in the textile industry. I can clearly see before my eyes the auto component or machinery parts industry, the engineering goods, the leather, footwear and sports or sportswear, sports goods, toys, furniture, handicrafts, handlooms, a number of products which directly relate to MSMEs or labor-intensive industries stand to gain from this agreement immediately. We will also see our farmers and our fishermen get increased potential of exports. We are a substantial exporter of farm products and fish to many parts of the world, including the US, aggregating nearly $55 billion. That's about 5 lakh crores. My sense is that number can easily double, particularly as we do more value addition in the years to come, to probably $100 billion.
Right. Now, there were almost $34 to $40 billion worth of exports to US, which were already exempted from tariffs, including pharmaceuticals and mobile phones for that matter. How many additional items will now face zero tariffs in the US, and could you list out some of them?
In terms of reciprocal tariff? Yes, we will have many more products enjoying the fruits of 0% reciprocal tariff, both in the agri and the industrial sector. On the agri front, all our spices, tea and coffee and their extracts, copra, that's coconut or coconut oil, vegetable wax, nuts like areca nuts, Brazil nuts, cashew nuts, chestnuts, so fruits and vegetables like avocados, bananas, guavas, mangoes, kiwis, papaya, pineapple, shiitake mushroom. Number of very, very important products which are of great interest to the Indian exporters. Bakery products, cocoa and cocoa preparations, processed food, banana pulp, citrus juices, guava and mango paste, pineapple, and there are many more. I'm not reading out the entire list. Right. We'll get zero duty on reciprocal tariffs. We also will have a number of zero duty in terms of reciprocal tariff on some more products like gems and diamonds, coins, clocks and watches, essential oils, certain home decor items like chandeliers, illuminating signs, parts of lamps, seats, inorganic chemicals like iron and hydroxides, aluminium oxides, inorganic compounds of precious metals, zinc oxides, certain instruments and apparatus, minerals and natural resources, articles of paper, plastic and wood, natural rubber. This is just an indicative list I'd kept with me. So a number of items, a number of lines have been negotiated to get zero duty.
You know, you spoke about agriculture and you've said that India's red lines have been protected.
Totally.
But at the same time, you've got farmer groups who have expressed concern and they've said that this is a total surrender, and they've also called for a protest on the 12th of February. How would you address their concerns?
I will be talking to the farmer groups or any associations. I would recommend to them also to carefully have a look at the exempt list, which I have spoken about on earlier occasions. All the areas of mass production where we are self-sufficient and which really the larger part of farmers are producing, like meat, poultry, all dairy items, rice, wheat, sugar, all types of GM products, soya meal. We have corn, maize, millets like jawar, ragi, bajra, kodo, amaranth, fruits like banana, strawberry, cherries, citrus fruits, some pulses like green pea, Kabuli chana, moong, oilseeds, certain animal feed, groundnuts, honey, malt and its extracts, non-alcoholic beverages, flour and meals, starch, essential oils, ethanol for fuel, tobacco, all of them are not covered under this agreement. They have been excluded, and the farmers are completely protected from any sort of imports with the high import duties that we impose on them. So I really think the farmers have nothing to worry. It is a few political vested interests or naysayers who are misguiding them. And I would like to appeal to all farmers and farmer organizations to carefully assess, and they will find that our farmers are fully protected.
You know, one of the points that the Bharatiya Kisan Sangh has raised, that the dry distillers grain, now that has, you know, a GM component to it. They've also raised concern about soybean oil as well. How would you address them? Because they're seeking a clarification.
Soybean oil has been imported, as has DDGS on earlier occasions, but soybean oil is imported every year in very large volumes from all over the world, including from the US. So it's not as if it's something new. The environmental protection norms are that once the product is processed, then GM does not come into play. So I will allay their concerns with full responsibility, that they need not worry. No GM products are being given entry into India.
Right. Now, there was a line in the joint statement which says that India will reduce or eliminate tariffs on all US industrial goods and agricultural products, including dry distilled grain, red sorghum, tree nuts, fresh and processed fruits, soybean oil, wines and spirits, and additional products. Now, what does the additional products mean? Is there room to include more?
There's a vast range of agri-products, many of which are, you know, of a certain type and names that we've never even heard of them. There's not much trade internationally or between India and any other country. Agriculture has a very long list of items, but these are the main agri items, what I just read out to you. What we've opened are items which we are already dependent on imports. For example, we import almonds, not today, but for decades. As children, we have eaten California almonds. We import pistachios, we import walnuts in the country. So these are certain products which for a long period of time have been imported. You are well aware that the demand for apples in India far exceeds the production. So we import about 5.5 lakh tons of apple every year. A lot of them come from the United States of America. We have given them a quota which is less than what they are currently exporting to India. And even within that, while the normal floor at which we allow imports is 50 rupees as a minimum import price, on which 25 rupees is the duty, so 75 rupees as a landed cost. With the US, the apples being of a certain higher quality, a minimum import price of 80 rupees has been kept with a 20 rupees duty. So the floor actually is 33% more than the normal apple, which is a huge protection for Indian farmers. So I would think that we have not left any cause of concern and ensured that farmers in India are fully protected.
Right. You know, speaking about the executive order, which was issued almost simultaneously by the White House along with the joint statement, it said that India has committed to stop directly or indirectly importing Russian oil and will purchase products from the United States. Could you give us a sense of what's the understanding? Because our Russian oil purchases have been coming down.
This is a subject that doesn't get included in the trade deal, nor do I handle it. I think it would best be answered by the Foreign Office, who have already made certain clarifications in this regard.
Right. I'll just persist for one more moment because the executive order also speaks about monitoring mechanisms, and it makes the elimination of the 25% ad valorem duty contingent on stopping purchase of Russian oil. So how are we going to handle this? Because the US will be monitoring whether we are buying directly or indirectly.
I think this is best answered by the Foreign Office because I wouldn't know exactly what they mean by this comment and whether any discussions have been held.
All right. Just to speak to you about the Section 232 tariffs. Are we going to be working on trying to get concessions from the US on those areas which are under Section 232 as well?
This is the first tranche of a potential bilateral trade agreement. And we will continue to work with the US to see areas of mutual benefit which can be considered in the final bilateral trade agreement. And we will certainly be taking up Section 232 tariffs in the course of those discussions.
The $500 billion worth of imports that we have said that we intend to buy over the next 5 years, how will that work, Minister Goyal? Is this an intention? Is it going to be the best endeavor to do so, or is it binding?
Well, very clearly, we intend to expand and grow the economy very rapidly. We are the fastest growing large economy. And the goods where the US can be a preferred supplier include things like GPUs and data center equipment, ICT equipment, technology products, which we need in big measure in India. Particularly, you saw the AI mission is taking wings. You saw the data center announcements in the budget. And the import of these products is almost growing at double digits, 15-20%. Energy requirements, LNG, LPG, crude oil continue to grow 6-7% every year, 8% every year. We do require coking coal for steel. We are already importing about 17 billion. Going forward, this is only going to get bigger. Our steel mills are planning to double their capacity, so we'll need more than $30 billion of coking coal. Precious metals come into India in very large numbers. Aircrafts, we already have orders on Boeing. We need engines, we need spare parts. I suspect we already have about $80 billion worth of civil aviation equipment on order, which is only growing. The demand for aircrafts and engines are growing, and more orders may be placed. Looking at all of this, clearly India needs a lot of these products. Even today, our current import of these products is about $300 billion. As it grows, in the next 5 years, we estimate our requirement of these products to be in the range of about $2 trillion. And therefore, I don't see any difficulty if the United States of America supplies us more planes, more energy, more GPUs and data center equipment, which we really need, more coking coal, more precious metals. We will encourage them because that will add to the competition. India is agnostic. We would like to buy from the best source at the best price, the best quality. And I'm sure the United States will be happy to supply these products to India and encourage bilateral trade, which we expect to grow to $500 billion by 2030 annually.
All right, Minister Goyal, I'll request you to hold on to that thought. We're going to take a short break. We'll be right back with much more on the India-US trade deal. Welcome back. You're watching CNBC TV 18. We are in conversation with Commerce and Industries Minister Piyush Goyal on the India-US trade deal and what lies ahead. Minister Goyal, thanks once again for being with us.
In the joint statement, it was also said that Section 232 probe on pharma and ingredients is on, and India will receive negotiated actions with respect to generic pharma and ingredients. By when are you expecting some outcome on this?
They have not yet imposed any Section 232 tariff on pharma. Therefore, it was not possible to exactly put in a number there. But our understanding is, and we've received assurance, that generic pharma and their ingredients will be given a zero-duty reciprocal tariff, or zero-duty Section 232 tariff.
What happens now in terms of the next phase of the deal? What will be the focus?
Well, I think once we have completed the legal paperwork, we'll continue to negotiate with the US to see how we can work towards making trade easier, expanding bilateral trade. We'll work with them to ease any tariff barriers on both sides so that we can both enjoy the fruits of this absolutely fabulous agreement that we've entered into.
Right. H-1B, of course, this was an area of concern. US has imposed additional restrictions on the H-1B program. Has that been a part of your talks, and would you be taking this up in further negotiations?
I have not discussed H-1B visas with my counterparts so far. I had discussed with our Indian industry, and they really don't seem to be perturbed at all about the restrictions on H-1B. They're very confident that wherever they require it, they will get it. In fact, some people also told me it will actually become better because a lot of the fringe applications will go out and really serious players will now be looking for entry of their people into the US to serve high-tech products and high-tech requirements. Having said that, I personally think H-1B lost its significance significantly post-COVID, when we all saw that working from home, we could do a lot of work. And we've already seen the impact of that with the growing number of GCCs that are now operating in India. Almost 1,800 GCCs now operate in India. The world and large corporations recognize that you could as well do the same work from any other offshore location. Instead of getting people into very high cost economies like the US, Europe, getting anybody to UK or London or New York or anywhere, any such places, a very expensive proposition. So a lot of work is being outsourced to their GCCs, which is great news for India because the people stay in India with their families, they earn in India, they pay taxes in India, they spend in India, adding to our economy and economic activity. They save in India, invest in India, and we also earn foreign exchange.
Right. So my final set of questions, Minister Goyal, are there going to be some concessions for US e-commerce companies to hold inventory also in India? Is that a part of the deal?
There is no such discussion with them on e-commerce.
Okay. Now, when it comes to non-tariff barriers, US had its intentions where it wanted India to ease non-tariff barriers. What have we proposed and what do we want for them in return?
Well, it's a bilateral situation. There are many areas. For example, there were restrictions on the supply of GPUs or NVIDIA chips and stuff like that, or technology products. So there are certain areas on both sides which we would like to address non-tariff barriers of the kind which are detrimental to trade, because we do believe that as trusted partners, we should be having greater trade amongst the United States and India, and we'll continue to work towards that end.
So those trade non-tariff barriers or restrictions on GPU imports, will that be a part of the interim?
All these discussions will continue to happen because that will all be a part of the larger bilateral trade agreement that we are looking at.
And finally, what's the timeline for the full BTA?
Well, I think I'm on record very often that I never negotiate with timelines or deadlines. Every agreement has to be seen through very carefully, negotiated in the best interests of our people, our country, our businesses. And while I would not like to put a timeline to it, I can assure you that both the United States and India are keen to do it fast. We share very good relations at every level, whether at the leaders level, ministerial level, officials level, businesses, or the people-to-people ties. So this is really a very, very defining partnership and friendship which we would like to nurture in the years to come.
Finally, it was signed off at the level of Prime Minister Modi and President Trump. You had done so much work in the background. Any behind-the-scenes conversation or anecdote that you can share with us? I know it's a lot is confidential, but did the coming of Sergio Gore also help things?
Well, it's been a great experience negotiating with the United States of America. I've worked with the Trump administration in their first term towards the end, after I took charge of commerce on 1st June 2019. So I had a little flavor. Mr. Jamieson Greer, the USTR, Ambassador Greer, was the chief of staff of the then USTR. So we share an old relationship and a very good friendship. So it was wonderful working with my counterparts and between the officials in the US government. But I can place on record that Ambassador Sergio Gore played an important role. He is a friend. We've had many engagements, many conversations. Of course, they're privileged, I cannot share with you. But nice person, nice friend, and a nice colleague to work with.
Minister Goyal, thank you so much for talking to us comprehensively about the fine print of the India-US trade deal. We look forward to the formal signing in New Delhi with you and Jamieson Greer. Thanks once again for being with us here on CNBC.
Thank you.
Thank you so much. Thank you, sir.
Hello and welcome to CNBC TV 18. India and the United States have finalized a joint statement whereby the two countries have agreed on an interim trade agreement, due to which the United States will reduce tariffs on Indian goods from 50% to 18%. To decode the fine print of this trade deal, we're joined by Commerce and Industries Minister Piyush Goyal. Minister Goyal, thank you very much for being with us.
Thank you.
So the joint statement is done. I think investors, exporters would now want to know, when does the 18% tariff rate become effective?
Since we had the weekend, Saturday, Sunday, after the joint statement was issued, I would suspect any day during this week, the executive order to reduce tariffs to 18% should be coming out.
Right. So does this mean that with that executive order, the rate would immediately come down to 18% in the federal register? Would it require a signing?
It would require a signing by the Honorable President of the United States of America. But now, having entered into the framework agreement and all terms being finalized, I see no difficulty in that.
Right. So are you also expecting a visit from the United States to somehow jointly announce this deal, or are you going to US?
We will have our teams now put the entire documentation in legal format so that we can sign the interim trade agreement or the first tranche of the bilateral trade agreement, for which I have invited the USTR, the United States Trade Representative, my good friend, Ambassador Jamieson Greer, to visit India. He has indicated that he would accept the invitation, and maybe mid-March sometimes he would be visiting India.
All right. So for exporters, for Indian exporters, that would be the date possibly when the new tariffs would become effective.
No, the 18% would become effective immediately. There are other areas of concessions, some areas where we've got a zero reciprocal tariff. Those will become effective after the execution of the interim agreement.
Right. Now, over the last 1 year, there was uncertainty about the trade deal, and that was impacting investor sentiment towards India. The stock market sentiment also was impacted to some extent. What would be your expectation?
Hello and welcome to Business 360. I'm Arundhati Ramanan, and these are the top headlines that we're tracking for you this evening. Fear surrounding AI triggers a massive sell-off on Wall Street. Top 7 stocks and lower. Indian benchmarks feel the jitters as well. Top IT stocks lose 2.6 lakh crore rupees in market capitalization this week. Microsoft's AI head says that artificial intelligence could take over most white-collar jobs within the next 18 months. Former Infosys CEO Vishal Sikka says that there's a gap between AI's promise and enterprise-ready reality. Also warns that it should not be assumed that slow adoption means no disruption. Money continues to flow into AI firms. Anthropic raises $30 billion at a valuation of $380 billion. The company has more than 500 clients who are spending over $1 million compared to just a dozen 2 years ago. India's sovereign bonds rise after government undertakes a debt switch with the Reserve Bank. Centre issues bonds worth over 75,000 crore rupees maturing in 2040 to ease redemption pressures and borrowing needs for the next financial year. Axis Bank CEO Amitabh Chaudhary says acquisition of Credit Access Grameen is pure speculation, but also adds the bank is in early evaluation stage of the opportunity. No decision yet on whether to pursue the acquisition or opt out. That's an exclusive. BNP reportedly registers a landslide victory in Bangladesh parliamentary elections, clears the path for Tariq Rahman to become the nation's next prime minister. Once a political pariah, the Jamaat-e-Islami emerges as the second largest party. Country's election regulator is yet to officially notify the results. 68% vote yes in the referendum on constitutional reforms. A tumultuous first leg on the budget session of Parliament draws to a close. The House saw heated exchanges over the India-US trade deal and the unpublished memoir of former Army Chief General Naravane. Parliament will reassemble on the 9th of March. The top lawyer of Goldman Sachs resigns after latest revelations in the Epstein files. General Counsel Catherine Rumella remained a close ally of the convicted sex offender through his arrest in 2019. The Trump administration revokes an Obama-era scientific finding which concluded that greenhouse gases pose a threat to public health and welfare. The finding serves as the legal bedrock for the U.S. government's climate rules. White House calls the move the largest deregulation in American history, says it will reduce cost of new vehicles by an average of $2,400. Those were the headlines that we're tracking for you this evening, but the top story today. Continued fears of AI disruptions reignited a massive sell-off on Wall Street, with the top 7 IT majors clocking steep cuts. Indian tech stocks felt the jitters as well, with top companies losing close to 2.5 lakh crore rupees this week. The Nifty IT index has fallen over 8% in the last 7 days, and this marks the index's steepest drop in 9 months. Rima Tendulkar is here with all of those details. Rima, what's triggered the sharp sell-off?
It was one of the worst weekly falls for the Nifty IT index in recent times. At the session low, the index was down 11.7%, making it the biggest fall since the COVID times, March of 2020. Of course, by the end of it, the index recovered and ended with a fall of about 8%. But it doesn't hide the kind of pain the Indian IT companies have been going through for a while. From their all-time high levels, from the peak levels, we've seen a fall of 30-40%. 40% plus for TCS and Wipro, 30% plus for Infosys. Even Coforge and Persistent have seen very sharp drawdowns, and these were some of the best performing mid-cap companies. I think the big question everyone's grappling is this just another tech cycle where Indian IT companies will be able to pivot, they'll come out on tops, and therefore the sell-off that we're seeing is a bit excessive, it's a good buying opportunity, or is this time really different? Well, Citi has a view, and they're saying that this time it's different. Yes, the Indian IT companies have weathered many storms, Y2K, cloud, but this time it's different for 3 key reasons. One, the incumbency risk. The Indian IT companies this time are much larger. They've doubled in size. since the cloud era. So therefore, they're the ones who are going to be disrupted rather than being the disruptor. Secondly, the AI impact is more pervasive. When cloud came, it impacted infrastructure, the way data was getting stored. But the impact of AI is on the operations and the business model, the entire value chain. And finally, the third reason is new AI work is coming in, but it's smaller. It's more pilot, exploratory, and not enough to offset the pressure on the legacy business on account of revenue deflation. But JP Morgan has a contra view. And here they're talking more about the kind of valuations. They're not talking about the business impact per se, but they are speaking about the valuations where they say the free cash flow and the dividend yield are now screaming deep value. They're saying that these are levels that we last seen during very severe market dislocation like GFC and COVID. And they've laid out 3 scenarios, and that is very helpful for us to gauge where Indian IT companies are headed. But of course, it depends on what your view is on growth. They're saying that from FY23 to FY25, IT companies grew between 2 to 3%. If you assume that is going to be the growth rate, low single digits, then IT stocks have a downside of 10%. But if you think it's going to get better, maybe IT companies can clock in a growth of 5-6%. Better than what we've seen over the last 3 years, but not at par with the long-term growth rates, then maybe stocks stay where they are. But in the bearish scenario, if you assume that AI is going to severely impact the entire sector, there's going to be no growth, a 0% terminal growth, then the downside risk seen for the IT companies is more than 30%.
All right, Rima, thank you so much for decoding what's happening with those IT stocks. But here's a warning from Microsoft's head of artificial intelligence, Mustafa Suleyman. In an interview to the Financial Times, Suleyman said, and I quote, "White-collar jobs, those sitting in front of computers, whether lawyers, accountants, project managers or marketers, most of these tasks will be fully automated by AI within the next 12 to 18 months, end of quote. Meanwhile, former Infosys CEO and current CEO of Vianai Systems, Vishal Sikka, told CNBC TV18 that even though there's a gap between AI's promise and enterprise-ready reality, some disruption could be expected immediately. In an exclusive interview with CNBC TV18, Sikka warned that it should not be assumed that slow adoption of AI means no disruption.
Things are always slower than we expect. Adoption takes time. Enterprises are very complex. They are, they are like countries. Large companies are like civilizations. Some of them have been around for, hundreds of years, if not decades. So it takes a long time and even in terms of autonomy, there is a lot of still advancements to happen. Similarly, in the services industry, there are dozens of service lines. AI's impact on those service lines is not all uniform. It is not, doesn't happen overnight to all of them. Some systems are much more complex than others. And so the rate of change is always as slow as the slowest pipe in the network. But having said that, I used to say this 10 years ago, 9 years ago, whenever that was. And it is here now. And we have a short window of time in which to sort of transform. I think we have to separate the potential, the promise, if you will, of this disruption from how it impacts in the here and now. In the here and now, you have particular projects that people are executing on. And if a client expects that you now do this project dramatically faster or cheaper or with less people or whatever, then that would impact the here and now. But that is something that takes time. That's what I meant by depending on the service line, depending on the nature of the work, depending on the team that is involved, and things like that. So there is the fear in general of the potential of what this can do to knowledge work. But then there is the actual reality of creating an enterprise-ready offering that uses these new capabilities to deliver those. So there is a gap between
Moving on to the day's market action, Dalal Street ended lower for the second straight session, with the Nifty slipping below that 25,500 mark. 44 Nifty stocks closed in the red. For the week, market ended largely in the red, with Sensex and Nifty falling nearly 1% each. But the outliers were those defense and PSU stocks, which outperformed and climbed nearly 4% each. From equities to commodities, gold prices have bounced back from one-week lows following robust U.S. jobs data and a strong dollar. Further fears of AI disruption also aided the overnight sell-off in the yellow metal. Globally, prices of spot gold in the international market are now improving marginally. Crude oil prices are on track for a second weekly decline despite recovering marginally today. This as concerns over a US-Iran escalation subsided and geopolitical risk premium decreased. The International Energy Agency's latest report lowering its oil demand growth prediction for 2026 also weighed on prices. Axis Bank CEO Amitabh Chaudhry has said that the bank is evaluating Credit Access Grameen as a candidate for a possible acquisition, adding that the process is in a nascent stage. Chaudhry added that it's incumbent on the bank to evaluate all opportunities and microfinancing is an important business. These statements come after CNBC TV18 reported that promoters of Credit Access Grameen have initiated a process to sell their entire stake.
We will obviously evaluate this opportunity also, but we are in very, very early stages of that valuation. We are not even decided whether we'll take the next step. But no, I mean, MFI is an important business. We've been building that business for quite some time. We have been trying to see how we can transform the business internally. Here, the question is whether you want to spend a chunk of money to buy a business from outside with all the, accompanying execution risks, or you want to build it internally. And that's a choice we will make at the right time. We are not in a hurry, absolutely.
AI giant Anthropic has raised $30 billion in a Series G round, valuing the company at $380 billion. The company has said that the investment will help it boost research, product development, and infrastructure expansions. Rachna Dhanrajani joins us now with all of those details. Rachna, how significant is the raise in the broader AI race?
Right. Anthropic's latest fundraise is a signal flare for where the AI race is headed. The Claude maker has pulled in $30 billion in fresh capital, pushing its post-money valuation to $380 billion and cementing its position as the clear number 2 in frontier AI. The round, led by GIC, quote, with participation from D.E. Shaw, Dragoneer Founders Fund, Iconic and MGX. What is driving that conviction, though, is not hype alone. Anthropic says its annualized revenue run rate has climbed to $14 billion. The customer mix is moving sharply upmarket. Clients spending more than $100,000 annually have multiplied by 7x, while those paying above $1 million have jumped from just over a dozen 2 years ago to more than 500 now. 8 of the Fortune 10 are already using Claude. Enterprise adoption is now visible on the ground. And that's the case across artificial intelligence and not Anthropic alone. We just saw Siemens say that AI co-pilots are embedded in parts of its engineering and manufacturing stack. In India, Bajaj Finance continues to highlight AI-led underwriting, collections and servicing as core to its model. Accenture and Deloitte are deploying internal AI agents. So the shift industry-wide is now pretty clear that Gen AI is moving from experimentation to operating infrastructure, and Anthropic is trying to position squarely for that in future. Now, even as the recent IT stock sell-off briefly rattled the AI trade, now to put AI trade, it was now being termed as the SaaS apocalypse. But how much of that holds up, we will find out. But to put the valuation in perspective, at $380 billion, Anthropic alone is now worth more than the combined market capitalization of the Nifty IT index, which sits near $300 billion mark. Still, the ride is not friction-free. Elon Musk has publicly accused Anthropic's models of bias, and the industry has seen some departures from safety and alignment teams at both Anthropic and OpenAI. That's number 1 and number 2 in the industry right now. Microsoft AI CEO Mustafa Suleyman also warned that the most white-collar computer-based tasks could be automated now within the next 12 to 18 months. Anthropic CEO had also warned that soon jobs will get disrupted just a few weeks back. And we are seeing that play out now. Now, all of this unfolding is amid an extraordinary capital cycle. Big tech is preparing to spend more than $650 billion on AI infrastructure this year, as we saw with the quarter earnings. Now, this brings us to the real test for Anthropic, which is execution. Now, OpenAI spent the last 2 years locking in distribution and is now under pressure to deliver margins and monetization, as we're seeing. And Anthropic is nearing a similar inflection point because the funding is in, expectations are rising. So what comes next will determine whether the capital surge translates into durable platform power. Back to you.
All right, Rachna, many thanks for taking us through those details. Now, moving on, the Supreme Court has rejected an appeal from Aircel, Reliance Communications and their lenders seeking to classify spectrum as an asset during the bankruptcy resolution. The petitioners argued that excluding spectrum from resolution processes would render any revival efforts futile. However, the apex court held that IBC cannot be the guiding principle for restricting ownership and control of spectrum. The court also said that spectrum is a material resource of the community and its control has to be secured for citizens. Indian Energy Exchange's shares fell after the Appellate Tribunal for Electricity dismissed its petition challenging market coupling. The order clears the way for power regulator CERC to move ahead with the move aimed at discovering a single uniform power price across exchanges. APTEL has told IEX that it can move a fresh plea to challenge them if it has any fresh grievances. The first leg of the budget session came to an end after weeks of acrimonious standoff between government and opposition over various issues, including the India-US trade deal and former Army Chief Naravane's unpublished memoir. The House will reassemble on the 9th of March after a 3-week recess. Tamil Nadu government has credited 5,000 rupees into the bank accounts of 1.31 crore beneficiaries under the Kalainar Women's Rights Scheme. The amount includes 3,000 rupees in advance, along with an additional 2,000 rupees as a summer special package. On that note, it is time for us to head into a short break. But coming up, the Trump administration revokes an Obama-era scientific finding, which concluded that greenhouse gases pose a threat to public health and welfare. More on that when we come back. Stay tuned. Welcome back. You're watching Business 360. The big international headlines of the day. BNP registered a landslide victory in Bangladesh parliamentary elections, clearing the path for Tariq Rahman to become the nation's next prime minister. Once a political pariah, the Jamaat-e-Islami emerged as the second largest party. Here's the caveat. The country's election regulator is yet to officially notify the results. 68% people voted yes in the referendum on constitutional reforms. Imran Khan's son has expressed serious concern over his father's health. In a post on X, Qasim Khan said that the former Pakistan Prime Minister has lost most of the vision in his right eye, with only 15% remaining. Khan's son also stated that he and his brother are still being denied visas to visit Pakistan. In response, Pakistan's Supreme Court has ordered a medical examination for Khan, particularly for his eye. US President Donald Trump has warned Iran that a failure to reach a deal about its nuclear ambitions would lead to a traumatic outcome. He also told reporters that an agreement is likely in a month, as Tehran will agree to Washington's terms. Quickly, this as the Pentagon sent USA's largest and most advanced aircraft carrier to the Middle East. President Donald Trump has revoked the Environmental Protection Agency's scientific finding in 2009, which concluded that greenhouse gases pose a threat to public health and welfare. The finding serves as the legal bedrock for the US government's climate rules. Sonal Bhutra decodes the impact the move could have on emission norms in the United States. Sonal?
Well, it is a major shift in US climate policy. The EPA, or Environmental Protection Agency, has rolled back one of its most important climate rulings. Now, back in 2009, they put out something called as the endangerment finding, which officially concluded that greenhouse gases like methane, carbon dioxide, they are impacting the environment and they're harmful for human beings as well. And now, the single scientific decision basically became the backbone of US climate science and US climate regulation as well. It allowed the government to set limits to pollution coming in from vehicles, power plants and other industries as well. But this has been repealed under President Donald Trump, and EPA Administrator Lee Zeldin, they said the finding has now been repealed, and they called it the largest deregulation move in American history. How does it change things? So basically, the US government will not be able to regulate pollution standards. They will not be able to set limits to pollution from motor vehicles, from powerhouses and manufacturing industries as well. And it will not give them any authority to regulate greenhouse gases in the country. They also plan to delay or weaken clean technology and vehicle emission standards which are linked to the ruling, and they have their own arguments. They say it will cut compliance for most of the businesses and it will lead to savings of $1 trillion. But you know, climate science says something extremely different. There have been papers as recent as 2025 and as old as 1979 which talk about how scientifically it is proven that greenhouse gas emissions cause temperature rise, they impact flooding, they impact the environment and actually cause climatic issues as well. So those things will come up for you on the screen. It's from IPCC, which is the Intergovernmental Panel on Climate Change. There have been studies from EPA itself which talk about it. In fact, as far back as 1979, one of the reports had already confirmed that human-produced carbon dioxide would heat the planet. So in simple terms, what it meant is greenhouse gases, they trap the heat and they increase the temperature of the earth. And these have been proven by scientific studies. So this has come in as a shocker and has received a lot of backlash from some of the activists and the industry as well.
All right, Sonal, thank you so much for taking us through those details. Goldman Sachs Chief Legal Officer Catherine Rumela has resigned after documents released by the U.S. Department of Justice revealed her close relationship with convicted sex offender Jeffrey Epstein. The documents indicated that Rumela accepted gifts from the late financier and advised him on how to address media inquiries regarding his crimes. Rumela and those around her have insisted she had a professional relationship with Epstein. Her resignation will be effective June 30th. The Epstein files fallout has also hit the top brass of the UK government. Britain's Cabinet Secretary and Head of Civil Service, Chris Wormald, has stepped down from his post. This after reports suggested that Wormald was responsible for conducting due diligence checks before Lord Mandelson's appointment as US ambassador. Mandelson quit after his name came up in the Epstein files. And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV 18. Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always are Shruti Mishra and Ritu Singh. These are the top headlines from the startup world. 6 Sense Mobility bags 44 crore rupees in a Series A funding round led by ACE investors Ashish Kacholia and Piper Serica. The funds will be used to scale up indigenous manufacturing, strengthen OEM partnerships, and develop AI-enabled connected vehicle platforms.
IDFI bags $53 million in a Series F round led by Neo Asset Management. Existing investors Bloom Ventures, Analog Capital, 11/8 and K Capital also participate. IDFI will use the proceeds for acquisitions, expansion and new product offerings.
Battery cell tech startup Eternal Energy raises 27.4 crore rupees in a seed round led by IAN Group. Proceeds will be used to complete product development and demonstrate manufacturing capabilities in India.
Ever Brands, operator of Subway and Lavazza in India, gets $15 million round led by Playbook Partners. The fresh capital will be used to strengthen its multi-brand food and beverage platform and support further expansion across India.
Money continues to flow into AI firms. Anthropic raises $30 billion at a valuation of $380 billion. The company has more than 500 clients who are spending over $1 million compared to just a dozen 2 years ago.
Those are the headlines that we're tracking for you today on Startup Street. But in what's growing, digital finance platform Olive has raised $23 million in a Series B funding round that was led by Nandan Nilekani's The Fundamentum Partnership with participation from SMBC Asia Rising Fund. Now, this money is going to aid the company's next phase of expansion, scaling the core business, deepening customer engagement, and laying the foundation, it says, for long-term value creation. It will be deployed to expand the product suite with new offerings across insurance, UPI, and business loans as well. So let's get a sense of how important the funding is for the company and the growth path, what that looks like going ahead. Let me invite Rohit Garg, the co-founder and CEO of Olive, for more on this. Rohit, welcome to Startup Street, and thanks so much for your time here. Begin by telling us about this $23 million fundraise you've done and how exactly are you going to distribute this capital between various things you've outlined, whether that is going into insurance and UPI, deepening your customer relationships, etc.
Thanks for having me here, Ritu. Great to be here. So Olive is a digital lending platform with focus on expanding financial inclusion with credit and the full stack financial product base for the entire emerging India base. So we started on this journey about 7-8 years ago. And now Olive is scaled immensely with 50 million users across the country. We have disbursed more than 10,000 crore since inception. And the business has been growing profitably for the last 11 consecutive quarters. Now, this funding particularly comes at a very, very interesting juncture for us. So with profitability and a very, very strong PMF that we have, this funding allows us to invest in the long term, expanding our product suite for our customer base beyond just the lending product that we have right now, but into areas like insurance, UPI payments, as well as business loans. And our aim is to create the leading full stack financial platform for emerging India. And beyond capital, if you see, we have raised this round from the Fundamentum Partnership, which is founded by Mr. Nilekani and Sanjeev Agrawal, and SMBC Asia Fund. So both are very, very strategic and investors with very deep understanding of Indian financial sector. So we are looking forward to building a very large business with this.
You've already done about 10,000 crore rupee of loans in cumulative transactions. You've also stayed profitable for the last consecutive 11 quarters. How much incremental scale is this fundraise going to get you in the next 2 to 3 years without really compromising on profitability?
Right. So, see, we have always focused on risk and unit economics as the core pillar of our business. So from here, we are looking to scale and cross over $1 billion in AUM and 100 million in users over the next 3 years using this capital. So definitely a very, very strong path ahead for us.
And what's going to drive that? The kind of numbers you're giving us for FY29, $1 billion plus, and the kind of user base you're looking to expand to. What is the plan to get there?
So see, in India, while obviously financial services is still percolating down, right? And if you see historically, majority of that has come to the top 10% or the affluent and the mass affluent base. What we see here is now the opportunity to digitize the next 500 million users. So people who are sitting in tier 2, tier 3, people who are working as mom and pop store owners, working as emerging salaried class. So these are the segments which have still been overlooked because historically they were data poor and most people never thought the income levels are good enough to build sustainable, profitable businesses. We have been able to, I think, break that thought process. So from here, with the credit first hook, we are able to gain very, very strong understanding of the user as well as build trust. And with that trust, we want to become the one-stop platform where users can come and take care of all of their financial needs. So the idea is to go both horizontal and vertical to actually solve all of our customers' financial needs. And that platform will definitely have the kind of reach that we are talking about.
You say your core customer base is pretty much beyond the metros, tier 2 and tier 3 cities of India. Are you seeing any change in credit demand or repayment behavior in these markets as the lending cycle matures? I mean, especially when it comes to small ticket loans, unsecured loans. At least from traditional players, we've been seeing talks of a stress which seems to have been have peaked and is now coming off. But what are you seeing on the ground?
So see, what we realized even when we started, right, the traditional ways of serving this customer base, if you take from the affluent base and apply it as is, that does not work. Because one, as I said, the data hasn't been enough historically. So they're stuck in a chicken and egg loop, right? You don't have enough credit history, so you don't get a good loan. If you don't get a good loan, you are not able to build the history. And that's where the whole digitization journey with smartphones and DPI, I think what they have done over the last 7-8 years is like immense, right? So today, if you go to a tier 4 town or like even a village, you see people who are as digitally literate as an urban consumer, right? They are actually shopping online. They are actually making payments through UPI and everything online, right? So they're very much comfortable. So now the onus is on you how you use this unstructured data, because this data is still not structured like your typically white collar audience provides. And what we have done with machine learning and AI technology is to harness this data and convert into more usable format. And once you are able to do that, then those insights allow you to actually lend them profitably with very, very reasonable loss performance. And that is why, as you rightly said, while the overall macro hasn't been very great over the last 2 to 3 years, but we have actually seen consistently decline in our NPAs, consistently growth in profitability, and growth in operating leverage. So I think we are at a very great juncture to solve for this.
Well, Rohit, finally, since you're looking at expanding into all forms of credit, you're looking at UPI, you're looking at business loans, you're also looking at insurance. How do you ensure you don't spread yourself too thin? And what will be the one core focus area that Olive would be known for?
So you're absolutely right. And focus is paramount as you build a FS firm. So our core is credit. And the idea is you use the data insight that you get from credit and expand it to adjacent markets. So currently, we're already doing personal loans. We plan to expand into business loans. And because these customers are using UPI as a mode of payment, we plan to then advance into that. So I think the idea is to go more sequentially rather than like bridging into this all at once. And then once you build trust, I think over time, then you are able to augment that base. So that's the plan.
All right. And we wish you the best with that, Rohit. Thanks very much for your time here today on Startup Street.
Thank you. Thanks a lot.
Well, moving on the hot seat today, developer of carbon dioxide removal projects Varaha has announced a $45 million Series B round, closing the first $20 million tranche led by Westbridge Capital, making the firm's first climate tech bet. From biochar and regenerative agriculture to afforestation and enhanced rock weathering, Varaha is building high-integrity carbon removal projects with long-term off-take agreements already in place with Google, Microsoft, and a major US-based aviation player. Now the company is launching the Varaha Industrial Partners Program, opening up its carbon removal platform to industrial players globally. To tell us more, joining me now is Madhur Jain, the co-founder and CEO of Varaha. Madhur, welcome to Startup Street. Almost a $45 million raised in Series B funding with Westbridge leading, and this being their first climate tech investment. Madhur, what does that signal about investor conviction in carbon removal today? I believe you're on mute, Madhur, if you could unmute yourself.
Yeah, so see, carbon has seen actually a very difficult sector, difficult time last year. And most of the companies globally were not able to raise any equity financing for the most part. Especially growth financing were almost non-existent. But how Varaha has built business in a very diversified manner while having different pathways of carbon removal and also great traction in terms of not just contracts locked, but also delivering on the revenue potential and that too profitably across several quarters. I think these are the things which stood out for someone like Westbridge to make their investment into Varaha.
Sure. Madhur, you operate across 4 pathways: biochar, ARR, regenerative agriculture, and enhanced rock weathering. Which of these is scaling fastest, and where do you see the biggest commercial opportunity?
So, see, I mean, because we are deploying capital across all 4 categories, we continue to see a lot of opportunities across 4 sectors. But I think if I have to pick one, I would say regenerative agriculture, because like it helps on the food security part, also saves billions of liters of water if you start to practice these. So the benefits beyond carbon are also substantial. And hence, I do see lots of investment coming into regenerative agriculture and this category growing the fastest.
Okay. All right. Like I mentioned earlier, you've signed long-term offtake agreements with Google, Microsoft, and a major US aviation company. Elaborate, on the nature of these agreements. Also, how hard is it to build credibility in a market where concerns around carbon credit integrity remain high?
Yeah. So, also on top of it, we remain the only Asian company to actually sign these contracts with these large counterparties in the category that we signed these contracts in, which is even bigger achievement. But so one of the fundamental reasons is that when you're working with smallholder farmers and creating these carbon removal pathways, you need to have a very strong scientific, rigorous team in place, and also the ability to build a technological platform which can help you verify, validate, and monitor year on year how these credits are being produced. So 25% of Varaha's team is actually science and tech, wherein we hugely invest, which allows us to build trust in our product.
Okay. Varaha claims it has delivered one of the highest volumes of durable carbon removal credits globally. So what differentiates you scientifically and operationally from other carbon project developers? Also take us through your revenue and growth targets for the near future.
Yeah. So what separates us is our scientific partnerships with both global as well as nationally important institutions on creating high quality data for quantification of credits. The second part is development of digital monitoring, reporting, and verification platform, which has been done in-house and certified by the carbon standards as well. So this is one of the most critical pathways which has allowed us to scale so rapidly and deliver these credits. In financial year 25, we were at 40 crores in revenue profitably. In financial year 26, we expect to close to 100 crores, which is 2.5x growth in just one financial year, and again profitably. So being one of the few organizations in this sector globally to be profitable allows us to scale further and faster in the coming years as well.
Sure. Let's quickly now talk about the new Varaha Industrial Partners Program. Madhur, why open up your platform now, and how exactly does VIPP evolve or potentially transform your business model?
Yeah, we see climate change as one of the biggest crises of our times.
Yeah.
And carbon removal is a very important way to mitigate that. Now, we see a lot of organizations globally in the global south which have the potential to contribute towards carbon removal, but don't really have the know-how of how to really set up these systems, how to quantify credits, how to find buyers. And since Varaha has been able to build all of this infrastructure, we thought that this allows us to expand our business rapidly using our technological platform while allowing for more and more sequestration and providing benefits to smallholders globally. So that was the reason that we opened it up recently to work with more and more partners across geographies and continents.
So Madhur, if I'm an industrial operator with biomass and gasification capabilities, what does partnering with Varaha actually look like? From sensor installation and MRV systems to monetizing credits in global markets.
Yeah, so if you have biomass, we would help you right from establishing whether this biomass is additional or not, which form this biomass should be used in to create high quality biochar, which is permanent in nature, installing the sensors which can capture enough data, and then working with the auditors to get the audits done, working with the registries to get the credits out, and then working with large tech companies to put long-term offtakes into place. So we handle end-to-end so that it provides certainty to these players to work with us.
All right. On that note, it's time for me to wrap up our conversation. Madhur, many thanks for joining us on Startup Street, and wish you the very best for the future.
Pleasure.
On that note, it is time for us to head into a short break. But coming up next, premium hair care brand Adani bags $3 million in a Series A round led by RTP Global. We speak to the firm's founder to decode their fund deployment plan. On the other side, stay tuned. Welcome back. You're still with us on Startup Street. Premium professional haircare brand Adani has raised $3 million in a Series A round led by RTP Global as it looks to scale research, expand its salon network and build a science-backed haircare portfolio tailored specifically for Indian hair and climate conditions. Founded in 2023 by second-time entrepreneurs, the brand already has a presence across more than 500 premium salons and is betting on a salon-first strategy to build trust and performance credibility. Joining me now to discuss this further is Soumya Yadav, the co-founder of Adani. Soumya, thank you so much for taking time out and being here with us on Startup Street. You know, you are building this premium professional haircare brand at a time when ingredient-led and science-backed beauty is gaining traction in India, right? What early growth signals are you seeing and how big do you believe the opportunity is for India-focused professional haircare?
Thank you for having me here today. So Adani is a professional haircare brand specifically formulated for Indian hair. And we believe that over the last few years, the Indian audience has become really aware and has started understanding more about skincare and hair care and started demanding products that are specifically made for them. We are now very evolved to the stage where we actually demand whether a particular ingredient is right for us, whether a particular regime is right for us. And we have let go of a lot of fads that came to us from the Western countries. And we feel this is the right time for a professional hair care brand to grow in India, which is specifically made for Indian hair and Indian climate and backed by science and research.
Sure. And, you know, most of these salon haircare brands, as you pointed out, in India are either imported or not specifically designed for Indian hair and climate, right? So what sort of makes your formulation different and what proof points are you seeing from stylists and consumers?
Yes, actually, a lot of global brands that are present in India in salons and also selling directly to consumers are made for colder climates and hair that are finer in nature, mainly Caucasian hair. And in a lot of cases, either those products are very less in conditioning or they will dry out the hair more than needed, or they will make the hair very limp. They have not been made for the coarser hair that Indian hair is, plus the climate that we are in, which is very hot, very humid, and also has a lot of pollution and dust and dirt. We have been seeing that over the course of the last 2 years or close to 3 years now of building this business, that our research is so ingrained in Indian salons that every product that we introduce gets tested in different salons across the country so that we know how it is impacting the hair in different climates and different water conditions. Plus the R&D itself is so strong that whenever we choose a new ingredient that we want to add to the product, it goes through a thorough test of its efficacy on Indian hair. We have been seeing that over the last 1 year, salons have really adopted us quite fast. In the last 1 year, we have grown from just 10 salons to now being present in almost 600 salons. And in a lot of these places, we are becoming one of the top brands that they promote to the end consumer as well as use in their regular treatments.
All right. And you know, you've chosen this salon-first go-to-market model and you're already present in over 500 salons across the country, right? So how critical is this professional channel for you to sort of build brand trust and adoption? And how does salon traction translate into retail and online sales?
So globally, if we look at any haircare brand that has become really big and made billions of dollars in sales or in valuations, have always been professional brands, because there is a inherent bias in the consumer's mind that, oh, if a brand is professional, it would be better, or if the quality of the product would be better. And that is actually true, because a professional brand, by the nature of being present in a salon, is put to a higher standard. It is being used by a stylist or by people who are very used to using high quality products. And consumers are able to sense that and also develop a bias towards it. We also feel that salons are a great place to do brand building. Just imagine a consumer walking into a salon, they're already thinking about hair care, and the kind of brands that they will see will include Adani, which is one of the only Indian brands that will be present there. So when we do advertise on other platforms, say social media or on marketplaces, that just reinforces the bias that he has already developed or she has already developed towards this being a better product or an efficacious product.
Sure, and you've raised this $3 million in a Series A round, which was led by RTP Global, right? As well as participation from other investors. Where will this capital sort of be deployed? You've got R&D, new product launches, salon expansion, brand building. Where are you going to spend the funds?
So a large part of it is going in R&D and brand building right now. Brand building for us includes salon expansion because we consider that as a marketing strategy as well. Currently, we only have 3 SKUs for retail and just 4 SKUs for salon. Hence, a lot of focus is going on expanding the product portfolio and focusing on more problem areas than what we are present in currently.
Sure, and you know, you actually preempted my next question. I was going to talk about the fact that you have a limited but focused SKU portfolio, right? So what does the product pipeline look like for you in the next 12 to 18 months?
So for us, R&D is really a very important part of what we do. And every product takes a long time for us to actually launch. One of the recent products that we launched has taken 13 months of R&D iteration testing. And the final formula that has been launched is actually the 66th formula. And this is something that we actually hold very proudly with us. So the next products that we are working on, we had already started working on them last year, and they are in the hair fall range, in styling, in dandruff range. And as and when we feel really confident about those formulations to bring them to the Indian consumer is when we would be ready for them to launch.
All right, Soumya, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on your journey going forward.
Thank you for having me.
And on that note, we're going to wrap up this edition of Startup Street. From Arundhati, Shruti and me, it's a goodbye and thanks very much for watching. Stay with us. News and updates will continue right here on CNBC TV 18.
Hello and welcome. You're watching Global AI Lens. I'm Parikshit Luthra. India is all set to host the AI Impact Summit in the coming days. Against that backdrop, we take a look at how AI is poised to strengthen a new world order as the old one steadily erodes. So what is this new order? It's a new alliance of mid-sized nations aiming to compete with the US and China, an idea championed by Canadian Prime Minister Mark Carney in his speech at Davos. Many of these nations are forging new pacts built on shared digital infrastructure and localized AI. Smaller nations too are optimistic. They see AI as a way to navigate political shifts and build resilience. Thriving economies for them, it's not about hyperscalers. It's about focused sovereign AI systems powering trade, banking, governance, and citizen services amid rapid advances in AI and growing geopolitical uncertainty. Economies are transforming fast. The winners in this race will be those who don't wait, but those who build the guardrails as they build the technology. Now, where does India stand on AI readiness? According to a 2025 KPMG survey, Indian CEOs are bullish on AI's potential while remaining acutely aware of the risks. The report found that 74% of Indian CEOs believe AI workforce readiness will significantly impact their organization's growth over the next 3 years. And there is more. Companies that deeply embed AI into their operations and invest in preparing their workforce are likely to gain the greatest advantage. To unpack this further, we're now joined by Harjeev Singh, founder and CEO of Cambrian AI, world's first human-centered AI native marketing platform. Also with us, Purushottam KG, who is head of AI at KPMG in India. Thank you very much for joining us. Harjeev, let me begin by asking you about the thoughts that you hope to bring at the India AI Impact Summit next week. And really, do you feel this is India's AI moment?
Good evening, Parikshit. Thank you for having me here. I think it is indeed India's moment. As you set it up in your comments, that this is a pretty big, significant shift in the way the world is going to approach everything we do, from business to government to policy. And given that India has one of the world's largest young demographics, and the amount of the galvanizing of compute and AI capacity in India that is going to get harnessed from leading beyond this AI summit, India can lead this revolution around AI, especially given that we focus on the workforce and allow our teams across the world, as in within enterprises and within government, to get AI fluency. I think that's going to be very critical as we sort of think about expanding our capacity and to revolutionize, the world's workforce is revolutionizing India's workforce. I think that's going to be critical for this.
All right. Let me also get in Purushottam KG of KPMG. Purushottam, how do you see the readiness of some of the top and leading corporates in India in terms of workforce readiness for an AI future?
Thank you, Parikshit, for having me on the show. I think the question is extremely relevant. It has been always contextual in the last 3 years that that India has been driving the AI revolution, not only for India but also for the world, because India has been servicing the world as well. When it comes to the Indian readiness, the journey started, almost alongside the large tech players, because India had to be ready for the future. India is already in the top 3 when it comes to AI readiness and competitiveness. And in the last 3 years, we've actually been talking to CEOs and understanding how they are approaching AI. And one thing that is very clear is that there is a clear recognition amongst most of the CEOs, and you have the statistics in front of you, that most CEOs really think AI is going to be the next game changer. They had recognized it 3 years back. But the fact that they started investing in it, investing in their talent pool, and also making them AI ready is testimony to the fact that they are seeing their talent pool to be the future of the organization, to not only innovate but also consume. India is going to be the largest consumer as well. The India AI mission that was launched 2 years back has not only gotten multiple institutes, but also a mission for every educational institute to actually not only churn out engineers, but also skilled engineers in AI. Yeah.
All right. Purushothaman, I'm going to come back to you. Harjeev, when we speak about Cambrian Edge AI, tell us about the kind of solutions that you're looking to bring. And secondly, on a larger level, if India is targeting becoming a Viksit Bharat, a developed nation by 2047, how can AI help us in that goal? We're looking at a race for AI for large frontier models between US and China, but what can really work in India's case and help us deliver for our population?
Sure, no, absolutely. At CambrianEdge.ai, our focus has been to absolutely revolutionize the space of marketing, which actually, if you look at the global employment numbers, this was from a report Foundation Capital did a couple of years ago. There's about $1.1 trillion of salaries that go to marketing teams across the world. AI oftentimes is misconstrued as something that's going to disrupt jobs and workforces. Our take is very different. We are very human-led in our approach. We are very focused on ensuring that teams that come in, come onto our platform, and we have about 300 enterprises across 18 countries that are on the platform today, and it's built for large enterprises. One of the things we focus on is ensuring that all of these board AI mandates, where at a strategic level, if you see the data from the CEOs, they all are mandating AI, right? Because they all see that this is going to be a very big shift. The more important thing is, are the teams getting the fluency to use it on a day-to-day basis in a manner that allows them to access all of these large language models? So our platform has all of the models built into it, and we also have a collaborative feature that allows teams to work together. And we're seeing some phenomenal, results from accelerating how AI fluency can be brought into the enterprise. To your point about how India plays a role within this, I think that's actually a very important question. For any of the countries, and you mentioned in US and China as sort of dominating the large language model space, I think India has a phenomenal opportunity here, especially if you look at, Sarvam.ai. We are also building out a lot of compute at lower cost, which is essentially what it takes for AI to be successful and deployed across the country. India is always very good at managing something that can scale. I mean, look at our UPI and digital infrastructure. It has been phenomenal. And I think we can do the same for AI across our country and our population.
All right. Let me also get in Purushothaman once again. Purushothaman, when it comes to the industries in India which are going to see the greatest impact of artificial intelligence and the way it changes the way we work, which would be those sectors where you foresee the greatest impact?
The greatest sectors are going to be those that are going to first touch the end consumers, to be very clear. Financial services, TMT as a sector, and retail are the top three sectors that have actually been driving not only the digital boom, but also the AI revolution. Others obviously will follow, but these are the top three.
Right. Coming back to you, Harjeev, and this question would be about what India needs to do from a regulatory point of view. What kind of interventions possibly can provide a more enabling atmosphere to startups and also to attract investments?
Sure. Now, I think with any new technology, it is very important to have the right governance structures and policy enablement. India already has the world's third largest startup ecosystem. I also believe that the question you asked Purushottam earlier around which sectors are going to get impacted, I can tell you every sector in the world. It does not matter which sector you're on, because the fundamental change AI, and we're a native AI platform, comes from the fact that we have to rethink organizational structures. I think a lot of companies are still trying to figure that part out, because if I'm mandating AI across my companies and I'm not changing the org chart and not doing the org redesign to live in a world where you have this super intelligence available to everybody in your team, you are going to roll it out like a software tool, not like what AI can actually do. So that's just one point I wanted to add in there. But I think there's phenomenal opportunities for India to play a very large role, because given that we have such a young demographic and such a large young demographic in the world, which is the largest, if we can ensure from a policy standpoint that we are investing in workforce fluency across the board, there's an amazing opportunity to tap that and do it quickly, because the other countries are not sitting back and waiting for this to happen, right? The US and China are quite far ahead in terms of the investment dollars that go into it. But I think we have our soft power in terms of our human talent, which is actually the most powerful part.
Okay. Purushothaman, my final question to you. What's your expectation and hope from the India AI Impact Summit? And secondly, how do you think this summit in India will translate into actual investments on the ground?
So, very, very important question. But at the same time, I want to also share that by having this summit itself in India, India has actually proven to the world that India can launch a summit of this scale by bringing in more than 500 CEOs, more than 500 startups. You have organizations that are not only showcasing their best-in-class infrastructure, but also niche enterprise solutions that are embedded with AI already from an India standpoint. And we have a lot of innovation that is actually coming through. My expectation from this conference, obviously, and I have a fair degree of understanding of what's the agenda like. The panel sessions of the global CEOs will be clearly a hallmark where different points of view, their perspective on how India will not only be relevant, but also be the driving force for this transformation around the world. That will be one expectation. Second is the showcase of the Indian talent, the startups, the enterprise solutions that are embedded already with AI and how it's being transformed will be the second one. And thirdly, and the most important one is obviously you started with the skill set and the ability of the Indian organizations to upskill its teams. How are Indian corporates also driving this entire skill accelerate program within their organization is also something that you can actually see. So innovation at scale, inclusion at scale, and also penetration of AI already into every facet of our life is something that you're going to see Indian organizations really showcase as part of this conference.
All right, we're going to take a short break. And first of all, I'd like to thank Harjeev and Purushothaman for joining us. We've run out of time on this segment, but when we return, we're going to get you more conversations. And this will be with one of the companies showcasing their innovation at the India AI Summit. Stay tuned. Welcome back to Global AI Lens. The India AI Impact Summit is just 4 days away. Over 100 countries are expected to participate. California-based global silicon to systems design company Synopsys will showcase its AI-led engineering solutions at the 2026 summit. The event comes soon after Synopsys announced its $35 billion acquisition of Ansys. The deal strengthened Synopsys' capabilities in physics-based simulation and advanced chip design. It is expected to be a key enabler for next-generation AI systems across automotive, robotics and industrial sectors. Dr. Prith Banerjee, Senior Vice President of Innovation at Synopsys, joins us now at the India AI Impact Summit. He will be speaking on the role of AI and machine learning in electronic design, automation and engineering simulation with a focus on AI-driven design flows and digital twins. Prith, thank you very much for being with us. Why don't you break down for our viewers first as to what is the kind of innovation that you would like to showcase to the Indian public, the Indian media and the Indian government at the AI Impact Summit?
Thank you very much, Parikshit, for inviting me to speak to your audience. You mentioned that Synopsys acquired Ansys. I used to be the CTO at Ansys before the acquisition. I'm now leading our innovation across the different portfolios around IP, electronic design automation, and simulation. So what we are going to showcase is the future of intelligent products in every industries like automotive, aerospace, healthcare, high tech, and energy. They're getting transformed by what we say is silicon designed, software enabled, and AI driven. 3 pillars. So when you look at a car these days, right, you have a software-defined vehicle where the car is becoming intelligent with the software that runs on the electronic chips that drives these things. And all of those will be AI-driven. So what we are going to showcase is how Synopsys is embracing the concept of AI. The specific area is what is called physical AI, where it is not just the foundational models of the large language models with words as tokens, but the physics of the world AI models that are around us. And we are going to use that AI to build intelligent products across different industries.
Right. Let me also give us a sense of how Synopsys is investing more in terms of getting ready for an AI future and also serving its customers for their AI needs.
Absolutely. So Synopsys, our mission is to empower innovators in every industry. And so let me kind of break it down. Synopsys used to be the leading developer of electronic design automation systems to design the electronic chips that you have heard from that go up to 1 trillion transistors. We used to help our customers in designing those electronic chips using what is called electronic design automation tools. But the tools, these chips are getting more and more complex every day. So, and the pace of innovation is advancing. And so in order to address the pace of innovation and the complexity, the challenges are so much that we are embracing the power of AI to build with these, to address these complexities. So specifically, we are investing in an area of what is called agentic AI, where if you have engineers that are designing these electronic chips, these intelligent systems, you would run out of the complexity so much you require almost 1 billion people, 10 billion people to design these systems. What we are doing is using agentic AI techniques to build what are called agent engineers to complement the human engineers. So the combination of human engineers with agent engineers are going to help our customers across different industries, automotive, aerospace, healthcare, high tech, and energy, to build these incredibly intelligent systems. So we are embracing the AI technologies, foundational models for physical AI and agentic AI to help our customers to innovate very, very interesting, intelligent products.
All right. Let me also ask you about the importance of India in terms of your growth strategy. What's your workforce like in India? How do you plan to scale up your workforce? And how will it contribute to your revenues in the next 5 to 7 years?
So Synopsys is a global company. We have customers globally. We have workforces globally, including India. I cannot break down the percentage of people in India, but it's a very, very significant percentage, especially in the R&D that we do in India. And but with respect to embracing AI, we are going to include AI training for our engineers. And these engineers are actually using this agentic AI technology and using foundational models for AI to help our customers in building most intelligent products. So we are a global company with global customers, and we have a very, very significant customer footprint and workforce footprint in India.
Right. Now, just to ask you about the kind of innovations you believe, Dr. Banerjee, will really change the way we work and function as human beings, as people working in the private sector and the public sector. You're speaking about agentic AI. What are some of the models or applications you think will really change the way we function in the next 5 years?
So we are in the early phase of AI. The early phases, as you all know, right? We used ChatGPT to help us write poetry or compose essays and so on. But those were very, very early uses, and those are what are called using large language models. The future is what we call the world models, physical AI models. So as we help our customers in designing airplanes, automobiles, energy systems, solar farms, high-tech equipment, healthcare devices, the way we use AI is going to completely change the way engineers who design these products design the products. For example, in the past, when you were using an automobile, a car, that car was a mechanical car. You had a mechanical steering, a mechanical brake, a mechanical different things inside the car. Now it's all software enabled, right? So that there's a piece of software which is almost like a 10 to 100 million lines of code that runs on a Tesla car these days. And so when you have an electronic steering, there is a steering, but it's controlled by software. We have electronic brake, it's a brake, but it's controlled by software. These software things that you write are incredibly complex. And what Synopsys is allowing our customers to do is to do that software design, the validation testing, and powered by AI. And so our customers will be able to use the latest technology powered by AI, by agentic AI, to develop these incredibly intelligent products across industries.
One thing that a lot of governments around the world are trying to see is what is the scale-up of autonomous technologies we're likely to see? Which industries are going to see the greatest prevalence of autonomous technologies?
So that's a great question. Again, we serve our customers across automotive, aerospace, energy, etc. Right? I mean, when you are flying an airplane, I'm sure, Prakshit, you know, almost 80% of the time, the plane is running on autopilot, right? So the pilot actually is there to supervise, but the plane is flying itself. Now, flying an airplane is much easier than driving a car, right? And again, driving a car, right? You have these autonomous driving, cruise control, which is like an autonomy, but it's driving at a 55 miles per hour on a straight highway is an easy problem. But driving a car in the streets of Mumbai, right, with lots and lots of traffic and pedestrians, that's a hard problem. So these areas they're going through, as you know, from level 1 to level 2 to level 3 to fully autonomous driving. And we at Synopsys are helping our customers in building these level 5 autonomous vehicles. So automotive industry will see a lot of these kind of values, but so with healthcare, right? We are working with lots of customers in the healthcare area to do robotic surgery, autonomous surgery. We are helping NASA with their Artemis mission to fly the aircraft to go to the moon completely autonomously. So you'll see in every industry, aerospace, spacecraft, surgery, data centers, and automotive, cars, all of them will embrace autonomy, and they will be powered by, as I said, silicon designed, software enabled, AI driven systems.
All right. Thank you very much, Dr. Banerjee, for joining us for that very interesting conversation ahead of the India AI Impact Summit. That's a wrap on another edition of Global AI Lens. Goodbye and many thanks for watching.